Okay, you're all right, we're gonna get started. Morning, everyone. So our first paper for today is, well, risk and return in government bonds. And I can't find the schedule here. I'm still trying to get my act together. You have 20 minutes. Thank you so much. Please go ahead.
Thanks for having the paper on the program. This is joint work with Caroline and Adi, who are both sitting here. So let me start by motivating the paper. So we all know that long-term treasury yields experienced a prolonged decline followed by rapid increase in recent years. Of course, this change in yields can reflect movement in the natural rate or term premium. But what does explain low frequency variation in term premium? A natural candidate is variation in bond risk that in this paper we measure using the bond stock beta. But then two obvious questions arise. Can changes in bond stock beta explain variation in long-term yields? And do investors even price these bond stock betas? Or are bonds priced completely different and completely separately from the price of stocks? In this paper, we show that bond stock beta is priced once you use risk premium measure that account for expectation of future yields. So let me be clear about that. A standard proxy for risk premium is to use future realized excess returns. And here in this figure, I'm plotting them on the y-axis is future realized excess return against the 5-year stock bond betas for US Treasuries on maturity 3, 6, and 11 years. Let me pick a point to be clear what you are looking at. Here is June 2011. The bond stock beta was minus 0.15. This is the bond stock betas over the preceding 5 years. At the same time, the realized return from June 2011 to June 2012 was 18%. So from this figure, you may conclude that there is a weak and noisy relationship between bond stock beta, which is risk, and future realized return or risk premium. Now, in this second figure, we use an ex-ante measure of risk premium, which is expected excess return, or as is commonly known in the literature, subjective expected excess return. So now, here you can see June 2011, and here the subjective expected excess return was minus 3%. So from this figure, you can see a strong and positive relationship between the bond stock beta and risk premium, or a risk return trade-off. So what happened in June 2011? So after June 2011, US Treasuries market were surprised by the European sovereign debt crisis, with the ECB cutting rates and a flight to safety that pushed down US Treasury yields, and so pushed up the returns on US bonds. So this shows the advantage of using an ex-ante measure of risk premium rather than ex-post measure that is contaminated with surprises. So let me give you some more detail on how we construct this expected excess return. So in order to construct an expected excess return, you need the price today and an expectation of the resale price of the bond 1 year from now. Now you can rewrite in terms of yield, where expected excess return from time t to time t plus 1 for a bond of maturity n is equal to the duration of the bond times the current market yield minus duration minus 1 times the expected yield 1 year from now of a bond that now became n minus 1 maturity minus the risk-free rate or the short-term rate. In order to measure expected yield, we use the expectation of professional forecaster from the Blue Chip Financial Forecast. So this has been done in the literature, and this is commonly known as subjective expected excess return. For the rest of the talk, I'm going to just call them expected excess return for brevity. So here, the intuition is this really current market yield minus expected yield with some different scaling. Now, once you use this formula, here are the main results of our paper, of what we do. First, we find that expected excess return increase with bond stock beta. And this is true in a US panel, both in the time series and cross-section across maturities. It's true in an international panel of 12 advanced economies, both in the time series and across countries. And to give you a sense of the magnitude, we find that the price of beta is similar to the equity risk premium. Then we show that it is really the market that is pricing this bond stock beta. And in fact, current market yields load more on the bond stock beta than expected yields. Finally, we have a simple term structure model of expectation to rationalize the results. But what's the bottom line? The bottom line is that variation in bond risk that we measure through bond stock beta explain half of the secular decline and the recent rise in bond yields that we see in the data. So this is our paper. Now, let me skip the literature and go straight to the US data. We measure the US bond stock beta in a very standard way. So it's a rolling regression over the past 1 year or the past 5 years. So here you can see a different maturity. The bottom line is that pre-2000, the bond stock beta was positive. Post-2000, the bond stock beta turned negative, and recently is increasing. In light blue, you see the 1 year rolling regression. In dark blue, the smoother 5 year rolling regression. Then we measure US bond expected excess return using the formula I showed you before. Now we use actually monthly data. So here is the expected excess return from times t to times t plus 12. And here we measure for different maturity. And in dark blue, you see the smoother 12-month average. And here is the same idea and the same fact. Expected returns were positive pre-2000, then turns negative with some volatility. And recently, they turn positive again. Now the question is bond risk premium related to bond stock beta? And here, according to major hedge fund, it seems so. So Ken Griffith on Citadel in January said, if stocks and bonds in the US start to move together, this will result in bonds having a much higher demanded yield in the marketplace. According to major dealers, it's the same concept. Record high correlation creates need for greater risk premium on bonds. So what we can do now, we can test this relationship formally. And so what we do, we can do a simple linear regression of expected excess return, future expected excess return on the bond stock beta. And what we are interested in is this lambda, which is the market price of risk. And here are the results. In the first column, you see the coefficient that is approximately 11%, 10.87%. Now, you can control for bond variance and maturity fixed effect, moment of the yield curve. You can control for the time trend. You can have a time fixed effect. And so it's a pure cross-sectional estimate. And we recover basically the same, virtually the same result. So the main result is that expected excess return loads strongly on bond stock beta with a coefficient that is similar to the equity risk premium. Now, of course, we also know that both the market and forecaster are subject to a number of bias. So then we try to control for some of that, as well as inflation. So now we're going to add a bunch of controls. So in this table, you see in each column, the name of the column is what we put on the right-hand side as control. So we start with the expected change in Fed future rate that has been shown to be highly correlated with the expected change in long-term yields. Then we can also control for expected return or pseudo-expected returns that are based on pure statistical forecast for yield. And so we can have yields based on AR model, moving average model, or also slow learning model a la Farmer Nakamura Stanson. Nothing seems to change the beta. Finally, we also know that inflation moments affect both the bond stock beta and term premium. So we try to control for the standard deviation of inflation and expected future inflation. Nothing seems to really affect the results. So the next step is, okay, let's try to go a bit deeper into what is driving the result. And here I pull up the same formula as before. Here you see the expected return formula. And what we would like to do next is to estimate the loading for the market yield and the expected yield, which is in red. Now, of course, these two objects tend to trend over time, also because of changing expected short-term rates. So to trend them, we use the spread between the market yields and the expected yield with respect to the expected average treasury bill rate over the next 10 years. And then we're going to use these two measures and regress on the bond stock beta. So here are the results. In turn, we first regress the market yield minus the expected short-term rate, and we find the coefficient around 4. Then we regress the expected yield minus the short-term rate, and we find a weaker coefficient of around 2.7. And actually, once you add fixed effect, the time trend is even smaller. So the idea is that market yields load more on bond stock beta than forecasted expected yields. What's important? In this paper, we are not trying to convince you that forecasters use the CAPM to predict future expected returns. But we're saying that forecasts are useful to the trend yield to obtain plausible measure of risk premia, while it's really the market that is pricing the bond stock beta. Finally, notice that this object enters with a positive sign, while this object enters with a negative sign. So it's really like the bond stock beta of the market minus the bond stock beta of expectation. Finally, note that this is a standard measure of term premium, which is the current yield minus expected short-term rate. Then we start to say, okay, what can explain then the model of this forecaster? Then we interviewed the old Goldman Sachs team that now is all in the buy side in Citadel and Millennium, as well the current team. So what they say is that they use what they call a fair value model to relate macroeconomic factors such as inflation to long-term yields. JP Morgan, similar concept. So the way we rationalize this forecast is these forecasters, they think they have an edge in doing macroeconomic forecast, and it's shown to be the case in the data. Now then they fit this macroeconomic forecast into a fair value model that relate to the 10-year yield. And on top of that, they have some judgment. So they don't fully trust models, so they had a judgment component, and that's how they find the 10-year forecast. But so an example is inflation seems an important variable. So what we do next, we try to take an extreme case of a fair value model where we don't have any term premium consideration whatsoever. So let's say these guys, they don't care about term premium, and we construct a pseudo expected excess return when instead of having the expected yield, we use the expected inflation over the next 10 years scaled. And again, no consideration about term premium. And now we regress this expected excess return on the bond stock beta, and we find a very large coefficient of 27. There are two insights from this. First, forecaster need not to use CAPM as long as the market is pricing the beta. Second, using the model, we can show that based on this estimate, we can recover a lower bound for the true market price of beta, which is 5.1%. Then we ask, okay, are these forecasters completely unrelated to future expected excess return? So we regress future realized return on expected excess return, and we find a positive coefficient of 0.84, which is also not distinguishable for one. So it seems that they are able also to predict future excess return, just that the bond stock beta does not. So we think they are pretty good in forecasting high frequency variation in short-term returns, while low frequency seems harder. So let's put those together and let's find the implication for term premium that we can estimate based on our lambda and expectation about beta. So here is the term premium, which we see is positive. This is our beta implied nominal term premium was positive, then negative ended up. We can also estimate a beta implied real term premium. And the bottom line is that changing in bond risk explain about half of the decline as subsequent rise in bond yields. Then we can move to international panel. Here, let me be clear. The dark line is the bond stock beta. The dashed gray line is expected excess return. So let me pause and repeat. It's different from the previous chart because here I'm superimposing the bond stock beta to the expected excess return. And here you see a strong correlation. In Canada, 86%, in Germany, 70%, in the US, 75%, as well in Japan. So here we can use our panel and we can run the same regression and we recover a very similar coefficient. We find that this holds in time series in the cross section. And to give you a sense, here I'm doing a univariate regression for each country. And these are the lambdas or the coefficient for each country. And you see it's pretty stable across countries, always positive, and statistically significant in most countries. Then we can do, so this seems to hold in the international panel. We can do an exercise to study the potential effect on QE on this market price of risk. Here we find that the loading on bond stock beta falls during QE. So QE reduces the market price of risk. And the key insight is then that the effect of QE depends on the stock bond betas. Let me be clear. Here we don't have any identification and we also have limited variation. So we think this is just suggestive evidence. Finally, but yeah, so the key insight is that QE effect depends on the bond stock beta. Finally, in the remaining time I have, let me put on the table a simple model we can use to rationalize the results. Here we have the 1-year yield which is depend on one factor, which is autoregressive. We have three sets of belief: rational belief in blue, market in green, and forecaster. And we have the bond stock beta that is autoregressive with some persistent. And different agents can have different perceived persistence. So it can be rational, market, and forecaster. Then we assume that the market price of risk is scaled with the bond stock beta depending on lambda. There are a number of insights, but in the interest of time, let me give you just two insights. First, even if forecaster perceive the beta to be less persistent than the market, so if rho tilde of forecaster is less than the market, we will estimate a lambda that is greater than the market price of risk. This again to say, even if forecast is a reduced form to say, even if forecasters are not even using the bond stock beta, we will actually recover a higher lambda. Second, if market has underestimate the beta persistent with forecaster, and both markets and forecasters share a bias about the persistence of short-term rates, then this behavioral bias can weaken the relationship between realized return and bond stock beta, which is the noisy figure I showed you in the first slide. So this is the model that we use to rationalize these two main findings: why we recover high estimated lambda and why it doesn't work with future realized return. So given I'm just out of time, let me conclude that variation in bond stock beta explain subjective expected excess return with a high correlation. We have consistent evidence in the US in a panel of international countries. And the implication is that the improved hedging were contributing to the negative term premium, and the rise in bond risk explained the recent rise in bond yields. Thank you very much. Looking forward to the discussion.
And Kelly Shu will discuss.
Okay, well, thank you very much to the organizers. I really enjoyed reading this paper and thinking about it. I think it's a very nice paper. So as a very quick recap, and I think the paper is fairly simple, so I won't spend too much time summarizing it. So the paper starts with the question: when bonds become riskier, do investors demand higher expected returns? And bond beta has changed over time. It was risky pre 2000. It was a hedge from about 2000 to 2021, and it's now positive beta again, or risky again, 2022 until now. And in the data, if you were to look at realized bond returns, that shows no relation, basically a flat relation with respect to beta. Now, what this paper does is, instead of looking at realized returns, they measure subjective expected returns from proportional forecasts. And once you look at subjective expected returns, then there's a positive relation. Okay? So their findings are that the subjective expected returns track betas with actually a pretty large slope of 11% per year. Okay. And this fact has important bond market implications. It tells us that half of the secular decline in long yields from 86 to 2016 would be a beta-driven term premium. And further, it also has some implications about QE, which I won't get into because the authors didn't have time to get into in their presentation either. Okay. All right, so overall, I think it's a very nice contribution offering new facts. That flat realized return cloud becomes a clean upward sloping line if you just measure beliefs as, let's see, if you measure expected returns using the subjective belief measure, okay? And further, it's nice in this setting because we actually get negative beta, which you rarely observe in other asset classes. So when the bonds were hedges, the forecasters did make forecasts consistent with expected bond returns underperforming cash. Okay. Their analysis also has an impressive battery of controls. And I think this might actually be kind of an out of sample test, which is More recently, I don't know when they started working on this paper, beta changed again, and so did the subjective expected returns according to their prediction. Now, I like this paper, but I think I kind of appreciate it from a different perspective compared to the authors. I think of it as presenting a really interesting puzzle, okay? So for the bond stock beta, it explains a subjective expected return. So their rolling average beta predicts subjective expected returns, but it does not predict realized returns. Now let's combine that fact with the separate row, the second row, which is the term spread. That's a classic predictor of returns. In their paper, they show in table 2, term spread does not predict subjective expected returns, okay? But we know from previous work, all the way going back to Campbell Schiller and a lot of other research following, that the term spread does predict realized returns, okay? So I think this paper is about more than just, oh, the CAPM works in bond markets if you just measure expectations properly. It's really a puzzle about a long-running violation of rational expectations. The market seems to believe in something that they are just never paid for, which is the bond stock beta, okay? Meanwhile, the markets are paid for something that they could use to shape their beliefs, or maybe it is their beliefs. But the markets are paid for something, the term spread, that they claim they don't believe in, okay? So this seems to be a puzzling contradiction within their data. Okay, so some suggestions to strengthen the paper. My first suggestion is to position the paper as a contribution to the subjective asset pricing literature. So what is this literature? It's this literature showing that in a variety of other asset classes or cross asset classes, risk does seem to be priced approximately with the CAPM if you look at beliefs, but not risk is weakly or not priced at all in terms of realizations. So there's early work by Brav, Lahavi, and McKaylee showing that analysts and value line expected stock returns rise with beta, but the SML line remains flat, okay? Kausman, Calvis, and Loudis, they show that institutions' capital market assumptions across a lot of different asset classes also line up with the CAPM. Gormson and Huber's research showed that firms' perceived cost of capital, so that would be another measure of beliefs about expected returns, does increase with beta. There's also work by Burke and Van Winsbergen, Barbara Huang and Nodine showing that fund flows, if we were to use those as a proxy for beliefs, they behave as though investors risk adjust using the CAPM. Okay? So I see this paper as offering an important new test of subjective asset pricing within government bonds and coming out with some kind of similar findings, which is that the CAPM works a lot better if you use subjective beliefs. Here's another recent example that kind of summarizes the findings in the subjective asset pricing literature. This is Tice Jensen's job market paper. And here what he's showing is the slope of the coefficient from regressing subjective expectations of future returns on beta. And what he's showing, sorry. Okay. Is the CAPM as well as Fama French 3-factor model work pretty well if we use belief measures of expected returns. Okay. Now, I think it's still important with this existing literature to test these findings in the bond market. It's a very interesting new setting. It's not just a new asset class, it offers new tests. This is a unique setting where we actually get to observe negative beta. Okay. So we get to test this idea further. And for the volatility-based intuitions can never deliver a negative premium, whereas covariance logic can. And now we have also time series variation in one asset's risk rather than the usual cross sectional tests. Okay? And here we also have important implications that could be highlighted more. So from a monetary policy perspective, if half of the decline in long yields reflects pricing of beta, that means the natural rate is not falling that much, which means that monetary policy, I guess, presumably could respond less. It also offers a potential explanation for this 2004 to 2006 Greenspan conundrum. Why didn't long yields go up with short rates? Well, maybe there was a corresponding shift in the betas. Okay. Now, subjective asset pricing, in my mind, fits very closely with the results for betting against beta in the classic Fresini and Pedersen paper. What they show is that across many asset classes, alphas are falling with beta in almost every asset class, and they actually looked at treasuries here. So for high beta treasuries, there's also negative alpha. Okay, so I think of this paper's results as, again, consistent with these betting against beta findings. You could call this, oh, CAPM works if we think about beliefs, or it's also consistent with just a lot of mispricing. Okay, so if we were to take standard betting against beta logic even more naively than in their paper into this paper, what you see here is on the right, subjective excess beliefs rise with beta. Okay. Now, betting against beta logic would say, well, if high beta bonds are overvalued for whatever reason, the most naive version is the market has overly high expected returns, and they read that as alpha. So they buy all of these high beta stocks, okay? Well, then these high beta stocks, or when they're high beta, is going to deliver low realized returns, and that then leads to the flat relation between realized returns and beta. My second comment and suggestion is to try alternative measures of beliefs. Now that we see this paper as the general framework is subjective asset pricing, then the ideal test for subjective asset pricing is we want data on the marginal investor's beliefs about expected returns and also forward-looking betas. Okay. Now, I think what the paper does is actually quite reasonable. Beta is highly persistent. They measure that as a 5-year rolling average. But there are situations where a backward-looking beta differs quite a lot from forward-looking betas. In particular, it matters, I think, for a lot of their international tests. So this is, if you look at the red and the green lines, those are the measured betas for Italy and Spain, and you see that they peak in 1997 and 2015. Okay. For those of you that know kind of European crisis history, these years seem a bit off. I think what's happening here is there's a 3-year lag behind the ERM crisis of 1992 to 1995, as well as the doom loop of 2010 and 2012. Those were the periods when probably the actual forward-looking betas for Italy and Spain spiked. Okay? But their measure is lagging that by about 3 years, while simultaneously they're using a forward-looking expected return measure. Okay? So in certain cases, I think it could matter a lot. The other thing that they want is the subjective expected return from yield forecasts by professional forecasts. That's their proxy for the market's beliefs about expected returns. Now, in my own research, I found that these professional forecasters are just very bad at forecasting changes in long yields. Okay? So in research with Rick Townsend and Chen Wang, what we found is that professional forecasters do significantly worse than just a naive forecast that predicts no change in the long run. And given that the long rate is a forward-looking measure of expected changes, expected levels of short rates plus some risk compensation, a no change forecast is a pretty reasonable benchmark. Okay? It's not necessarily a problem if marginal investors have the same mistaken beliefs. But it is a set of people that have very confused notions about where the long rate is headed. Okay, so I'll show you actually graphically exactly what they're doing. So the light blue line is the actual path of the short rate. That's the policy rate. Okay, the light red line is the actual path of the long rate. Okay? And each of these hairlines is the consensus forecast of these forecasters over the next 4 quarters. Okay. So what we see in this picture is from the year 2000 forward, their short rate forecasts are doing pretty well. This is maybe the idea that there's a consistent reaction function by the Fed, there's forward guidance, et cetera. But their long rate forecasts exhibit massive errors, okay? And specifically what we've shown in our paper is, I think, a very funny mistake, which is that they are predicting matching shapes over the next 4 quarters of the short rate and the long rate. So if they're forecasting that the short rate goes up and down in an N shape, they are forecasting the long rate goes up and down in an N shape, which is not true in the data. Okay, this is one thing that leads to a lot of forecast errors. Okay, if they think that the short rate is going to go up over the next 4 quarters, they think the long rate is also going to go up in tandem with the short rate over the next 4 quarters. Again, not true in the data. Okay, this is a group I would say that should know better, so we know their identities. So this is Gary Chiminero's forecast. Okay, and it's his personal forecast of the long rate against the consensus forecast of the short rate. So the consensus forecast of the short rate is not his private information, right? So it's not like he knows what the Fed is going to do, nobody else does, so it hasn't been priced in the long rates yet. Okay? So he thinks that because the short rate is going to go up, the long rate is going to gradually go up over the next 4 quarters. Okay. And if you look at his Vita, I mean, it's again a puzzle. He should know better. He was chief economist at Fleet. He has a MBA from MIT Sloan. He was admitted to the Harvard Biz Ed program, although he did not graduate. He was a professor at Wharton, and he testified before Congress alongside Alan Greenspan on monetary policy. Okay? But he had these just wild errors. All right. So I'm not saying this explains the results in their paper or biases in any particular direction. It's just these forecasters are making strange forecasts. Okay? Now, the paper is aware of forecaster bias and shows that their model works even if forecasters don't care about the CAPM, as long as the market cares about the CAPM. Okay? So let me just give you a simple example of how this logic works. Okay? Suppose the forecasters don't care about the CAPM. Maybe they don't even know about the CAPM. Okay. They just follow a fair value yield rule, which is, let's say 4% is the Fed path for short rates plus an inflation adjustment. Okay. And let's say duration is 9. Okay. Now, bonds are risky. And here in their framework, the market is smart, cares about beta, forecasters do not. Okay. Well, then the forecasters might demand a 0.5% per year. Sorry, the market demands a 0.5% per year compensation for beta. So today's yield, let's say, is 4.5%. Okay. Now, these naive forecasters ignore the beta-driven premium. They keep on forecasting fair value. Okay. So their predicted yield for next year is 4%. That means then the measured subjective expected return from forecaster data is 0.5 plus duration times the expected change in yields. Okay, which is 5%. So notice this is a very inflated number, and it's high exactly when beta is high. Okay. Now the catch here, though, is naive forecasters really inflate the magnitude. The market does care about beta in the example, but the market only demands a low compensation for the beta. The measure says 5%. Okay. So this means that their slope is an upper bound on how the market prices risk, and therefore exact prices of risk for beta are not identified. So again, I think their measures are reasonable, but it would be nice to supplement their measures on beliefs about beta as well as expected returns from other sources. So here's I'm not sure this is possible, but this would be kind of my dream list of forward-looking beliefs about beta and expected returns. You could look at the New York Fed surveys. Some other papers have looked at institutional capital market assumptions about covariances that would give you a forward-looking estimate of beta. All right, next comment has to do with addressing a potential alternative explanation, which is because beta is slow moving. If overall you pick up a positive return and beta relationship, that could be driven by a change in macro regimes rather than a change in beta itself. Okay. So we can think about inflation scare regimes. Okay. And this is when there are supply shocks. So there's a supply shock, inflation's hurt stocks and bonds together, we get a positive beta. So it'd be like pre-2000, more recent years as well. Okay. Further, the inflation premium could push up yields above the expected Fed path, and therefore a measured expected return is high. The second regime would be a recession scare regime, which kind of occurred throughout the 2000s to 2020. This is a point when we're afraid of demand shocks. So there's bad news, the Fed cut rates, bonds rally on the Fed cuts while stocks are crashing. Okay, so this is like a negative beta regime. There's no inflation premium much during this time period, plus a lot of safe asset demand. Yields are below the path, and now measured expected returns are negative. Okay, so in this story, you would also get this positive relation between expected returns and beta, but the ultimate cause of that is not pricing of beta. It's a shift of these macro regimes that simultaneously determine stock bond beta and expected returns. So I don't think the existing tests quite separate these stories. The international panel does help, but some of these other countries may just be shifting across these two regimes as well, just across different time periods. A more direct test would really test the slope of the expected return versus beta within an identified macro regime. And I think the good news for the authors is when I just like did an eyeball regression of figure 1B, I did actually see a strong positive slope just within a recession scare regime. Okay. All right, my last comment, and this is again something I think that could matter but is easily addressed. Right now, the paper considers interest rate risk and inflation risk, but ignores default risk. Okay, but if there is default risk, that can simultaneously inflate the subjective expected return measure as well as beta, again leading to what looks like a positive relation between the two. Okay, so let's take Italy in 2012. Its spread over bonds was 300 basis points. Okay, and that's because we were worried about Italy actually defaulting on its bonds. Okay, suppose its expected default loss is 150 basis points per year. Okay, its true expected return, let's say, is only 1.5%. Okay? However, the measured subjective expected return is just a mechanically higher yield pricing in that default risk. Okay? This is just that classic MBA junk bond lecture that I actually do give to my students, which is the yield for maturity for junk bonds, as well as Italian debt, apparently, is the yield to maturity is not the expected return. It is much higher than that because it is priced in default risk. Okay. Now, default risk also raises the stock bond beta because at this point, Italy's going through stress, its bond prices fall, the stock prices of all the big banks holding the stocks also fall, and then there's this doom loop as the country then has to go and bail out these banks, further putting distress on these bonds. So now we've got a positive stock bond beta. All right, so I don't think this explains the US results unless, some of you are pessimists about US bonds. Maybe there's a lot of default risk with us too. But it does call into question some of this cross-country evidence. I think the simple fix here is use a safe sovereign panel, or you can subtract the CDS implied expected losses from your measured expected returns, because they're going to be mechanically inflated for this issue. All right, so I'm just about out of time. I do think it's a very nice paper. And again, I think this paper is interesting more for the questions that it raises. Why do markets believe in something that they're just never paid for, this bond stock beta? And why are markets paid for something? So the term spread does predict returns, but it does not predict their beliefs. Okay. Thank you very much.
We have 20 minutes for questions. Maybe people want to line up at the microphones and authors come up here. Might be good to collect a few questions so we get through more questions.
Yeah, so very interesting paper. Somewhat to Kelly's point about whether it might be overstating the magnitudes because you're just looking at the 1 year expected excess return. If I remember the data correctly, you can also just look at longer horizon expected excess returns because you've got the forecasted short rate path over the next 10 years. As long as you've got at least a 10-year maturity bond, you could say, what are the cumulative excess holding returns over the next 10 years to see if this is just something they expect to happen over 1 year, like maybe it's mispricing correcting, or if it's really compensation for risks that they think is going to apply year by year. And then on a micro level, more for my personal interest, since they have quarter by quarter forecasts, you could even see kind of within the next year where they think these things are going to be realized, because you can see what they expect the yield to do 3 months, 6 months, et cetera. It'd be interesting to just flesh out not just the 1 year expected return, but the whole term structure of expected excess returns.
So as Kelly nicely put out, there's sort of like two ways to look at the evidence that you have. One is through the lens that, hey, realized returns were just very noisy, that's why you don't see it. And the other is, hey, people are not being compensated the right way. So I think that one way that you can try to disentangle it is if you create an objective measure of ex ante expect returns, think of like a out of sample type of machine learning, whatever that may be, and you see whether the relationship between beta and expect returns holds with the objective measure as well. If it does, then it's mostly the unexpected returns, things that people could not possibly expect ex ante that just are creating the noise. If that does not line up, then it's more the Kelly interpretation. So I think that may be a nice way to explore that.
I wonder if, for great, really interesting paper and great discussion, have you looked at tips at all? Because Kelly mentioned the inflation scare regime, and one of the puzzling aspects of that was that as treasury yields jumped by 3%, long dated, the tips yields jumped by almost exactly the same amount. So in the inflation scare regime, break-even inflation didn't move. And it seems like you might have an interesting story that could potentially explain that.
I think in the international panel, you're using each country's domestic stock market to measure the beta. I'm just curious, how critical is that? Do results go through if you use a global, some form of global index? That relates a little bit to Kelly's point about the doom loop. Just curious about that.
Do you want to answer those 4 questions? Take the next round? Or do you want to?
Yeah, thank you for the fantastic questions. Thank you for the really insightful stuff. I sent you this 100-page appendix just before July 4th. And I'm sorry about that. Yeah, I just wanted to say, just to reiterate our key measure, and that I think that's a little bit different. Of course, there's a way to think about what we're doing in terms of subjective expectations. But what I think is different about this specific set of expectations is that their forecasters are not predicting future returns. They're predicting yields. And so our measure is the market yield relative to the forecast. And so we're picking up at least partially also on the risk premium, on the beta relationships with market yield. So I think that's one reason why our beta is really, that the result is interesting and a little bit different from simple cap in, cap out story. We don't think that's what's going on. And yeah, so Sean, yes, I love your question. Where we are, it's true, our baseline overstates the magnitudes. The forecasters are not thinking about the cap emina. And I talked to someone who's been doing that since 1980. He said he never heard anyone talk about the cap emina. If they don't think about the cap enough, it's as if the risk premium were going to mean revert within a year. And of course, we're going to imply an expected excess return that varies too much. Now, if the market was not pricing betas at all, and our model helps with that, if the market was not pricing betas, the prediction is we should still get a 0 coefficient. You can reject that no. So it seems the market prices beta according to our data. There are certainly other ways to bound this estimate. We've done one bound. So if you see our baseline of 11% as upper bound for the market price of beta, when we completely remove the term premium from the forecast, we also get a lower bound of around 5%. So I think that is actually fairly tight between 5 and 11% as a price of beta. I broadly would view all of that within the range of the equity premium. Yes, and then Andre's question, of course, one could do more on objective measures, and of course, you guys have this very nice evidence that we're going to hear more about later. That's about longer horizon capital markets assumptions. I think the advantage of the forecasts here is really that forecasters are not just who knows what they're doing. They're making lots of mistakes, no question about that. And that's why the data is really useful for us, because as long as the forecasters are somewhat closer to the market than something else that we could do, it helps us take out some of these persistent return surprises that happen over our sample. That's the purpose of using the expectations here. I think they're precisely useful because there are mistakes in macro forecasts. That said, I think we're getting one step beyond, we could just throw up our hands here and say, oh, the markets are irrational, that's it. But I think we're going one step beyond that. We're saying, well, there are probably mistakes about, is the Fed going to keep inflation under control over the next 10 years? But on top of that, it seems like some of these very basic ideas that have been around in finance for a long time, co-movements with what's arguably a higher shock ratio asset correlated with the SDF, these co-movements do seem to be priced on top of that. And I think that's pretty interesting and pretty fundamental for discussions like we've had over the past few days, what happens to bonds and stocks on FOMC dates, right? In order to think about that, you need to think that there's some sort of joint pricing. And tips, absolutely agree. Tips are a little tricky to feed into our full analysis because just the expectations that are available. But I can tell you that over the past 3 years, the increase in bond stock betas has been concentrated on the tips. And John and Luis pointed that out in our review paper that's forthcoming now. And so has the increase in yield. So it's very much consistent. It's not necessarily an inflation scare story on the betas over the past 3 years. And you see that in the yields, you see that in the beta. So maybe that's a little bit kind of a third regime that gives us additional observations beyond just, is this high inflation versus low inflation?
So on the question on the bond stock beta, we use domestic, but we also have an extension in which we use the US market to estimate the beta. The results are visually the same, just like slightly weaker. And on Sean's question, so I show you a table where I use actually the market yield minus the expected short-term rate, which is exactly what you wanted. And there you see still the bond stock beta. And we also did the term structure. There is nothing like so puzzling when we use like 1 quarter to 2 to 3 quarter horizon.
Okay, very nice paper. I have 2 quick questions. First, the risk premium is asset beta multiplied with price of risk. And if you look at US stock market, one may argue that the price of risk or risk premium for US stock market has changed quite a bit in the past few decades. So I wonder if you think the bond market investors or these forecasters also incorporate that information into their forecasts in addition to just the beta variation. And my second question is, does the subjective forecast data also explain or predict changes in quantities of treasury in addition to the returns? Thanks.
So it seems like if you match these expected returns, let's say that you call them subjective, but let's say it's really expected returns, but then rates fall a lot during this period and that's unexpected. It seems like you could try to sort of fix that part of it or like account for that part of it pretty easily and recover back whether the subjective explains what remains, because these bonds have pretty simple 1-factor structure. We know how much yields went down. So give it a chance to see whether what you have then has explanatory power once you add back to each bond, say its duration times the unexpected fall in rates. In your figure, like you could see that you had the line for the subjective, and then it flattens out such that all the ones that are in the lower left-hand corner just basically go up. And if that's the fall in rates, it's not like a big mystery that we had a fall in rates there. You could stick a term like that back in with their duration and see whether then what you have left over explains that. That seems like it would work.
I want to encourage you a little bit to respond or to at least tell us some thoughts on one of Kelly's points. We know a lot about what predicts returns in bonds. And in that world, people have not naturally come up with the stock bond correlation as one key variable. And ultimately, if the market cares about this, we should see it in somewhere in those predictions. So I'm kind of curious how you can reconcile your results that are very striking with these other results that are also, I think, extremely striking and well established.
Yeah, I wonder, you have this interesting result that bond stock beta explains a big portion of the secular decline of interest rate. So maybe could you elaborate, because here the bond stock beta explains subjective returns, not realized returns. So I wonder, is your claim is about in subjective return realm that explains decline, or you're talking about the realized decline of the secular of the yield?
Oh, can I ask a question? This is more like just for visualization and understanding, but I thought it would be interesting, your first two graphs to plot the surprises as a function of the betas. It seems like whenever the betas are low, the surprises are always positive and high negative or something like that. So I think that would help with the interpretation. The other thing I wanted to pick up on from Kelly's discussion, and I think because you have so much data on the forecast themselves, but when she brought up the betting against beta evidence, it made me wonder, like, if you have segmented markets and people that need to invest in fixed income are kind of reaching for yield, then you could get kind of these results from the standard betting against beta forces.
Yeah, so let me just start with this issue of what predicts, and thanks, that was super helpful discussion. What predicts realized returns versus what you're like subjective expected return? I think the simplest answer is think of there being, systematic mistakes in the market yield too. Those systematic mistakes line up with the stuff that we say predicts realized returns, right? Like, so why does the term spread predict returns? Because when the term spread's high, that's when people are wrong about the future path of rate. And I think that's the simplest explanation for it, which is exactly sort of what NBER and others say too, which is like, once you add back the surprise, that's the formula for realized returns versus the formula for our subjective expected returns. The difference in that is the surprise. And so like it's just arithmetically has to work out that way. And we could just show that directly in the figure. I think that would be helpful. The other thing, Carolyn said this, I just want to reiterate that I think what's cool about this setting is, yeah, the forecasters don't use the countdown. They're not NBER. They're doing the NBER thing, but they're not. It's not like the equity analysts who they literally do the countdown calculation in the report. Here, and we showed this briefly. Like, you don't actually have to use the yield forecast. You just use an inflation forecast, and that's good enough to recover a correlation with beta. Just because you need to strip out, sort of these. You just need something that captures a bit of the supply on it. So unexpected or inflation expectations do that just as well. And so for me, the real active takeaway of the paper is that once, John and I and Carolyn and Luis look for a relationship between bond risk and bond returns forever. I almost quit back in school. But and so what I really take away from it is the first thing in the decomposition where it's you do market yield minus anything that strips out some of this long-term stuff, you find a relationship between market yields and bond betas, which I wish I found it 20 years ago, but so that's for me what I took away from the paper is that actually it does look like the bond market cares about this thing.
Can I ask the last question? The change in the regime of stock bond betas also coincides with arguably two different regimes about the level of interest rates. And one thing that I want to hear your thoughts on this. The period of the negative stock bond betas being a level of extremely low interest rates, so the two things don't have to go hand in hand, but they have, right? And if you look at what happened over that period, and I think that shows up in the expectations, is most market participants just kept forecasting rates need to go up. It's like that. You could have a model of very changing regime and extremely slow learning. They never believed interest rate could be so low, and they have to go up. That also shocked me with macroeconomics, the zero over time when we're not, that cannot be possible. You just have to do, and they just kept thinking that way, and that's what was happening in the forecast. And then you have this coincidence between the two. But there's no causality of any of the same kind. Just these two different things happening at the same time and doing that. And in fact, you can see institutional investors. Joe was in this board of the Harvard Management Company. When was the last time that HMC invested in long-term bonds? I mean, they just all day, you're looking at this same most institutional investor, which is out of the box, even though it was the best performing asset class in the last 20 years. But they just kept up. So how do you think about this coincidence of things? And I think it's an interesting thing how we can connect both of them and this other thinking about risk premium. Level of rates and risk premium is different. Just want to give you thoughts.
Yeah, I mean, that's a good question. So the level of yields has changed, and I think that similar to Wenhell's question, if you want to, the main takeaway from this analysis is that the level of long-term yields is correlated with bond stock beta. Doesn't need to be that the causality goes from betas to yields, but we have a lot of theories that would give us reason to believe so. If you think that at some other sort of level, we have thrown in a lot of controls, right? So we've thrown in, for example, if you think it's about, okay, this was a time when inflation expectations plateaued, we can control for any sort of inflation expectations that you can come up with. What we showed you is the 10-year forecast of inflation, which actually has the most spiked. Anything else is weaker than that. We've controlled for inflation volatility, which of course came down at the same time, but the bond stock beta still drives that up. And I think that's what you would expect and Kelly asked, what about these being different inflation regimes? Of course, we have worked on this, Adi, that yes, when there are stagflations, we would expect bonds to be risky. They should fall at the same time as the stock market. So we should think that an inflation regime with supply shocks on the one hand feeds into positive bond stock betas. And the question, but we're bracketing that out here. Here we're asking, if you have positive bond stock betas, does the market even care? Is this going to be priced, and do they require higher yields? And that's what we show this evidence for. So I think it's it's entirely expected that this should move across inflation regimes. But when we put in both inflation and bond stock betas, it's the bond stock betas that explain the expected excess return, which is also what you would expect if inflation flows through bond stock betas and therefore affects risk premium. And similar for credit risk, I'm not an expert on credit risk, but of course, to the extent that Italian bonds are expected to fall in a crisis, that's a beta, that's a risk that should be priced and should have a risk premium. That's why we ran the regression as it is, but we'll do more robust.
Just to be clear, the two regimes are not only about expected inflation, it's about the real problem. That's the actual interesting thing, and Ken mentioned that. Real rates were extremely low, regardless of inflation. Look at tips yields. You and I worked with that. And then you get in 2022 this huge U-turn on real rates, not just the nominal rates, more than real rates. So we have to think about that part.
I think we're just about out of time, so maybe we should continue this discussion over the break. All right, welcome back, everyone. We're going to get started because, of course, we're already running behind. All right, you have 20 minutes. Take it away.
Great. Thank you so much to the conference organizers for including our paper on the program. It's an honor to be here, and we're super excited to share with you our research. So one of the motivations for this paper is this fundamental idea that future monetary policy decisions matter today. In particular, households, firms, and investors, they make decisions based off of the expected policy path. And I want to be very clear that throughout this talk, when I mention the expected policy path, I'm specifically referring to the market's anticipated sequence of future monetary policy rate decisions. So not just what is the FOMC going to do to interest rates next meeting, but even for several meetings forward. So naturally, the path being uncertain can affect investment, risk-taking, asset prices, among other things. But the question is, where does this uncertainty come from? On the one hand, greater uncertainty about the economic outlook could lead to spikes in uncertainty about the expected policy path. Alternatively, markets might have a relatively clear understanding of the economic outlook, but face uncertainty about how the Federal Reserve is going to respond to incoming information. So this motivates the three questions that we ask in this paper. First, how can we measure uncertainty about the expected policy path? Second, once we have this measure and we see that this uncertainty spikes, what is really driving it? And lastly, do different sources of policy path uncertainty have different consequences? So monetary policy uncertainty is often treated as a single object. We're often interested in how much monetary policy uncertainty there is and then understanding its effects. Yet similar increases in uncertainty can reflect very different sources. So to motivate this idea a little bit more, we have this table here comparing the onset of the global financial crisis in the fall of 2008 with the spring of 2022. And these were both periods of elevated monetary policy uncertainty, but they had very different underlying environments. So in the fall of 2008, markets were relatively certain that the Fed was going to ease in response to negative economic shocks. But what was uncertain about the path of policy was the economic outlook itself. How deep and how prolonged would this recession be? The spring of 2022 is very different. This was a period in which output was relatively stable and inflation was clearly above its target. Yet investors faced uncertainty about how the Fed was going to respond to this inflation. Would they hike by 25 or 75 basis points, and how long would they remain restrictive? So what we argue in this paper is that similar increases can reflect different sources, and that these different sources can ultimately produce sharply different outcomes. So for instance, just looking at how treasuries behaved during these two periods, in 2008, treasuries were a hedge for stocks. The stock-bond correlation was negative. Whereas in the spring of 2022, treasuries were more of an amplifier for stocks, and this correlation switched to positive. So in this paper, we're interested in digging into this a little bit deeper, and we're going to do three things. First, we're going to construct a new measure that captures evolving uncertainty about the expected policy path in real time. I'll go into more detail on precisely how we do this, but the key idea is to directly measure from financial markets how their expectations are changing throughout the period in between FOMC meetings. And then what we're going to do is we're going to structurally distinguish two fundamental sources of policy path uncertainty using a Bayesian structural vector autoregression. And we're going to mention how there are two fundamental sources that can lead to spikes in this policy path uncertainty. One is when there's greater uncertainty about the economic outlook, which we call macroeconomic uncertainty or MU, and the other essentially being uncertainty about the Fed's reaction function, which we call monetary policy response uncertainty or MPRU. And then we're going to trace its economic consequences, and we're going to find that the source of the uncertainty and not just the level is important both for macroeconomic dynamics as well as asset pricing responses. So in the interest of time, I don't want to spend too much time on the literature, but I do think it's important to note that there's this large literature on measuring monetary policy uncertainty, as well as understanding the effects of macroeconomic uncertainty and uncertainty about the Fed reaction function. And the stock bond co-movement. So I'll tell you what's new with this paper. Beyond the measure we construct, we identified the source of observed increases in policy uncertainty. We're then able to quantify macroeconomic uncertainty's contribution to policy path uncertainty and have a systematic identification of policy responses uncertainty's contribution to PPU. What this does is it allows us to have a direct contrast with macroeconomic uncertainty within the same framework. And we think that our empirical results are going to align really nicely with this stock bond co-movement literature, and we'll have some empirical evidence of how the hedging properties of treasuries can respond to these different sources. Okay, so with measuring this uncertainty measure, first, our goal is to construct a measure that captures evolving uncertainty about the expected policy path. But why do we even want to create this measure in the first place? Well, first, we want it to have 4 properties. The first being that it's market-based. The reason for this is we want to directly measure in real time investors' changing expectations, which we can do using market prices. Then we're going to have a measure that is model-free. So not that there's anything fundamentally wrong with measures built from models, but for our purposes, we don't want the source of uncertainty built into the measure itself. Third, we are going to be looking over the intermeeting period. So to define this, the intermeeting period is the day of the FOMC up until the day before the next FOMC. And the idea here is that investors are constantly updating their expectations. So if we were to just look at this narrow window around the FOMC, we'd be missing a lot of changes that investors are facing. They can respond to, for instance, like CPI reports or speeches from Fed governors. So we want to capture all of that. And lastly is our policy horizon. So we are interested in the full near-term policy path. So not just what happens at the next meeting, but for over a year forward. So we'll be looking about a year and a half forward in terms of the market's uncertainty. So how precisely do we do this? We are trying to, as accurately as we can, have a measure of investors' expectations for the federal funds rate. So to do this, we use 2 data sources, Fed funds futures and the OIS forward curve. And we're going to use Fed funds futures for horizons 1 through 4. And I want to define this. So H equals 1 through 4. This refers to how many FOMC meetings forward we are. So H equals 1 is 1 FOMC meeting forward from where you are today. H equals 4 is 4 FOMC meetings forward from where you are today. So we're going to use Fed funds futures for horizons 1 through 4 and OIS for horizons 5 through 12 FOMC meetings forward. So that's the data. But how exactly do we do it? Use it. So we have a daily revision in the expected policy rate H meetings ahead. So what this means is that on every single trading day, we're going to have the daily change in these expectations for 1 FOMC meeting forward, 2 FOMC meetings forward, all the way to 12 FOMC meetings forward. Then we go from the daily frequency to the intermeeting period frequency. And how we do that is we compute the realized variance over the intermeeting period. So the intermeeting period, again, is that time between FOMCs. And it's going to have J trading days. It's approximately 6 weeks on average. So what this means is now our frequency is intermeeting period. That's what this T is. And so for each intermeeting period, we're going to have the realized variance for each horizon. So for horizons 1 through 12. And then finally, we're going to aggregate across these 12 horizons and have this one realized volatility measure, which we call policy path uncertainty or PPU. There's typically 8 FOMC meetings in a year, so having H equals 12 corresponds to roughly a year and a half forward. But intuitively, what PPU measures is uncertainty that financial markets face about the expected policy path during this intermeeting period. So frequent or large revisions in expectations lead to spikes in this measure, and we argue that that maps into uncertainty about the expected policy path. So here I'm showing for you the time series of our PPU measure over our sample, which is from 1991 to 2025. And the first thing that we notice is that it behaves as we would hope for it to. So it spikes during periods in which we think that there's this elevated monetary policy uncertainty. In particular, it spikes during major macroeconomic disruptions such as 9/11, COVID, or the global financial crisis. But it also spikes in periods where the economic outlook was fairly stable, but there's a lot of uncertainty about the Fed's reaction function, such as in the tightening of 1994 or the Russian debt crisis. So PPU is helpful in that it tells us when uncertainty spikes, but it doesn't tell us why. It alone cannot identify the source that's driving this uncertainty, which leads to our next questions of how can we distinguish the different sources of policy path uncertainty, and do different sources have different macroeconomic and financial market consequences? So our approach here is to use a Bayesian structural vector autoregression. Our variables are going to be industrial production, core inflation, the expected policy rate 8 meetings ahead, this financial uncertainty index from Gerardo, Levickton, and Young, and then our PPU measure. And again, our sample is 1991 to 2025, which corresponds to 278 FOMC cycles. The challenge here with ordering is it's not immediately clear how you should order these variables. There's no strong economic reasoning, for instance, for why you would want to order financial uncertainty before PPU or PPU before financial uncertainty, as both of these variables can respond to the same shock at the same time. So then we can think about sign restrictions. And sign restrictions indeed get us closer, but as we'll see later on, it leaves many observationally equivalent decompositions. So our solution here is to use both sign restrictions and narrative restrictions for identification, following some other papers in the literature. And what this gets us is it allows historical episodes to become identifying information. So it's going to use these well-known episodes to reduce the set of admissible decompositions, and that helps us get closer identification. So let me go over both of the sign restrictions and the narrative restrictions. So the first sign restriction is common to both the MU and the NPRU shock. Both of these variables lead to an immediate spike in our policy path uncertainty measure. But there's differences between the MU and the NPRU sign restrictions overall. For the MU shock, we're considering this to be like your typical demand-like shock, which means that industrial production will fall, inflation falls, and this financial uncertainty will increase. The NPRU shock is quite different. We also have it decreasing industrial production. However, we leave unrestricted the response of financial uncertainty as well as the response of inflation. We don't want to pre-impose any sort of, let's say, stagflationary result to NPRU. Next, we get into our narrative restrictions. So we're going to have 5 narrative restrictions linked to well-known historical episodes. For the 1994 tightening and the 2022 tightening, we are going to say that the NPRU shock needs to be positive, and it also needs to be larger than the MU shock. So to be very clear, we're not saying that there can't also be macroeconomic uncertainty during these periods, or in fact, any other sort of shocks that are happening. We're just saying that the NPRU shock in these periods needs to be larger than the MU shock. And we think that this is reasonable. For instance, in the 1994 period, Greenspan himself mentioned we have created a degree of uncertainty after their February 1994 tightening. And recent work by Anna has demonstrated how after the Fed came out with this new 2022 monetary policy framework, there was elevated uncertainty about the Fed's reaction function in 2022. Then we have three narrative restrictions that are linked more to the macroeconomic uncertainty shocks. So for the global financial crisis, COVID, and Silicon Valley Bank period, we're going to have it so that the MU shock is positive. And for the global financial crisis and COVID, we're also going to say that the MU shock needs to be larger than the NPRU shock. So again, not saying that there can't also be uncertainty about the Fed's reaction function during these periods, just that the macroeconomic uncertainty shock is larger. And we think this is reasonable since these were two periods of very large spikes in unemployment and recession. Okay, so what do we get from this? Well, first I'm going to show you the response of PPU and FU on the first row to the MU shock, and the response of PPU and financial uncertainty to the NPRU shock. So, of course, both of these shocks increase policy path uncertainty, but the response of financial uncertainty is very different. So it leads to a spike in financial uncertainty for the MU shock that is persistent for a prolonged period of time. So indeed seems to be periods of elevated macroeconomic uncertainty. The response of the financial uncertainty to the NPRU shock, though, is negligible. Really, we don't see that uncertainty about the Fed's reaction function affecting, credit risk or, research and development or these other sorts of variables. Now looking at the response of industrial production, inflation, and the policy rate to both the MU shock on the top row and the NPRU shock on the bottom row, I think one of the more interesting results is the inflation result, which is the second column. So we find that in response to the MU shock, inflation falls and then gradually recovers. But I think what's really interesting is the response of inflation. So in response to an NPRU shock, inflation increases immediately to around 0.2 percentage points, and it remains elevated for roughly a year. And I should be clear here that the horizons are these intermeeting periods. So H equals 10 would refer to 10 intermeeting periods forward. We also find that the policy rate falls in response to the MU shock and rises in response to the NPRU shock. But then we're interested in, well, how do the MU and NPRU shocks, how do they propagate to financial markets? To explore this, we're going to use local projections, again at the intermeeting period frequency, with the following controls: the 3-month term spread, the 3-month T-bill, the term spread, and the AAA Treasury spread. And one thing that's kind of neat here is that asset prices were not used in the identification. So they were completely separate from estimating the shocks themselves. So this provides a nice external test of how different sources of policy path uncertainty propagate through financial markets. So we first look at cumulative excess returns. And we find that both of these uncertainty shocks reduce equity prices. They fall by roughly 2.5 percentage points or percent. Then we look at nominal yields. And what we find is that in response to an MU shock, 10-year yields decrease by around 20 to 30 basis points. So what this suggests is that this is a period in which equities fall and bonds increase. And so this correlation is negative. So this is indicative of periods in which treasuries can hedge the risks of stocks. On the other hand, in response to the NPRU shock, the 10-year nominal yields increase by roughly 10 basis points. So this would be suggestive evidence that these are periods in which treasuries can amplify the risks of stocks, since both equities and bonds are moving in the same direction. But to really try to dig at this a little bit further and the mechanisms behind this, we look at real yields. And we're specifically going to look at the 10-year tips. And we find different responses here in response to MU and NPRU shocks. So in response to the MU shock, the 10-year TIPS yield decreases by around 15 basis points. The way we interpret this is that anticipated easing helps to compress real term premia. On the other hand, in response to this NPRU shock, there's this immediate increase in the TIPS yield, and it rises around 10 basis points. So we interpret this as investors really facing this two-sided risk, whether the Fed continues to hike or lets inflation run rampant. Either way, investors are going to demand higher returns for holding this risk. So there are three main takeaways with this paper. First, we argue that policy path uncertainty is not a single object. Different sources can drive this uncertainty. And we say that the source of uncertainty can be identified. So we have a market-based framework that distinguishes macroeconomic uncertainty from monetary policy response uncertainty. And what this helps us to understand is that the source matters. It determines how policy path uncertainty propagates through the economy and financial markets. So thank you so much, and looking forward to the discussion and your comments.
And Anna Chieslak will discuss.
Thanks a lot for inviting me to discuss this paper. The paper asks the right question at the right time. If the market is uncertain, is it about the economy or the Fed, and does it matter? And it tries to answer this question by first measuring the policy path uncertainty. And here the uncertainty is really realized volatility of interest rates. This measure is then decomposed into macro uncertainty, I will call it MU, and reaction function uncertainty, what I will abbreviate as RU, with structural VAR and sign restrictions. Importantly, some of the responses are not going to be constrained. And the output of this decomposition is then taken to make some estimates of impulse responses on macro and asset prices. Now, what do the authors find? The effects of the MU shock, essentially by construction, are like a demand shock. Importantly, though, the RU shock becomes like a stagflationary shock. And here something to highlight is that these effects are really big. In variance decomposition sense, RU shock has a really significant effects. Then the MU shock, again, propagates as we would expect from a demand shock on asset prices, stock bond movement, making bonds essentially hedges, but the RU shock makes them risky. Okay. So what I will try to think about in the discussion is two questions about the identified RU shock. First, the extent to which this is a reaction function object, and second, whether it captures uncertainty. And I will go about this in 3 steps. I will provide some benchmarks to size the effects, essentially magnitudes. Then I will think about interpretation of the macro and asset price responses through the lens of a very simple model. And finally, think about recent evidence, the post-COVID episode, which seems like perfect to study reaction function uncertainty. So what is a 1 sigma RU shock? When you kind of look through the author's estimates, it is telling you that such a shock would move the policy path uncertainty by about 30 basis points, 1 standard deviation RU. So you can think about this in the following way. Imagine that the policy rate is just fixed. The first moment, the level is not moving around. And what this shock does is essentially to widen the cone. So that's the confidence band becomes broader. So that's the 13 basis points, 1 sigma shock. What the paper actually estimates is slightly different. It estimates that not only the cone widens, but also on impact, the level of the short rate goes up. The key point to take away from this is that this kind of shock has really large level effects on inflation, on output gap, on stocks and interest rates. So to think about some of the magnitudes, here's an overview of what people estimated in the literature using different methodologies. And when you want to compare the magnitude of these effects to the literature, it looks like 25 to 40 basis points hawkish policy surprise, compounded with some kind of cost push shock, given this positive inflation response that Courtney highlighted. So the insight to take away from this is these effects are big. They are very significant. And the distinction is clearly first order, I hope, in the minds of policymakers. They should be thinking about, well, what is exogenous uncertainty vis-a-vis what is the uncertainty that we ourselves create, and perhaps the latter is something that we can avoid. And we have a workforce working on it. Let's think about the separation of these two types of uncertainty in a super simple framework. Think about an output gap having some demand shock, inflation in deviation from some target. There are no cost push shocks here, and a policy rule. There is some traditional Taylor shock, but the important thing is that that parameter, the response coefficient, can move around. And now, where is the reaction function uncertainty? Well, this is stochastic, and pure reaction function uncertainty shock will be the shock to this zero mean V thing. Is going to be its volatility. So a reaction uncertainty shock moves the kind of the cone through that sigma V. It is essentially the extent to which we doubt what the Fed is doing. Now, when you solve this model for macro outcomes, so what does it do to the output gap? You will find that reaction function effects enter in two places. One is going to be the numerator. It is going to be like a traditional monetary policy shock, roughly. And notice that to the first order, we have certainty equivalence. Sigma V, which is what we are interested in, doesn't enter. It's just the level shock that enters. Where the sigma V does enter is through the denominator. Because of the nonlinearity here, sigma V will enter, that's the uncertainty, through some second order effects. And this will be the channel that will survive even in steady state. The implication for macro impulse responses, however, is that this kind of pure fanning out shock, the pure RU shock, will move output gap, inflation, etc., only at the second order. It's not a first order effect. So from the perspective of this setting, having these big impulse responses begs the question, how do you get that? Okay. Now, let's think about a classic monetary policy shock in this setting. So you could think about now the monetary policy shock being the compound effect of something traditional plus the reaction function. And similarly, here is the monetary policy uncertainty, which is the conditional volatility of the short rate. Now, there is some observational equivalence here where a reaction uncertainty model behaves as if you had fixed coefficients, but with a larger state-dependent variance. And what is important about that state dependence is that the state dependence is tied to the level of expected inflation. So the RU is going to move around here even if the pure uncertainty, the sigma V, is constant. It is just going to move around because expected inflation is moving around in deviation from the target. Of course, in steady state, when you put inflation at the target, the reaction function uncertainty is invisible at the first order. So let's do some simple asset pricing here. Let's assume that people really dislike negative output gaps, and let's price two simple assets related to the paper's empirics, stocks and bond. So stock is just one period consumption claim, bond is going to be the 2-period nominal bond, but notice that everything here is real. It's a real premium. So in this setting, what will happen is you have a two-factor structure in conditional risk premium. The macro uncertainty, MU, will appear because we have some exogenous demand shock. That is the kind of fundamental thing.
And reaction function uncertainty will also enter again in this scaled way. So the demand component, the exogenous demand shock, gives you this hedging premium. It will move stocks and bonds exactly in the opposite direction, just like the paper finds and essentially imposes in the identification. The second term will move stocks, bonds in the same direction through that kind of what we called in some of the composition with my co-author Hao Pang, common premium. Common premium because it moves stocks and bonds in the same direction. And again, even though reaction function uncertainty is second order for macro, it naturally emerges as a first order consideration for asset prices through this risk premium channel. Importantly, everything here is going to be state dependent. This channel is particularly large in situations where you are deviating from the target. It's very natural when you think about this classic Taylor rule. Coefficient moving around doesn't matter if you are at the target because you are multiplying it with 0. But as you are moving away from target, any uncertainty about the coefficients with which you are multiplying the gap will start to matter. So that's essentially what is impounded in these equations. Now, mapping this to the object that the paper is measuring the path uncertainty. So that's like conditional variance here. And the same elements start popping up in this equation as well. So we will have the demand component. It is alive even if there is no uncertainty about the Fed at all. And the reaction function component, this is the PPU proxy that Courtney showed, is going to move around, especially when you are deviating from the target. Now, stock conditional premia, bond conditional premia, and PPU, policy rate uncertainty, are all three different combinations of these objects, okay? So that would explain why in the impulse responses you find the particular shapes and particular directional effects of MU vis-a-vis the RU. And by the way, I am throughout abstracting at all from the cost push shocks, which would add some more terms to this, make things more complicated. So what does this simple setting imply for the paper's empirics? The macro IRFs, remember that in this simple world, the pure mean zero reaction uncertainty shock will move macro only through the second order effects. So when you find these large stagflationary responses, you start worrying that the identified RU shock is contaminated by some first moments. Where could these first moments come from? Where maybe there is some parameter learning, so the shock is really not mean zero. You're learning about drifting coefficients, or the Fed responds endogenously to inflation. Now, there is a second element to these macro IRFs being so large, is that issue of state dependence that I highlighted. RU only matters to the extent that you are away from the target, and the identified episodes where RU should be large are precisely those episodes, and Courtney highlighted 1994, 2022. These are precisely those episodes where you are expecting that the economy was away from the target. So the concern for identification is that those identified RU shocks likely pick up exactly those states when the gaps are large, and that would give you sort of the large impulse responses. Now, for risk premia, RU is a first order consideration. Stocks and bonds will move together with common premium, and that is very much consistent with the paper's results, which are sort of the outcome of the author's identification. What you get here, and I am glad that we had this first paper ahead of the Courtney's paper, the switch in stock bond correlation emerges here as a sort of bonus. Even if the uncertainty itself is fixed, this channel will be operating because you are moving closer or further out from the target. So when you are sort of far away from the target, stocks, bonds will be moving positively. This will be the dominant force. When you are closing the gap, getting close to the target, it's the hedging premium components, the second volatility factor that dominates, and this is how you switch sign. Now you could think about a moment in which you got close to the target that this happened, and 2000, late 1990s is exactly the moment when you would expect the switch to occur. Now, what about the state-dependent effects? Can we find some more evidence that actually something like in this simple model is happening in the data? So what I took here is the Kansas City Policy Rate Uncertainty Index, which is actually very highly correlated with PPU, but is pure uncertainty because it's from the option market. And so the model says this should sort of be related to expected inflation squared. So here is a fitted regression, and you see 1994 and 2022 being those periods where indeed the correlation or the spikes coincide. There is a strong positive relationship between these things. Again, highlighting that state dependence in RU conditional on the gaps in inflation and output. So this period is particularly interesting. This is the post-COVID period. And here you see the data essentially screaming that something like reaction function uncertainty might be going on. So I will think a little bit more about this. Now, recall that even in the simple model, the interest rate uncertainty, or PPU, stock bond premia, stock and bond risk premia, are different combinations of these two sort of objects related to reaction function and to exogenous demand uncertainty. So what I'm going to do here is to use a bunch of measures from the literature that try to pinpoint the interest rate uncertainty as the left-hand side, and I will project it on a pure decomposition based on co-movement between stocks and bonds, where we try to identify this hedging premium and common premium components in the data. And the model tells you that the common premium components should have unambiguous positive effect on the uncertainty in the short rate. And that is essentially what you uncover here. The hedging premium is actually ambiguous, and you don't see any significance. So I will close by sort of putting this in the context of recent events, where I actually think that question is particularly, and the results are particularly pertinent. So as you probably know, we had a new, now old, but a new policy framework in 2020, and that framework introduced a lot of novelty. Flexible average inflation targeting, employment shortage, this implied asymmetry. It was new, it was, we claim, poorly communicated. This is going to be fixed and in the next few months. What this would imply is that you are going to have a natural increase in sigma u because it's a new thing. We don't know how it works, and that it's communicated poorly. What happened in the economy at the same time created sort of a perfect storm conditions for reaction function uncertainty to play a role. So when you look at the output gap measures, they all started sort of going through the roof in early 2021 through 2022, mid 2022, which was like the pivot period. What this tells you is that in this specific period, output gap, inflation gap were positive. So what this should mean is that term premia will go up. And when you look at Fed's own measures, published measures of the term premium, exactly in this period where the gap is open and reaction function uncertainty is plausibly at work, you see a very significant run-up in term premia of the magnitude of about 150 basis points. Of course, you can say, well, many things happened here. How do you know it's reaction function uncertainty? We actually, in some work with Mike McMahon and Hal Pang, we zoomed in on this particular period where the Fed was really communicating vaguely. And what we estimated is that common premium component contributed about 1/3 of the run-up that actually occur in this period. Okay, but these were exact conditions in which you would expect this to happen, with sigma V being probably high and output inflation gaps being open. So I think this is an important question, an important insight that the paper delivers. The effects of uncertainty depend on its source, and we should all kind of retain that. 2 points on the identify RU shock is that for macro, the RU seems to be second order. So the large effects that the paper finds suggest bundling with some first moment effects and picking up that state dependence, which is directly related to inflation gaps. And U is certainly first order for asset prices, and it enters through this uncertainty times inflation state channel. So the bottom line is that to interpret these things, we need still a little bit more structure to separate the R and U components and then make causal statements about the pure uncertainty effects. Thank you.
Thank you for the discussion. So I'll take some questions.
So I'm not in your field. To people like me, the SBAR seems like art. So, but I remember when I read Wall Street commentary, they do talk about, like, I'm uncertain about Fed policy in this case. So it seems to me you should be able to use AI to go back and read all Wall Street commentary for the past few decades and use that to verify whatever you infer from your models.
Despite being a big believer in the power of the Fed, I wonder if maybe you believe a little bit too much in the Fed, in the sense that maybe there's one more state, which is inflation uncertainty, that has nothing to do with the Fed, and that would look maybe a little bit like your theory. So I'm wondering if you put some thoughts in measuring this separately from your policy response.
Nakamura Tyson recently emphasized that the Taylor rule kind of stopped being a good description of the Fed reaction more recently. I wonder whether you pick that up on spikes of your uncertainty measures. Another thing is that Anna emphasized this uncertainty about the slope of the reaction function. I wonder whether you think there's some different implications for uncertainty about the intercept, where let's say that captures the Fed measures of what the natural rate could be, and we're uncertain of what the Fed thinks is that the path of natural rate. So different types of uncertainty.
Yeah, very interesting, and I'm glad you're shining the light on this source of uncertainty. Now, if we think about a Fed reaction function, right? So if you think about I equals gamma times pi, let's ignore the residual for now. Uncertainty in I can come about because gamma is high and pi is uncertain, or it can come about because gamma is uncertain and maybe pi is not that uncertain. In the past 3 years, clearly inflation has been very uncertain. So, I mean, I think it's just useful to be a little bit, keep in mind that reaction functions are actually pretty hard to communicate, and I've tried, and in a Jackson Hole paper with Adi and Michael, we estimated how the perceived reaction function to inflation changed post-pandemic. It changed a lot. I think it's quite plausible that uncertainty rose at the same time, but how would you even distinguish between those two?
Can you answer those 4 questions and then move on to the next?
Yeah, sounds good. So for the first point with the using AI to maybe bolster some narrative evidence, I think that would be really interesting to do, particularly if we're interested in understanding how these daily changes are moving. If we can have more narrative evidence to understand why there is expected policy change at any particular day, I think that AI could potentially be very useful for that. On the points about inflation uncertainty and how much of this might be more about like inflation uncertainty versus like reaction function uncertainty, I think this is a really good and a really fair point. And I think it's something that we need to like tackle and grapple a little bit more with in the paper. One thing I will say is, so both of those narrative restrictions were like tightening, so 1994 and 2022. We've done some recent robustness checks looking at, for instance, including the Russian default crisis episode. That was an instance where inflation wasn't high, and the Fed also eased. But this would be another instance of like reaction function uncertainty. And then we've also done versions with dropping the narrative restrictions, and it doesn't seem highly dependent on including the narrative restrictions. It just helps us with the identification. But all that said, I think that this raises a really like fundamental important point. We need to dig in more.
Just one thing that I'll add to. One thing that I'll add to Courtney's point. So we're not saying that both cannot come up at the same time. So it's true, like over the past few years, there's been uncertainty about, like in 2022, for example, Anna's work shows, and there's uncertainty about how the Fed is going to react. But in our model, we allow also uncertainty about the macro economy to go up as well. So both are not, one does not mean that the other is not going to happen. So it's,
So, in the literature, there are quite some other uncertainty index like Baker Bloom Davis on general economic uncertainty. So I think it'd be useful to kind of further contrast with those kind of index. On the related note, I think Anna's suggestion on the state dependence is really crucial because what really is important here about the money policy response function uncertainty is that it's a level dependence on the inflation. So if you can kind of strongly show that, that would be very useful for us to confirm that is indeed policy uncertainty, reaction function uncertainty.
So maybe when you answer the question, you can go back to the original estimate that you had over time. But I'm kind of puzzled that there's not more of a decline in the 1990s, given there's a huge increase in Fed transparency and communication throughout the 1990s into the early 2000s. This is the beginning of forward guidance. The Fed, started releasing like detailed statements about why they're changing policy and what they're expecting to do at the next meeting or the next couple of meetings. And if I look, you almost have constant monetary policy uncertainty from 1990 to 2005. And it's really puzzling to me why there's not a decline.
Just wonder. So I wondered if I should think differentially about uncertainty about the timing of moves versus genuine uncertainty about the moves. So I guess your PPU measure is going to, if some news comes out and we start to think, actually, we know the Fed's going to cut by 50 between now and 1 year from now, but because of the news, we think it's more likely to be in the next meeting rather than 2 meetings from now. That's going to turn up with quite a lot of volatility, but I don't know if that matters as much as genuine uncertainty.
Can I just one tackling the question about like why there's no decline in uncertainty? I think we can remember, Alan Greenspan, he didn't want to be. There were statements, but there was not so much telegraphing about what was going to be done. Even markets, had to learn what was happening, just later over the period. So I think it's not that surprising that our measure is still high. But,
I have a 2006 paper in the JMCB, which goes over all of the increases in Fed transparency in the 1990s. And you do see it in like options markets. If you just look at implied volatility in options, you do see declines throughout the 1990s and early 2000s.
Yeah, so I think it's a good point we can think about further. And I do think that also is like relating to how this evolution of Fed communication has happened over time. Like you mentioned, like there's the introduction of statements in 1994, and then going back to the statements that were like very short, and then they've grown over time and had more forward guidance, particularly after the Great Recession. So maybe we can think more about how this evolving Fed communication may respond as well. To the point about like other uncertainty measures like Baker Bloom, it's a really good point. It was one of the buttons in the slide, but we do see how this uncertainty measure correlates with other uncertainty measures out there. And we don't find too strong of a correlation. The strongest correlation we find is with that Kansas City Fed uncertainty measure that's built with options. But it seems like we really are picking up like a new sort of measure of uncertainty. And then when it comes to like the timing of moves, so maybe it's you think that 50 basis points is going to happen, but you've switched it from maybe horizon 4 to horizon 8, let's say. I think this is really interesting. It's a place where we're digging in a little bit more in the paper is looking at these different horizons separately. We find that they really do sort of move together overall. So if we split between like horizons 1 through 4 and then 5 through 9 and up to 12, they all seem to track each other different or similarly, but there could be instances where a particular sort of expectation is changed in a one horizon versus another. So I think that would be interesting to look at further.
Well, regarding the state dependence, I think it's at least in my view, like the uncertainty about the response of monetary policy can be the determinant of the state of inflation. So I think both things can be related. So it can be that our measure is capturing the state and it's not like a different state. It's some exogenous variable causing the state.
By that, you mean like this pi bar is partly capturing the inflation target of the Fed? Or,
The uncertainty about it, so. But
I mean, uncertainty about it, but that it needs to be the inflation target?
yes.
All right, good. I think we're out of time, so thank you so much.
Thank you.
We have a 15-minute.
Gonna go to the paper. Like, I was like. No, oh, no, it's not quite that.
About the.
Like I said, going less. Yeah, 12 minutes, yeah, straight into questions. Yeah. Like this. Yeah.
All right, welcome back. We're going to have our lightning round now, which means 12 minutes for each paper, and we go straight into Q&A, so line up right away, and we have 8 minutes for Q&A. Okay, great. Take it away.
Okay. Thank you to the organizers for inviting us to present this paper, which is joint work with Andrendo Fatto. So let me start with a motivational example. In the first quarter of 2021, PJM and Amundi both released a 10-year equity return forecast of 5.8%. And at first hand, this might appear like these two institutions were agreeing on the underlying state of the economy. However, if we look at the return decompositions provided by these asset managers, we can see that this 5.8% is actually hiding a lot of heterogeneity. For example, if you look at the real growth component, PJIM actually assumed a 2.2% real growth component, whereas Amundi was actually had a 4.6% component. And so this raises a couple of questions. How much disagreement does the total return forecast actually conceal? What generates this disagreement, and does this matter for portfolio choice? And more broadly, this paper asks, what is the institutional belief formation framework for return expectations, volatilities, correlations, and correlation forecasts across assets and markets? So this slide summarizes the belief formation framework of our paper. So when it comes to first moment forecasts, asset managers have a common accounting language where they first decompose their return expectations into building blocks. And then they populate each of these building block numbers through quantitative assumptions on the data generating process. And then they process information through narratives, qualitative narratives. And finally, they revise their forecasts in an environment where consensus is available. We also find evidence of these building blocks across asset classes. And on the other hand, when we look at second moment forecasts, this seems to provide a more contrasting case where these forecasts seem to be more history-based with some qualitative, conservative, subjective adjustment on top. So our data, so we hand collect these capital market assumption reports from 83 institutions from 2028 to 2026. Now, the beauty of these reports is that they have the forecasts, so the mean, correlations, and volatilities, the building blocks, but they also have the text. And so we collect offers, assumptions, and narratives as well. We complement this data with classic market, standard market data with new sentiment data from Ravenpack, portfolio locations from Morningstar, shareholder letter outlooks from the SEC, and LinkedIn data to obtain education, years of experience, and job titles of the authors. So what do these reports look like? Well, on the right, you can see some of these tables, which are currently widely studied now, let's say, starting to get studied in this literature, of these return expectations. But what we notice is that these reports also have a lot of text, a lot of explanations behind these numbers. And so I'm going to come back to this, but we're also going to look and leverage this text data. So let me start with the heterogeneity in the return and correlate and second moment forecasts. So we're going to start from some very standard regressions in this literature, where we run these saturated fixed effects regressions, where we have the forecasts of returns, volatilities, or correlations on the left-hand side. And on the right-hand side, we're going to add a time fixed effect and an asset manager fixed effect. And we're going to do this for each asset class independently. And what are these plots showing you? Well, they're showing you the share of the variance explained by the asset manager fixed effects in blue, the time fixed effects in red, and in gray, we have the residuals. And so what do we see? Well, when we look at panel A, which is the return expectations, we can see that for both equities and fixed income, the blue areas are quite important, meaning that there's quite a lot of heterogeneity explained by simple asset manager fixed effects. When we look at panel B, when we look at the volatility forecast, again, this seems to be that the asset managers fixed effects explain quite a lot. So there's a lot of substantial heterogeneity in both the first and the second moments. Then we also find this across asset classes and for correlation forecasts. But where is this heterogeneity coming from? So in order to explain this, we are going to leverage these building blocks that these asset managers provide. So what do we know about these building blocks? Well, Douglas and Ebert have a paper where for US equities, they actually show that the asset managers have these building block decompositions. So on the left, we have an example for PJM for the first quarter of 2021, which was in my original example at the beginning. And then we also went through all of the reports, and we find that virtually all of the asset managers essentially mention these return decompositions of building blocks in their reports. What do we also know from the literature? We also know that valuation change is the main source of disagreement. And we also know that when we look at the subjective risk premia, they're countercyclical and they move closely with real-time benchmarks. So we're going to start by revisiting and by looking again at the disagreement in equity return expectations. So what drives the cross-sectional variation? So we're going to run regressions of return expectations on these individual building blocks provided by the asset managers with a time-fixed effect in order to study the cross-sectional variation in each year. So in panel A, this is for the US market. And first, we just study the simple covariant share of each building block. And in blue, consistent with the previous evidence in the literature, valuation change seems to be the main driver of this agreement. However, we also notice that when we look at these building blocks, they're not uncorrelated. They're actually quite strongly correlated. So for example, when we look at growth, it's strongly negatively correlated with valuation change. And so if we now repeat this share of variance decomposition, but we have a type 2 ANOVA contribution, meaning we look at each component and we fix the others in order to understand how important that is, and we look at the red bars, we actually see that growth is actually much more important than we previously thought. What about outside of the US? Well, we find that for outside of the US, actually growth is the main driver of disagreement across asset managers' return expectations. So the literature also find these return expectations are countercyclical. We also look into this and we find that valuation change expectations is exactly what drives this countercyclicality. But growth expectations are strongly procyclical, meaning that they dampen this countercyclicality. And we also find a lot of heterogeneity across asset managers. Does this heterogeneity matter? Well, what we do is we look at the allocations of these asset managers into equities. And first we look again at the exercise by Douglas Ebert by looking at how these expectations relate to the allocations to equities. And we confirm the result that is a positive pass-through. But then we also repeat the exercise. And instead of regressing on return expectations, we regress on dividend yield, nominal growth, and valuation change, the components. And what do we find? Well, dividend yield doesn't seem to matter. But nominal growth and valuation change, they're both very significant, with the caveat that the nominal growth component actually is twice as large as that of the valuation change. And so for us, this seems to suggest that nominal growth seems to be important in order to understand how asset managers allocate their equities. But where does this disagreement come from? So we're going to start from the quantitative assumptions that these asset managers rely on in order to explain their expectations. So what we do is we go through the text and we developed an LLM pipeline which looks at all of the assumptions that modeling assumptions that asset managers rely on in order to build their return expectations, and we cluster them into 7 groups. And then we ask whether the mentioning of these assumptions helps us explain why asset managers deviate from the consensus. And what we find is that managers who mention historical calibration, for example, they tend to be over-optimistic or more optimistic, and managers who mention mean reversion, they tend to be more pessimistic. So why do asset managers rely on differing assumptions? Well, we have some preliminary evidence that education seems to matter. So teams which have a higher concentration of PhDs, they tend to rely more on regressions and mean reversion, which then allows us to explain why they have different forecasts at the end. So asset managers also rely on narratives to process information. So as I mentioned, going back to this example, asset managers have these return expectation tables on the right-hand side. They have volatilities and correlations, but they also have the text which explains these numbers. And so we develop a novel LLM pipeline which identifies all of the causal sentences in these reports. And so in this example, the pipeline identifies the sentence in red, and the key part, which we report here, and the key part is the final part. As higher equity and real asset returns reflect modestly higher inflation expectations. So there's a causal agent, inflation, there's an affected agent, equity return, and there's a positive link between the two. So you can imagine that if you go through the whole document and collect all of these sentences, and we extract the agents and the cause, and then we connect all of the overlapping topic, we get a network of causal beliefs. And so what do we do with this? So we interpret this network of causal beliefs as a proxy of our belief formation framework. And then we're going to try and think of the framework characteristics. I'm going to try and proxy them with network theory measures. And there are 2 key characteristics we're interested in. One is attention. So you can think of it as the number of causal links which go into each topic. And second, the complexity, which is the depth and the interconnectedness of these causal networks. And what do we find? Well, in a nutshell, we find that networks which are more complex, they tend to react more negatively to positive earnings sentiment news. And higher attention to valuation change leads to more negative reaction to positive earnings sentiment news. You can think of it as some sort of underreaction. And higher attention to downturn and growth leads to more positive reaction to positive earnings sentiment news, meaning some sort of overreaction. So we validate the text of these capital market assumptions by comparing them with the text from institutional mutual fund investment outlook letters. And so what we do from the NCSR, from Edgar. So what we do, we take the capital market assumption text, we compare them with the mutual fund investment outlook letters from the same institutions, and then we compare them with the same text, but from different institutions. So here we're showing you the cumulative density function for the two distributions, and we find that the same manager distribution pair stochastically dominates the cross-manager pair, which we interpret as these capital market assumptions reflecting persistent institution-specific investment views. So we don't have time to talk about this deferred mechanism, which is the consensus, but we construct an ML benchmark and an ensemble benchmark, and which outperforms these capital market assumptions, and we use it to show that these expectations, they seem to anchor to the consensus, both the returns and the building blocks. But the last couple of minutes, let me try and talk a little bit about the second moments. So here, just to set the theme, we plotted the whisker plots of the equity volatility forecasts over time. And on the back, you can see the equally weighted moving average based on with different exponentially decaying functions. And in light blue, it's a simple historical average, the volatility constructed through a simple historical average. And what we saw is that there's quite a strong correlation between the median forecast of the distribution and a simple historical volatility forecast, which for us suggested that these forecasts seem to be history-based. So then we take this exercise a bit further. And what we did is we first read all of the assumptions in the capital market assumption reports for correlations and volatilities. And we find that 33% of these assumptions are history-based, pure history-based. 41% are history-based with a tweak, and 27% seem to have some econometric model. And so what we did here is we plotted on the y-axis the capital market assumption reports for forecast for volatility with the same plot for correlations. And on the x-axis, we have an equally weighted moving average fitted for each individual asset manager. And what we find is that there's a pretty strong relationship between what the asset managers say and a simple historical based estimate, which suggests that, again, to explain second moment forecasts, history-based explanations seem to bring us a long way. So let me conclude. This paper studies asset managers' belief formation framework for return expectations, volatility, and correlation forecasts. To fix ideas, let me go back to the original example. So PJM and Amundi in the first quarter of 2021, they had reported both 5.8% as their equity return forecast. But we also saw that this was hiding substantial heterogeneity. And where does it come from? Well, it turns out if you look at the manager's framework's characteristics, we can see that there's a lot of heterogeneity. For example, if you look at the composition of the teams, we actually see that PJM has a much higher concentration of PhDs than Amundi. If you look at the attention of the narratives, then we can see there's a lot of heterogeneity here as well. So for example, PJM has assigned a lot more attention to valuation change than Amundi. And if you look at the complexity of the networks, they're also statistically different. And we know from this work that if asset managers have different compositions of teams, they have different attentions, or they have different complexity, then they process information differently and have a heterogeneous forecast. We have evidence that there's also a mechanism which brings these asset managers together, which is anchored to the consensus. And finally, when we look at second moment forecasts, it seems that a history-based explanation gets us a long way. Thank you.
Okay, so we have 8 minutes for questions.
So since you have these building blocks for many assets, what I'm curious about is, can you find shared principal components? Essentially, I have forecasts for 20 different asset classes, but really inflation is driving most of what's happening. It makes this, I think it affects this market one way or this market the other way, or economic growth. I mean, that seems like a useful element of having the breakdown of these elements is you can see, is there just one building block that shows up in many of these, and actually it can simplify all these different forecasts by really saying these two different companies or CMAs, they really just disagree about blank economic growth, and then everything else kind of falls out from that.
So very cool paper. On the volatility forecasts, We have some other results on the prior paper in which we do something similar, but then we add some forward-looking measures, and they help explain those volatility forecasts beyond the historical one. So I just want to highlight that there's both components there, right? There's the historical thing that they lean on, and there's like some forward-looking adjustments. And I really like the fact that you compute the exact fraction for which, you know, they use all of those three. I think that's pretty nice.
So in a lot of our models, we think about with learning and model uncertainty, do we have a model, a parameter or two that we're uncertain about and we sort of learn about? An alternative view is we are in an incredibly data-rich environment with a lot of parameters to learn about, and we're all very uncertain, and we can analyze the same data and come up with different forecasts and views. But then we're looking at a very simple traded asset space here, where you can strip apart the different components and actually trade them against each other. And so I'm kind of curious. I mean, one is they could just be taking dramatically different positions, not just in equities, but in the subcomponents. And if not, why aren't they? It's kind of the next question for us, because they should bet against each other. And so in the sense of in the space of traded assets, ultimately come to some more greater level of agreement. And so I'm just kind of curious whether the positions are dramatically affected that way, or whether these are just stories they come up with for allocating sort of for what they're doing, or even almost ex post. But
Okay, why don't you answer those, because we only have 5 minutes.
Yes. So on the building blocks, it's I agree. So we have collected data also for fixed income, and there are also other asset classes. Usually each asset class has its own story in the sense that they have their own building blocks. What we could try and see is how much overlap there is between these different building blocks, which we haven't done, but I think would be very interesting. I think our view is that these building blocks seem to be how these asset managers think about when in the text they really talk about these building blocks. So that's our starting premise. But I agree that something to look into further is what's the principal component across all the building blocks across all asset classes would be extremely interesting to do. On the volatilities, yes. So our starting point was to, without even doing any analysis, was to just read these assumptions. And I think it's the starting point is, okay, how much can we actually explain just with volatilities? That's why if we look at the bottom right, I think there's also a qualitative component, and I agree with that. But I think there's a very important history-based component, and a lot of them actually are purely based on history. So I think the first fact is they are history-based quite strongly so. And even those asset managers who actually rely on something which is forward-looking, an equally weighted moving average forecast gets a long way. I'm not saying that's the only thing, but that seems to be a very, very important part, and probably the most important part for now. And then there's some subtleties which I agree could be important later on or downstream. And on the learning, I agree. So I think our stance on that is when we look at the allocations here, we know that there's a positive pass-through when we look at the return expectation, but then there's a sensitivity to the nominal growth and to the valuation change components are different. So two asset managers can have the same return expectation, but then actually, if they have different views on nominal growth and valuation change, they might allocate their capital differently. So we actually think that this agreement that you see within the total number actually is quite important because it's actually a fundamentally different view of the world. Going back to the original example, these two asset managers have the same headline, but actually they have quite a lot of heterogeneity in what's going on underneath. So we actually think that what's going underneath is almost as important as the headline return to understand how investors allocate their money. So I'm totally on board that I think they have different stories, and these stories then are viewable downstream when you look at their allocations. Yes. So I think they have and the narratives is what they also suggest. They have the very different narratives and very different stories, which allows them to get to these numbers.
And can you just, in 10 seconds answer, do you check whether which of these types are more accurate?
So we haven't. So what we haven't done exactly which asset manager is more accurate, but what we have done is just looked and we constructed an ML benchmark and an ensemble benchmark of different. We put together a bunch of very simple forecasts, and they seem to do better than an asset manager. Now, it doesn't mean that they're not good. It just means that there's room for improvement. That's the way we see it. And that also explains why we see these overreactions or underreaction to news, why we see this anchoring procedure, because there are a lot of things going on in this industry. But we haven't looked into that, and that would be super interesting to do.
Thank you. Moving right on to the next paper.
Thanks so much for including the paper in the program. Since we have 12 minutes, let's get directly to it. So what is the paper in a nutshell? We have been talking about this a little bit during this one, but basically literature has found the institutional expected returns seem to be reasonable. What do I mean by that? If you look at the equity expected returns, for example, of those institutions and compare it to the excess cape yield, for example, they are very connected, so they are pro-cyclical. And you see a strong positive risk-return trade-off in the subject beliefs of these institutions, both across asset classes as well as over time. But when you run those type of regressions of portfolio allocations on beliefs, the pass-through is actually relatively weak. It's better than for retail investors, but it's relatively weak. What do I mean by that? If you were to take like a Merton model and you were to try to get what is the implied risk aversion, it's very high to justify that. So what we're going to do in this paper is try to shed light on that issue from the perspective of pension funds. And let me start with some quotes. So CalPERS here tells us that they care about expected returns, but they also care about risk. So we have to consider that. They tell us where they obtain those. I don't have to tell you what capital market assumptions are at this point. And they also tell us that, sure, we look at all of that, but we're also uncertain about those. So we have to consider this information friction. And they also tell us we benchmark ourselves against a reference portfolio. So we have to consider that. So when we want to understand the pass-through, we have to consider those things. That's what this paper is going to do. So this paper is going to look at the allocations of pension funds and connect to the CMAs. Now, we won't observe directly the CMAs of pension funds. We observe the CMAs of their consultants. So that's what we're going to connect. Now, why consultants? If you go read the reports of pension funds, oftentimes that is what they use. This one is from OPERS, the Ohio State Pension Fund. They are telling you that they use the consultant, their consultant pension CMAs. What we look at 6 asset classes: cash, fixed income, public equity, private equity, real estate, and hedge funds. We find that portfolio allocation is strongly linked to beliefs. When I say beliefs, I just don't mean only expected returns. I mean the covariance matrix as well. But that's only after you incorporate frictions, informational and institutional frictions. Before, you see very little connection. In fact, after you incorporate frictions, that's going to explain a large chunk of the variation in their allocations. So that's the core of this paper. So let me get to it then. So first, data, very quickly. We use a standard data source for pension funds. The key here is that we're also going to look at the consultants of those pension funds. So one example here would be CalPERS that we measure in June 2022, and we see that the consultant at that time is Wilshire. So we take a different data set that we have used, the same data set that we used to show the plots in the beginning of this talk. Those are is a data set of the CMAs, and we have CMAs of 45 institutions. 22 of those are consultants. And as Federico mentioned, they have expected returns, volatilities, and correlations. One example of that would be Wilshire in 2021. So what do? We take the pension fund allocations in June 2022, we match the Wilshire allocation, which is the consultant of CalPERS, and we do this systematically. To have 15 consultants that match between those two, that captures about 30% of all the consultant years in the entire pension industry in the US, the public pension industry. But that's more than 50% of the pension years. And the reason is we have all the largest consultants. Okay, so that's the essence. So what do we do with this? We go there and we measure the allocations of each pension fund, and we aggregate to the consultant level because the beliefs are the consultant level. And we measure the mean variance efficient allocation implied from the belief of the consultants. And we're going to relate the two. Okay, so let's just show you very quickly how we build this. Standard mean variance, we all use to it. All we do is we add no short sales and no leverage, and we add a benchmark incentive. So not only they have mean variance, but they have a benchmark incentive. The solution of that is fairly standard, is our weighted average between the usual mean variance allocation with some Lagrange multipliers for the constraints and the benchmark weights themselves. Now in the paper, we microfound those benchmark incentives in 2 potential ways. We show that actually don't need to actually care about benchmark incentives per se. You can just be a regular mean variance investor, but if you're uncertain about expected returns and use a Black-Litterman type of approach, you behave as if you have this benchmark incentive. That's one way to get it. The other way would be you may directly care about the benchmark. You may have some tracking error constraint. In both cases, you will get the same effect. And the B here is going to capture how much do you lean on the benchmark. Okay, so in the empirical analysis, for most part, we use a 60-40 benchmark. That's the simplest thing we have, just to make sure that we're using the simplest. But we have some analysis that use more sophisticated benchmarks as well. Okay, results. So what I'm showing you here is the box plot for the true weights that pension funds have against the box plot for the unconstrained mean variance efficient weights that they have under a risk aversion of 3 and no benchmarking incentive. Clearly, if you have thought investments, you are very used to the idea that weights can go crazy once you input those. That's why we are seeing those box plots. They don't look anything alike, right? Now, you start adding constraints, and then the distributions start looking more alike, similar to each other. But there's actually some big mismatches. It's hard to see because of the scale of the y-axis. So I'll zoom in to the y-axis so that you can see a little bit better. So once you zoom in, you can compare the actual weights to the mean variance implied weights, and you see that they allocate more to fixed income and public equities than the beliefs imply, and less to the alternatives than the beliefs imply. Then you have to add the benchmark incentive. Once you add the benchmark incentive, those things align much better. So the overall distributions look a little bit more sensible, right? And then you can, of all of this that I did so far, I have used a risk aversion of 3, a pretty sensible risk aversion, but you can try to estimate the risk aversion as well using typical regressions of expected returns on covariances. And we do that for each consultant year to have heterogeneous risk aversion, and you get a distribution that looks somewhat similar to what they have. Okay, but it's just about distributions. What about the direct connection between those? So that's the next step. So what do? We're going to regress the allocations that they actually have on the mean variance implied allocations. Okay? And you're going to have fixed effects to allow us to focus on different sources of variation across asset classes, across pension funds, or over time. Now, when you do this regression using unconstrained mean variance efficient weights, the slopes are low, right? So they're very small slopes. The pass-through doesn't seem that strong, right? Now, they are statistically significant in some dimensions. 1R square is decent, 17%, but still, the pass-through look a bit weak. Then you add constraints, and those slopes increase, right? The benchmark here would be 1. So you add constraints, the slopes increase. But still, we don't quite get there. There's some, the R square specifically, they're not super high yet. You add the benchmark incentive, then the slopes increase further, the R squares get much stronger, and you start seeing the pass-through really happening, getting closer to the type of benchmark you would expect. And you can add the heterogeneity and risk aversion, and you get a little bit further away. So basically, the key idea here is that, yes, there is a pass-through, but it's very weak. And once you incorporate 2 very sensible frictions, constraints and benchmarking, you go a long way in understanding some of this. Now, of course, the right-hand side here has multiple belief elements. So it's interesting to understand what is the belief element that is driving the omega star here, the mean variance implied allocation. So what are we going to do is we're going to decompose the variation that omega star into the different components that compose it. And I should mention, the benchmark only varies across asset classes, 60-40, but not across institutions or over time. And in our regressions on asset classes, we are controlling for the benchmark. So everything that you see here is purely the effect of beliefs, not the benchmark. Okay, so then you can decompose the beliefs, as I told you. Taking the omega star, you can use a Shapley decomposition for those omega star to tell us how much comes from mu, how much comes from sigma, how much comes from correlations, and from risk aversion. And then you can, of course, go and try to understand the source of variation. And the key insight that you get from that is that a lot of the variation in the omega star comes from mu, but correlations and variances matter a lot. In fact, if you look at variation across pension funds or over time, the joint importance of variances and correlations is actually higher than the importance of mu. So it's quite important to account for that if you want to understand the pass-through of portfolio allocations to beliefs. Okay, so our interpretation of this is that beliefs, they affect pension fund allocations. There's 2 ways in which this can happen. One way, consultants may actually affect the beliefs or the allocations of the pension funds directly. That may happen, right? There's maybe a causal effect there. But there can also be that pension funds, they select the consultants that share a similar belief formation process. You know, this is the consultant that I sort of like sympathize with because we have similar views of the world. We are fine with either of those interpretations. The key that in either of those interpretations, beliefs are affecting allocations. But there are, however, some interpretations that we want to rule out. And those would be the reverse causality interpretations. There's two potential reverse causality interpretations. So let me go over those. One, maybe what consultants do is that they change their beliefs, their CMAs, so that they justify whatever desired allocation pension funds have that make no, that not connected to beliefs at all. That's possible. Now, we find that unlikely because, as it turns out, consultants only create one set of CMAs, not multiple ones. And so all their clients are receiving the same CMAs, and pension funds are only a relatively small fraction of what they have. However, you can actually test this, at least indirectly. If it was the case that the CMAs were just reflecting whatever distorted incentives pension funds have, they should not be unbiased forecasts of future returns. So what we show is that they turn out that to be unbiased forecast of future returns. Okay, so you can transform the long-term expected into a 1 year, and then you can regress future 1 year returns on those expected returns aggregated across CMAs. And this results from our prior work. So when you see that all here includes both consultants and asset managers, and the coefficient's relatively close to 1. You cannot statistically distinguish from 1. It's highly significant. There is non-trivial out of sample R squared. This is a 1 year horizon forecast. And if you look at only consultants, you get a similar result. So in other words, because they're unbiased forecasts, it's just not that they're just the reflection of whatever incentives pension funds have. There's a second potential reverse causal interpretation, which is, hey, funds may select new consultants to justify the desired allocation every period, right? Like every time or every period or at least once in a while, like in a dynamic way. So that in that case, it's not really that I'm selecting the consultant that shares my belief formation process. I'm just selecting each point, whoever would work for me best in terms of justifying my distorted allocations. Again, it's unlikely because there are preset contracts, and we only observe about 6.2% switches in the data set. It's very rare that they switch consultants, but you can also reject. There is an implication of that. The implication is when you switch, the link is going to be very strong. And as time goes by, the link gets much weaker because you're not switching, so that selection effect disappears. We don't see that. If anything, we see the opposite. The effect gets a bit stronger, which seems more connected to relationship effects. Okay, so of course, I knew I have 12 minutes. We have a bunch of other results that I didn't get to. Let me just point out that the set of results that I'm showing you are the most conservative ones. There are many things that we do in the paper to show that the results are even stronger than that. And also we consider belief wedges between pension funds and their consultants. And they're going to kick me out, so I'm not going to show you all those results. So let me just conclude. Prior to this paper, we knew that the beliefs of institutions were sensible, but that allocations did not respond that well to the expected returns. In this paper, we linked the pension fund allocations to the CMAs, and we argue they are actually linked. And you have to consider both expected returns and covariance matrices, but only after you account for frictions. Frictions are extremely important. When I say friction, I'm including both informational frictions, think of uncertainty, as well as institutional frictions, think of selecting a portfolio. It explains a large share, and I didn't get to show you, but the allocation wedges are still economically important. It's not like that this explains everything. So going forward, I think this highlights the importance to study beliefs and frictions jointly, right? So that's really the key point of this paper. If you want to understand one, you have to include the other. Thank you.
Questions? 8 minutes lineup, and yeah, we can.
So my experience is that the consultant does many things for these funds, and CMAs are like a small part. Indeed, just to use, let's say, Wilshire for CalPERS, CalPERS got like a scorecard of many different CMAs. So my suggestion is to actually look at the disagreement amongst the CMAs to see if those periods are the periods of greatest deviation.
So The way I read what you're saying is that, take the beliefs and then add constraints and make them adhere to the benchmark. So there are shadow costs associated with those constraints. And could you give us some intuition for how big those shadow costs are? If you were to relax the constraints, if you were to relax the benchmarking, would these funds have performed better?
So for some of these asset classes like private equity or real estate, if it's physical rather than just a REIT, it may be difficult to actually trade this and shift it quickly. So here we were looking at how the weights relate contemporaneously to the W star. I'd be curious if that gap predicts their future portfolio. So if they're really off from what would be implied by their portfolio, can you predict that they're gonna start raising their private equity share? They're gonna start buying real estate going forward?
So you mentioned two potential interpretations of why we see this shrinkage. One is sort of constraints, one is model uncertainty. I was just wondering if there's anything in the data you can use to try to distinguish between the two. I mean, my prior, having looked at forecasting returns, is that model uncertainty is super important. And so people are shrinking towards some kind of prior. But it seems like you see disagreement, things like that. And so is there anything you can do to kind of speak to which of those is more likely or even what they say?
So in the US, there is an issue with underfunding for many of these funds, and you have the data there for looking at the actuarial underfunding. I'd be very curious to see to what extent they deviate from all these frictions that you have in the MBE as a function of what their actuaries tell them the underfunding is, especially when it comes to what they allocate to private equity. Thanks.
Carolyn, brief.
Very cool data. I was just wondering, some of these frictions should be more pronounced for the alternative investments, which have been a really big chunk of pension funds over the past few years. Can you tell us something about the split of stocks, bonds as more liquid classic assets versus the ones where you need to have a lot of in-house infrastructure?
Okay, there's a lot. So first, let me just say, Ken, absolutely, there is disagreement. That's a great idea. So we can look at the disagreement and understand how that connects. Ken, on the shadow costs, let's see if I have enough time, but I can show you the distribution. So these are the Lagrange multipliers translated to units of expected returns. And what you see is that if you do not include, basically, the key insight is the following. Short sale constraints actually don't have big shadow costs. For most of the distribution, they are zero everywhere. But leverage constraint have a big shadow cost. So that is the one that's binding most often in the data set. So future allocations and times, that's absolutely true. It's not only the case for alternative asset classes. It's also the case for public to some extent. Part of the reason, and I didn't have time to explain this, but we use the target allocations that the pension fund have to avoid market movements to affect this. But you can also look at the actual allocations they have. And if you do that, you get stronger effects. And that's particularly over time. So that speaks to sort of like what you were mentioning. Larry, we have been thinking a lot about that. Personally, I think uncertainty is the core driver. It turns out that they are isomorphic to some extent on how the model works. There is one thing in which they differ, which is the B coefficient, how much you lean towards the benchmark. That in the uncertainty case, it depends on the prior precision. And versus the other ones, the Lagrange multiplier. So what we can do is impose that the B equals the Lagrange multiplier and see whether whether you get similar results. So if we don't, that would suggest that the institutional friction is not really what's driving, it's the uncertainty friction. But to test directly the uncertainty friction, we would need some knowledge of the uncertainty in both the estimate they have as well as the prior, and that's a bit harder to get to. Stavros, underfunding, we actually have done that a little bit. So we took the allocation wedges that basically, what is the actual allocate, what is the implied by the beliefs. We took those wedges and regressed on a bunch of variables. Those are endogenous regressions, but some of those variables are variables associated with the underfunding of the pension funds. And yes, they help explain why funds deviate from that. I forgot, sorry, Caroline had a question as well.
Oh, yeah, so.
Alternatives, yes.
Yeah,
Thank you.
got that. So when we look at the allocation wedges, what we can do is disaggregate the data. At the moment, we have aggregated the result we showed. We aggregate all of the allocation rate as we level of the consultants. The consultant is consulting for 20 pension funds. We can disaggregate the allocation wedges and then regress them on pension fund characteristics. And what we see is the biggest predictor of investing less in alternatives, especially private equity and hedge funds, relative to what the CMAs would suggest, is the size of the fund, is the size of the pension fund. The smallest ones, despite having consultants and the expectations that are strongly suggested they should invest in private equity, they invest way less, sometimes nothing, the smallest ones. Talking to practitioners, there are two explanations. One is they're small, they're going to have to make concentrated bets on specific funds, which adds additional credit risk. The other one, they know that some of the best pension funds and hedge funds that are in demand are not going to hit their money, their checks are too small. And so given that, it is reasonable they're going to adjust downwards the expectation of what they could get and should invest less.
14 seconds.
I think that, yeah, thanks so much for
Thank you.
the comments.
Yeah. Great. Okay. Okay, amazing. Okay, great. Thank you everyone for having us. This is joint work with my co-authors Antoine Didesheim, Brian Kelly, and Han-Xing Tian. So as the title suggests, this is about market efficiency. So a market efficiency specifically about financial news. So typically prior work finds that markets do a reasonably good job when it comes to pricing financial news. So this news gets incorporated into prices within a couple of days, and the effects are overall modest, in line with your typical anomaly. However, what these prior research have neglected is the fact that, well, this news that we're looking at is not all particularly new. A lot of it has overlap with traditional financial characteristics that we've been studying over the past 50 years in asset pricing. So this news mixes some stuff that is genuinely new with some stuff that is already incorporated into prices, and so it might bias some of the conjectures that we had for market efficiency. So what do we do in this paper? We isolate the pure news. This reveals an unusually strong return predictor that dwarfs the past 50 years of asset pricing anomalies. This predictor is, in addition, particularly long-lived, and we can link it to both under and overreaction. So what we try to answer in this paper is what is new in news and how and why do markets react to it. So let's go to the data. We use Reuters News. It's not a particularly fancy text source. It's something that hedge funds and market participants typically use. And so there's nothing special about this data that we're using. We need a way to take this unstructured data that we see in the text and we turn it into numbers. So how do we do this? We take the unstructured data, the text for the firms, we pass it through an LLM. So what does the LLM do? The LLM parses the text and it has an internal numerical representation that can summarize the semantic and contextual information in that text. So in other words, this is how the LLM thinks about the potential news article. So at each month T and stock I, we have a fixed vector that corresponds to characteristics that are associated with that particular news article. So think about traditional stock characteristics. So for stock I and month T, we have book to market and so on. This is just characteristics pertaining to that stock's news. Okay, so then the next question is, what is new in news? So again, we don't do anything fancy. So each month, T, fixed T, we have news articles, news embeddings for many different stocks in the cross-section. We regress this matrix on a bunch of standard asset pricing characteristics that we take from Jensen Kelly Patterson and some industry indicators. So naturally, this decomposes the raw news into two components, the predictable news and the pure news. Why does this make sense? Think about it in terms of industry. I think that's the clearest example. So a tech firm is going to have very tech-specific language
You're going to have hardware and RAMs and GPUs, especially in this AI era where everyone wants to buy them all the time. And for example, younger firms are going to be talking more about their growth trajectories and what their plans are and so on. So it makes sense for this data, these firm characteristics, to explain the news that we read on a day-to-day basis. So on average, these characteristics explain about 10% of the variation in these raw embeddings. Okay, the next step is to build portfolios. How do we do this? There are many, many potential characteristics, there's 4,000 of them, that are related to news, right? So we can't just do a long, short portfolio. So what do? For each of those characteristics that correspond to the text, we build a single characteristic managed portfolio. So there's 4,000 of them. So for each of them, we build one characteristic managed portfolio. So past characteristic times future return. And so there's 4,000 of them. We need a way to aggregate them. We aggregate the efficiency with just mean variance optimization. And so for the previous slide, this decomposition, we have 3 components. So we end up with 3 portfolios, one for the raw news, one for the predicted news, and one for the pure news. So first, look at the green line. The green line is the performance of the raw news, this f of star of E. And so this performance roughly gives you a Sharpe ratio around 1. This is a Sharpe ratio for like your typical run-of-the-mill anomaly. And when we go to the second component, which is the predictive news, this f star of E conditional on E, you see that these purple bars, they're all kind of close to 0. And so what this means is that if you actually include them in your analysis, in your green bar, it's going to basically bias the results to thinking that the market is actually much more efficient than it actually is. But once you remove the purple stuff, you end up with the pink. These are Sharpe ratios that exceed 3. It's quite remarkable, really. And so what we see is that one data set, news text, has more return predictive content than the entirety of the anomaly zoo combined. So the natural question that you may ask is like, well, is this just small liquid stocks? So we repeat this analysis with liquid stocks that are above the 50th percentile of the NYSE market cap. So what do we see? We see the Sharpe ratio obviously goes down. The performance goes down. These are more liquid stocks. These are stocks where people pay more attention to, right? It makes sense for them to be more efficiently priced. But if we repeat that same analysis for the typical anomaly, those returns, they also compress. And that relative outperformance, it's there. It stays the same. So another question which we think is very important to answer is how quickly does this anomaly decay? Because prior research, so Brian has a paper with Dashang, very similar analysis. So they take embeddings, they predict future returns, and what they find is that this predictive component, this predictive content, it gets into prices relatively quickly in a couple of days. But when you go to the pure news, you see something completely different. You see that looking at the pure news, it takes quite a bit of time for the market to figure this stuff out, about like 18 months. And when you compare this analysis to your standard factor on the right side, you see that the standard factor after 12 months, it's practically gone. And so not only is this an unusually large effect, it's also a very persistent and long-lived effect. So what about turnover? What about transaction costs? Does this explain the phenomena? Because you are trading on news innovation, not just news, but changes in the news. So what we find is that indeed the transaction cost, the turnover is quite large. It's quite substantial. However, even if you adjust for transaction cost, the predictive content in this predictor is still quite larger than your typical anomaly. And because I said in the previous slide that this is a persistent phenomena, if you smooth it over past 6 months, you can get much more net performance. So transaction cost is not the answer to this particular phenomena. So we do a bunch more robustness in the paper. For the sake of time, I won't go into them in great detail. I will spend a bit of time on the first one, which is a very important kind of criticism of using any kind of LLM-based kind of analysis in asset pricing, which is look-ahead bias. So we do a bunch of different analyses. The main one I'm going to highlight is we look at a point-in-time model from Manila and co-authors, and we look at that same point-in-time model, but that rather than looking at the point-in-time version, we use all the data. So this is the same LLM, but it has look-ahead bias, and we find that they practically perform the same. So we've established until this point that this is an unusually strong empirical pattern. However, the coolest part is not just the fact that there's performance and whatever, but it's the fact that this is driven solely by text. This is a completely textual phenomena, so it can help us potentially underpin and gain insight into what is happening in market misreaction, into market efficiency, and what are the potential drivers. So this is what we try to do in the second part of the paper.
So we tried to build interpretable embeddings using sparse autoencoders. This broadly is on prior work that I have with my frequent co-authors Han-Ching Tian, Antoine Didisheim, along with Hui Chen and Luciano Smoza. So what we do is think of the embedding as a beam of light. It's very dense. It mixes together many different topics, and so it's very hard to interpret. So what do you do with a beam of light to gain insight in what's going on? You pass it through a prism, and it breaks it up into different particles. Each of those particles are now a distinct color. So in the analogy of, so just getting back to what's happening in the LLM space, these are much larger, sparser, interpretable embeddings that each coordinate now corresponds to a particular topic. So for example, if the news is talking about oil, there is a coordinate associated with oil that's going to light up. Okay? And so using this analysis, we select and we find that 148 topics do a pretty good job at explaining the news phenomena that we see. And they fit really neatly into these different categories. So I mentioned 4 of them. The rest are in the paper: earnings and financial results, corporate guidance and outlook, distress, bankruptcy and delisting, corporate actions and restructuring. Okay. So the next part of the analysis thinks about over and under reaction, which is very natural given that this is a paper about misreaction. So what do we do? For each of those topics, for each of our topics, we look at how the price responds today versus what happens over the next month. So if the price continues to go up, we call that an underreaction. If it reverts, it's called an overreaction. This corresponds to a rho K of positive, rho K of negative, etc. Okay. We find that the majority of the news topics are associated with underreaction, and we also try to explain them. We try to explain these over-under reaction coefficients just with news text. So no return content used in these regressions. And what we find is text that is more negative, that is more quantitative, is associated with underreaction, and text that is more ambiguous and attention-driven, high attention, is associated with overreaction. This mirrors nicely with past behavioral literature by Tetlock and Hong and co-authors and so on, and it kind of matches our results quite nicely as well. So to wrap up, what have I done in this talk is I told you that there's a lot of overlap between what we see in the news and traditional firm characteristics. And that has been biasing our analyses in the past on market efficiency as it pertains to financial news. Once you strip that predictability away, once you go to the pure news, you see an effect that is unusually large, unusually persistent, and much larger than your typical anomaly. So and in addition, this pure news phenomena it's a very rich phenomena. It's driven by text. And so this gives us the opportunity to study these effects in much more greater detail. And right now, the analysis we have in the paper is just the tip of the iceberg. It's just scratching the surface. And I think there's much, much more work to be done. So to summarize, figure out what is new in news, then study how and why markets react to it. Thank you very much for your time.
Line up for questions, please.
Can you relate your news to sort of other news that has been studied in asset pricing? I'm thinking about, for example, earnings news, or Fed funds, monetary policy, macro announcements, and things like that. So what part is the orthogonal piece that you identify, and which one is sort of the news that we have studied before?
Could you talk about where the pure news is really coming from? So in my mind, I would think that an LLM in its embedding space could kind of pick out important parts of the news. So when you residualize it, is it a sort of distraction effect where when the news is including stale information, the embedding vector shifts towards the stale information rather than focusing on the new news, if that's a possible mechanism for this?
So this is a clarifying question. As I understand, you form these portfolios based on individual coordinates of your embedding vector, but your procedure doesn't tell you the sign with which you should trade. So that must be data-driven. And so what I wonder if, as a placebo, you feed just random words, just kind of noise, how much of the performance would stay, how much would go away? Just to understand that part of your process, how much that contributes.
So I'm just trying to reconcile the emphasis on purging the predictable part of news from the idea that you can smooth over these innovations and they're strongly predictable far out. I mean, the unpurged news is just the sum of all the innovations. So once we smooth the innovations, it feels like we're just back to the original variable. And in general, if the innovations can predict far out into the future, then the current news should also be quite powerful for predicting far out, because you're saying even the things that were known in the past still have a lot of power. So I'm trying to square those two in my head.
So I originally looked at the paper, I thought it was on daily data, but it's monthly. And I'm wondering if you subset the news to the news near the end of the month, that's more news than stuff that's 30 days old.
Should I start? Okay. So, I have a very short memory, so I'll just start from the end while I remember. So basically, on the question of the more recent news, so we take a conservative approach. So we push any news that is available within the month to the end of the month, and then we use it the next month. So there's at least like 30 days of gap between the news that we use for the analysis and the news that comes out, basically. So I don't think there is, so I think if you were to use the news within the same month, obviously you would get a much stronger result. So going on to the question about purging news, that is a very good question. So I think the econometrics is a bit more subtle, and it would take a whole new paper to kind of discuss it. But the idea is more in relation to unpriced risk. So because this is overlap with industries, this overlap with industries explains a great deal of the variation in the portfolios, while it does very little job explaining the mean returns. So it's not just an innovation in a time series way where it's just new information per se. It's more about new information that overlaps with stock returns. That's what the market understands well, and that's what's not priced. So that's why we make a stance of not calling it a shock. In the original version of the paper, we tried to call it a shock, and then we thought about it more carefully. But like this is much more subtle than your typical time series innovation. So on the placebo on random words, so the tricky thing, so you would need to have this placebo at the firm stock level. I'm not sure how that would work out. I would love to chat more about that. I'm very curious. So we would love to have more robustness in the paper. So on the topic of the announcements and other types of macro news, so we actually have a follow-up paper that we're currently working on, which tries to understand if this procedure also applies on other data sets. And we find that, at least on the early analysis that we conducted, this is very different sources of predictability. Like, it's not just what we see in typical asset pricing, it's something completely orthogonal to some extent. There's very low correlation with the typical announcements and so on that we see, at least in this analysis, we've orthogonalized it with respect to earning calls to some extent. So at least I'm pretty sure that there's nothing really to earnings calls in this analysis, but overall, we're trying to extend this to other sources of data and so on. What was your question? Distraction effects and.
So like if, when you residualize the news like this,
yeah,
on the original embeddings that the LLM produces, that embeddings vector, is it being shifted towards the stale news or the stuff that you're purging out?
Yeah.
Originally, do you think that that's going to continue in time, or are LLMs going to get good enough where they're going to kind of realize the salience of the pure news and get rid of the
I see. So this goes back to my answer to like what is actually happening with the econometrics. I think because this is driven by industry and because it's driven by just semantic similarities between the text within industry, I don't think it'll go away.
Can you elaborate a little bit more on why you aren't looking at like the time series, like news?
Oh, we've tried looking at the time series.
Exactly. I was wondering what the issues were.
This previous plot kind of gives you an idea of why it might not be a great idea, right? We know that past embeddings also have large predictive power for future returns. So if you were to use a past embedding to get a shock, then you could be basically killing all the predictive power that you have in these past lags. So we need something that is sort of tangential to the news itself as a sort of orthogonalizing variable.
Right. I guess it's just like the motivation was about market efficiency and pricing of the information. So still, it's interesting that like the predictable part of news is still moving prices. Like that's kind of a puzzle then. Right?
Yes, to some extent, like why is it so long-lived? Yeah.
This is more a comment, but maybe you can quickly tell how you think about it. So in your interpretation, if I understand these correlations, whether, the drift versus momentum essentially, that's not necessarily something you would have been able to predict in real time, right? Those are all ex post in sample correlations.
No, this is fully out of sample.
I'm talking about the interpretation at the end.
Oh, the interpretation at the end is fully in sample.
The-
Yes,
The
yes.
momentum, you call it over and under reaction.
Yes, yes.
It's more of a minor point, but it seems to me that's not over and under reaction necessarily. That's drift and momentum. It would only be over or under reaction if people in real time could have predicted the drift or momentum. That you, like, there's a time t subscript missing in the correlation.
So we fix a particular news source. And so this is per topic. And per topic, these coefficients are relatively stable through time. But overall, we don't really take a stance on whether or not this could be implemented in real time or thought about in real time. But overall, there isn't really a time t subscript because this is at the topic level. So there's like many topics, and for each of those topics, we have a portfolio. And for each of those portfolio, there's an over and under reaction. Those coefficients are relatively stable through time. So I'm sorry, we had to go through this stuff very quickly. So more details in the paper.
You can make a comment, but I don't think he has time to answer. So
Okay, I just want to reiterate.
discuss over lunch.
How do you decide on the sign of when loan or
Oh,
short?
so this is, we do an MVO. So the MVO is what designs the sign. So we do basically a standard mean variance optimization, maximum Sharpe ratio regression. So we're just using past returns of these series to indicate what the signs should be.
Very good. Thank you.
Thank you very much.
everyone. We'll break for lunch.
What happened? You told me, yeah, you are. You're still listening us. Now. You're listing yourself already. The problem is not, it's gonna take them. Exactly. Then you're gonna tell my stations. So.
All right, we're really excited to get started with the afternoon session. And that is going to start with a market-based cost of capital. Take it away.
Thanks a lot. And thanks a lot to the organizers for putting our paper on the program. We've been working on this for a long time, and so we're super excited to get people's feedback. Okay, so one common definition of the cost of capital is that it's equal to the expected long-run return on a firm's assets. And so this is a vital input for researchers when they're discounting cash flows, and perhaps especially for firms and investors when they're making investment and capital allocation decisions. The challenge, however, is that the cost of capital is unobserved, and we don't have great ways to estimate it from the academic literature. So standard models like the CAPM are really not a good predictor of returns at any horizon. Newer models like factor models and machine learning models are great predictors at returns at short horizons, but they don't really work for these long horizons that are necessary for many capital budgeting decisions. And so what we do in this paper is to provide a new method that estimates long-run expected returns in an out-of-sample way that firms can use to estimate the cost of capital in real time. Our method starts by predicting cash flows and then infer expected returns from the present value relationship and observable market prices. So we operationalize this idea in a global sample where we predict firm level cash flows using a machine learning model. And the outcome here is an out of sample estimate of long run expected returns at the firm level that we call the market-based cost of equity. Now, the market-based cost of equity is a strong predictor of long-run stock returns. It is unbiased in a forecasting sense, meaning that whenever we say the cost of equity is 10%, then on average, the realized return of that stock is 10% over the next 10 years. It is better than the alternatives we consider in the sense that it has a lower out-of-sample mean squared error. And so we think of this as the current state of the art if you want to predict long-run stock level returns. We also take this and use it to create a market-based cost of capital for the entire firm. And here we show that firms whose perceived cost of capital is closer to the market-based ones have higher market values. Okay, and so we contribute to the literature on return expectations by providing an unbiased benchmark for firm-level long-run returns. We contribute to the literature on long-run stock returns by showing a methodology that gives you out-of-sample predictability even at a 10-year horizon. Finally, we contribute to the literature on finance in practice by providing an unbiased cost of capital that firms can use and evidence that using it is associated with higher market values. Okay, so that was the overview. Now I'm going to go into the details, starting with the methodology. And so before we look at any data, we want to think a bit about different ways of forecasting long-run returns. Okay, so I'm going to consider a one-period model where expected returns and expected cash flows are driven by the same case state variables, but where the loadings on those state variables may differ. Then I'm going to consider two approaches for estimating expected returns. Okay. The standard approach is what we call the ER approach, where you just forecast returns directly as a function of the state variable. The other approach, the one that we're emphasizing here, is the cash flow approach, where you first forecast cash flows and then back out expected returns from observable prices and the present value relationship. Now, the important assumption we're going to make is that asset pricing dynamics vary over time, so that these loadings and the expected return regression vary over time, whereas the cash flow dynamics are constant. Okay, and there's ample reason to suspect that this is true. We're used to thinking about stable cash flows and varying discount rates. For example, say the value premium, right, was very high in, say, the 80s. It's probably a bit lower today. So think of this assumption as stable cash flows and volatile discount rates. Under this assumption, we can show that there's a mean squared error gain of using the cash flow method over the ER method that is equal to the number of state variables k times the unconditional variance of these expected return loadings. So this is telling you that there's a predictability gain to using this indirect cash flow method over the ER method under our assumptions. So the caveat here, of course, is that that may not hold over short horizon, right? We need a long horizon such that there's a high correlation between realized cash flows and realized returns. And with the caveat that you could potentially model this time varying loading, but of course that's difficult to do in practice. And ultimately it's an empirical question whether this works. But this is suggestive of the indirect approach being theoretically preferable. Okay, so we estimate a model for future cash flows that takes around 400 firm characteristics as an input, and then forecast the cash flow using a machine learning model known as light GBM. So light GBM is a gradient boosted decision tree ensemble, and we use it to predict cash flows at year t+1, t+2, up until year t+10 for the first 10 years. We estimate and test the model on a sample of data from 93 different countries. And because our US sample is a bit longer, we start the outer sample period there in 1984, whereas we start the outer sample period outside of the US in 1996. And we re-estimate the parameters of this model every year. Now that gives us explicit cash flow forecast for the first 10 years, but we also need an assumption about what happens to cash flows beyond year 10. So here we're going to assume that they grow at a constant rate of G, and G is both country and time specific and equal to the forward real GDP growth forecast that we get from the IMF. Okay? So think of this number as like a steady state growth rate. It's very stable in practice. And for the US, it's something like 2% with minor variation. We then take observable market prices and solve for the implied cost of equity in between a lower bound of this long-term growth rate and an upper bound of 10%. In practice, the lower bound is what bites by far the most often, but we kind of need that for the equation to be sensible. One thing I forgot to mention here is that we make a forecast for two different cash flow variables, so for net income and for free cash flows to equity, and we adjust both for inflation, so we're forecasting real cash flows. Okay, we do this separately for our net income forecast and for our free cash flow to equity forecast. And then the thing we call the market-based cost of equity is a simple average of these two. Okay? So think of the market-based cost of equity as the discount rate, which is consistent with our machine learning cash flow forecast and the current market price. Okay, so now I'm going to show that the market-based cost of equity forecasts these very long-run stock returns. And I'm going to start with this picture, which I think is quite striking. Okay? So what we do each month is that we take the global sample and then we sort stocks into 100 portfolio based on their market-based cost of equity. That gives you the X coordinate. Then the Y coordinate is the average realized return over the next 10 years for those same stocks. Now what you see is that both the points and the line lie very close, and it's not statistically different from this dash 45-degree line, which would be equal to perfect correspondence between the cost of equity today and the realized return over the next 10 years. Okay. I want to emphasize that this is like a striking level of predictability that you rarely see for for like individual stocks at such a long horizon, right? It literally means that if we say the cost of equity is 10% today, then on average it's almost exactly 10% over the next 10 years. We can do this a bit more formally by taking a regression of 10-year realized return on the current market-based cost of equity. In panel A, I have month fixed effects, and you see that both within the US, outside of the US, and in the combined global sample, the parameter estimate is very close to and not significantly different from that one that you need for this to be perfect correspondence. Now in panel B, we say, what happens if you just take this cost of equity at face value so you don't try to estimate any parameters? And what you see is that the average error is a bit positive, meaning that in our sample, realized returns were slightly higher than what's implied by the market-based cost of equity. But at least outside of the US, that number is not significantly different from zero. Okay. Then we have some out-of-sample R-squared metrics, which just shows you that there's predictability in an out-of-sample sense here. Okay. So this is our main evidence that the market-based cost of equity is a strong and unbiased predictor of long-run stock returns. Now we also want to compare it to some alternatives. And the first alternative we consider is what we call the MLR method. So here we take exactly the same machine learning model, exactly the same predictors, but instead of predicting cash flows, we predict 10-year realized returns directly. Okay, and so that's the empirical counterpart of this ER approach that we discussed in our theory. We also consider the so-called implied cost of capital measures, which comes primarily from the accounting literature, and they take exactly the same valuation logic as we do, and in fact, we were heavily inspired by them. But instead of having machine learning forecasts of cash flows, they use analyst forecasts of cash flows. Now, what I show you here in the first line is exactly the same regression as before, and the takeaway here is that only our method has an estimate close to 1. Everything else is significantly below 1. But of course, what matters is the out-of-sample R-squared, and here in the second line, you see that the out-of-sample R-squared of our method is always below the out-of-sample R-squared, mean squared error of the alternatives. So this is the main evidence we have for our method being the current state of the art, at least amongst the alternatives we've considered here. Next, we want to think about why is it our method works better than the alternatives. And we think the reason why our method beats this MLR model is because it's more stable. Okay? So what I'm showing you here is a histogram of correlations from the output of models that are estimated in different years. Okay? So those correlations are quite high for the market-based cost of equity, which means that if you take a model that was estimated on data up until, say, 1990, and compare that output to a model that was estimated with data up until 2023, then those outputs would be quite similar. Okay, so it's a stable model over time. By contrast, this direct machine learning model, this MLR model, has much less stability over time, and so these two models would differ quite heavily. And our theory shows that that may be one reason why the market-based cost of equity, this indirect approach, does better than the direct approach. Now, the reason why we're better than these ICC measures is simply because we have better cash flow forecasts. Okay, so I'm showing you this by taking the out-of-sample R-squared for our net income forecast for all the 10 forecasting horizons, and I'm showing you our forecast, 2 of the ICC implied forecasts, and a random walk method. And here, we see that our method has a positive and high out-of-sample R-squared across all horizons, but the analyst-based ones are good at like a 1 or 2 year horizons, but they have a negative out-of-sample R-squared at these longer horizons. Okay, so I've talked a lot about predictability, and now I want to focus more on the economics of like what is actually going on here. So the first thing we do is to look at whether the market-based cost of capital aligns with proxies for risk or mispricing. So we take 3 proxies for risk, such as analyst risk ratings, and 3 proxies for mispricing, such as earnings announcement returns, and then we regress them on the market-based cost of equity. Now, what you find is a consistent story across all these proxies. The market-based cost of equity is consistently negatively related to risk and positively related to mispricing. So this is more consistent with a story where a high market-based cost of equity is driven by undervaluation instead of risk. much of this has been focused on the equity component, but we also use it to create a market-based cost of capital for the entire firm. Okay. And so we do that by using the weighted average cost of capital formula. We have the cost of equity. We create a market-based cost of debt by taking bond yields for firms with traded bonds and adjusting them for expected default losses. And then we do leverage and marginal tax rate in a standard way. Now we use this to test standard capital budgeting theory, which says that firms maximize their market value by using a cost of capital that aligns with expected returns. Okay, this is true in rational models, it's true in irrational models. If you want to maximize your market value today, you should use something that aligns with expected returns. Now, in reality, it seems like firms are using something very different from that, and we have this data on the actual cost of capital they use. And so the prediction that we want to test is that firms that use a cost of capital closer to our market-based one should have higher market values. And the intuition is that if you use too low of a cost of capital, then you'll overinvest. And if you use too high of a cost of capital, then you'll underinvest. So what I'm showing you here is evident consistent with that standard theory. Okay, so it's a bin scatter plot, and on the x-axis, I have the difference between the cost of capital that firms are actually using and the market-based one. And on the y-axis, I have the log equity market value controlling for book equity and time fixed effects. Okay. So what you see is this inverted U relationship where the market value is maximized when the gap or the deviation is 0. And this is, of course, not causal, right? But it is consistent with this interpretation that if you use too high of a cost of capital, then you'll underinvest, you'll fail to take positive NPV projects. If you use too low of a cost of capital, then you'll overinvest and you'll invest in negative NPV projects. And so this suggests that firms can do better by using our market-based cost of capital. Now, this evidence is somewhat high level, it's somewhat indirect. So we also do something at a more granular level to really emphasize this point. And so what we do is that we take big new investment announcements and then we look at how the stock market reacts around those investment announcements as a function of the deviation, the gap between the actual cost of capital and the market-based one. Now, the prediction here is that if you've historically used too high of a cost of capital, then you have historically underinvested. And once the market sees that you make a new investment, that's a positive signal and you should have positive stock returns. Okay. And so that is exactly what we see here, right? We see it if we just use a dummy for a too high of a cost of capital, and we see if we just use the difference. Okay, so this is micro evidence, which is consistent with this inverted U relationship, and it's consistent with our measure being something that firms should consider using in practice. Okay. And so let me conclude. We propose a new method to calculate expected returns and the firm's cost of capital that we call the market-based cost of capital. We show that it's theoretically preferable and it works well in practice. And so now that we have this thing, I mean, firms can use it for capital budgeting decision, investors can use it for long run investment decision, and researchers could use it if they need a non-biased expected return estimate, or if they need to use the cost of capital. Right? A nice bonus is that our method also produces unbiased estimates of expected cash flows. And so we're going to share this data and the cost of capital data soon. And if anyone is interested, we hope you will reach out. Okay, so thank you and looking forward to the discussion.
Thank you, Thies. The discussant is David Tesmar.
All right. Thank you very much for giving me the chance to discuss this paper by the wonderful Gormson, Huber, and Jensen. It was very interesting thinking about it. Before I go into the paper, let me give you a little bit of the context. So there's a silent revolution against normative corporate finance that's taking place. So the recommendation we will make in our textbooks is to discount future expected cash flows with CAPM. And I don't think it's a secret in this room that the CAPM does not really work. And that's a big deal because actually when we teach people this stuff, they actually use it. So most firms, like large and small firms, use the CAPM. And so there's been over the years, it's not recent, but there's over the years, there's been efforts to understand and improve on potential discounting methods. Okay. So first, there's a whole tradition, there's a very noble tradition, starting to my knowledge, but maybe earlier with Jeremy's paper in the mid-90s, saying, even though the CAPM is not right, it's in the data doesn't, it's still the right thing to use. Okay. So it's a whole theological, construct that I will not go into. In a recent paper with Olivier Dessin and the gang, what we showed is that acquirers that acquire low beta targets tend to be penalized upon announcement more, hinting at the idea that maybe, since firms are using the CAPM to value the target and it's a low beta, then they're overpaying because the security market is flatter than what predicted by the CAPM. And then this other paper that Thais mentioned, that we have done with Nicolas and Augustin, where we, to value firm A, we look at comparable firm B, we compute the internal rate of return, a slightly different one than the one that you see, but similar, compute the internal rate of return of the comparable firm and use this to discount the cash flow of firm A, and we find that it lines up with market prices much better than any sort of factor model. Then there's also the other paper, the recent paper by a subset of the authors, where they find that the self-reported cost of capital from the earnings call transcripts actually line up with the CAPM reasonably well, but do not predict returns. So that's a situation. And that's probably what led to this paper that we're seeing today, which essentially says, I'm taking the IRR of a firm and I can show that the IRR of a firm can predict its long-term returns. Okay, so that's what the paper does. So I'm gonna summarize the paper in a little bit more detail, and then I'm gonna suggest that the authors sort of take the model a bit further than they currently are, and there's more to do, and it points to some minor contradictions that are not really lethal, but that are, that can be thought about, at least that would be food for thought. And then I'm gonna spend a little bit of time also trying to reconcile the idea that you can predict long-term returns, while it seems so hard to predict long-term returns. Okay? And there's an apparent contradiction here that is not there, in fact. I'm gonna explain why I don't think it's there, and why you should believe the results. And then I'm concluding. Okay, so start with the present value formula. You discount future cash flows with future expected return, and of course you need to compute the long-term expected returns. So this return at horizon K, at all horizons. And what again, when I step into the classroom and I teach my students, what I tell them to do is to use a flat term structure. I use the model that sort of predicts returns 1 year forward using some kind of, typically it's the CAPM, so it's going to be only one risk premium and one beta. It can be more. So what the starting point of the authors is to say, oh, but lambda and beta vary all the time. The factor structure of the market is a fleeting concept. It varies all the time. And of course, if I'm looking 10 years ahead, I don't know what will price the cross-section of stocks in 10 years from now. And so it's going to be super hard given current characteristics or, factors and exposures to those factors, factor prices and exposure to those factors. It's going to be very hard to predict long-term return. Okay, so that's not going to work well. And so what the authors propose instead is to say, okay, let's use instead let's invert the present value formula that's up there, okay, and compute something that contains all those very long-term expected returns that is supposed to contain them, okay. And so what they find is that it does actually predict returns, and it explains firm variation. You remember the hump-shaped graph, etc. And the intuition that Thais has spent some time discussing is that To compute the IRR, what I need to predict is future cash flows, and predicting cash flows is easier than predicting returns. There's much more noise in what shapes returns than in what shapes future cash flows. Now, there's another reason why I think this works, is that the present value formula is a restriction that adds value, that has predictive value. So like that's the formula I showed before. So this is the internal rate of return. This XT is, you know, what you project future cash flows on. Okay, so that's the model you're using to predict future cash flows. And you use P, so you use these XTs that you project future cash flows on and the price. And it turns out when you have some kind of horse race between the internal rate of return computed this way, so by projecting cash flows on X, it's much easier to predict future. It has a much bigger explanatory power than just lumping together X and 1 over P. Okay, so you try a machine learning, the same XGBoost, you put a lot of X's, a lot of 1 over P, interact them. It doesn't work as well as using the IRR. And so this, I think, comes from the fact that the present value formula adds predicting value. Okay, so what is the present value formula? It's essentially the fact that there is no bubble. Okay, and the fact that there is no bubble must be in the cross-section of stocks working reasonably well. That's pretty good. Actually, there's not that many economic theories that probably add a predictive value to over a statistical model. I don't know how much of a theory that is, but it is a restriction at least. And that's maybe something that the authors could highlight more specifically. Okay, so now let's discuss the model a little bit. Okay. So if you write down the model, it turns out actually if you look at very long-term returns, and that's probably something many of you thought about when you saw the equations, the IRR should not predict very long-term returns. Because in the very long run, you know, if everything is stationary, you don't know what are long-term returns. Okay, so let me write it up like more formally. That's almost exactly the author's models. Okay, so you have, you know, 1 year ahead returns that are driven by betas on a factor whose premium is not varying over time, just to simplify. That's, I think, the model that they have actually. And then betas are kind of mean reverting towards 1 with some kind of M persistence. That's close to 1, probably. I don't quite know. It's complicated, the literature, apparently. I leave it to asset pricers to sort this out. But let's say it's less than 1, okay? So that has to go. And so, so you do the algebra, okay? You plug it back into the discount rate in the linearized, in the Campbell-Schiller DCF, and then you obtain that the expected long-term return RT plus K at horizon K is equal to the very long-term return, which is this K, I mean, average beta over the long run are 1, so it's really the risk premium plus RF. And then times some plus a coefficient times the internal rate of return. So it's exactly the regression they're running. They're regressing future returns on the IRR. Okay? And they have this BK here. And as you can see, this BK like goes to 0, you know, because in the very long run, again, you can't predict returns because betas converge towards 1. So now what I did is that on the left-hand side, I plotted the BK in this model here. Okay, so the regression coefficient you should get in those simulated data. And it goes from whatever, 6, it doesn't really matter what it is initially, but it goes to 0 very quickly. So that's, here that's in months, okay, 120 months, 10 years. And you see that it goes to 0 after 60 months, more or less, you should have a BK that is close to 0. Okay, so at 6 years horizon, you should not be able to predict returns. That's not what you have in the data. In the data, you go all the way to 120 months. The BK here, that's for the global sample. It doesn't go to 0. It stays, I mean, it's fairly flat, actually. I mean, it's a bit of an artifact of how the graph is presented, but it's quite flat, actually. So it doesn't go to 0. So it means this model is wrong. And then, you know, it would be nice to actually try to think about what kind of what would be the right model. Another thing is that the paper sort of removes everything that's time series related, and I think that's interesting We know that the equity risk premium is predictable. It's kind of a long tradition. And it's actually even the equity risk premium is actually predicted even by investors. So it's not something that people don't know, which means that depending on, I mean, it's a whole can of worms I'm opening here, but actually you could say maybe the cost of capital should be lower when valuations are high, simply because expected returns are lower. So maybe firms should invest more when valuations are high. It's the Tobin skew model in a sense. So so to write this down, you can do it too. You just assume it's not canonical here, but let's assume that risk premia are mean reverting the same way as beta was, and now you set the beta to constant. So now you have two equations. So the first one is that the internal rate of return here is a linear function of the risk premium. So that's not surprising at all here, I guess. When risk premia are high, the IRR should be high. When risk premia are low, risk premia, and that's actually the case in the appendix table, whatever, 125. You show that this varies quite a bit. And I think it's interesting, and you're killing that variation in your regressions. Because when you run the regression here, so here in this model, you get the same regression specification here. So that's what the model predicts. So that's exactly the same equation, in fact. Future returns are correlated with current internal rate of return with a regression coefficient BK, the same coefficient as before. But now the average IRR, varies over time. And if you put in time fixed effects, you're going to kill this. Okay? So it depends on whether you want to think about it or not. I mean, so far you've decided to focus on the cross-section, but I feel the time series part is interesting too. Because it has valuation implications, like even in how we teach how people to do the DCF, we tell them to use 6% as the equity risk premium, but maybe that's not the right way to go. It raises a lot of questions, so but I think, I mean, at least I would want to see more about the time series of long-term returns and their effect on valuation. Maybe it's a different paper, actually, because you've got to convince people that this is the right way to do valuation. Okay, so now how to reconcile the fact that they claim to be able to predict returns, they do actually, long-term returns, and the fact that it's supposedly so hard to predict returns. And so first, a good reason why I believe that the results are correct is that they replicate in my own data. So that makes me happy. So we also build those IRRs to compute the IRR of a comparable. You first need to compute the IRR. It's different from yours because it's not the equity, it's not the market cost of equity. We directly get the WACC because we're interested in predicting the enterprise value of firms and not just the equity value, but otherwise. So it's a bit like a WACC in a sense, and we use fewer XT. We are much less fancy than you are in terms of predicting cash flows, etc. Yet, when we look at long-term returns and our internal rate of return, there's a positive correlation that's pretty high. It's not perfect, but I mean, it's not exactly the same thing. But I was happy to see that in a completely independent, situation, we find the same result. So it's there, and so now the question is, okay, but I haven't yet reconciled it with the intuition that it's so hard to predict returns, even in the short run. So not mentioning the long run. And in fact, actually, the answer is in this figure here, which used to be figure A8, I think, if it's the A8. Okay, so what does this figure show you? On the left-hand side, let's focus on the left panel. On the left panel, what you have is you compute the excess return of long-short portfolios sorted on the IRR. What they call the MCE, market cost of equity. I'm saying IRR, but it's MCE. They call it. So it's the long-short portfolio, and so the blue line is what they have is the excess return of this long-short portfolio. So that's again killing the time series variation. It's really just the cross-section. 1 year, 2 years, 3 years, up to 10 years out. And as you can see, the blue line doesn't decline very fast. The black line, which is not their paper, but it's the Kelo-Arju paper, where you project just future returns and characteristics, that declines faster. Okay, so that's kind of what the point the paper makes. Okay. However, so that's sort of, the alphas of the blue line sort of decay, but they decay more slowly than the Kelo-Arju paper, and they stabilize above 0. So that's sort of that's your result. But of course, beyond year 7 or beyond year 6, etc., The T-stat of the blue line, which is the right panel, actually goes below 0, below 2, sorry, not below 0, below 2. Okay, so it becomes quite imprecise, those forecasts. Okay, and that's a T-stat, so it's still significant, but at very long horizon, the T-stat is, close to 1.5. Okay, so it's fairly noisy. Still have a coefficient of 1, so that's very informative. But, it's not something you can trade on, so it can survive, I mean, you divide by square root of whatever, 40 years of data or whatnot, that's kind of, it's something that is not easy it's not easy to trade. So that's why it survives. I think that's not a bug. I think that's a feature. It makes it believable, That's why it's kind of something we believe. So that's good. Long-term return predictability is not magical, but it's an excellent predictor of future return. So it makes it a good candidate for a cost of capital. So to conclude, let me say it's a great paper. I would encourage the authors to use the theory, to push the theoretical framework more. It's not hard, and maybe to use it quantitatively, maybe tweak it to make it more lining up with the data, or at least highlight the differences. Also study the time series, I think, is interesting beyond the cross section. So now I'm convinced that indeed IRRs are a great way to compute discount rates because they predict long-term returns, sort of in an unbiased way with a coefficient of nearly 1. So that's unbiased. It's noisy, but unbiased. Maybe in terms of valuation, actually, taking this noise into account might be something interesting to do, to have like confidence bands on valuation. I mean, maybe that's possible. I've never thought about doing this in detail. It's just coming up right now. And also that sort of indicates our approach to say that, you can compute the IRR of comparables to price a given firm, and that sort of lines up well. And I think that's really good. It's really good evidence. Of course, it will not reconcile us with the CAPM, okay? The IRR is not correlated at all with the beta. So this is here on the x-axis, the beta of firms. This is my data, but I suspect your data gives you the same result. The IRR is completely uncorrelated with the equity beta. Okay, there's no correlation whatsoever. So that means, there's more research needed to sort of improve the methods for corporate valuation. That's it. Thank you very much.
Feel free to come up for questions.
Very intriguing paper. Just a quick reminder that the required rate of return on capital is not just equal to the risk-free rate plus an equity premium. It's equal to the risk-free rate, an equity premium, and a depreciation rate. If I understood correctly, what you're doing here to get at a tail valuation after you're done with the 10 years of the forecast, you're assuming that the free cash flows grow at the rate of GDP. In most models that we write in macro, cash flows grow at the rate of GDP minus the depreciation rate of capital. Because an investment in a unit of capital is not something that grows with GDP, it depreciates as a fraction of GDP with time. So I could see how you could be getting these results that you're getting if, say, that tail doesn't matter, and if your forecast of the future cash flow rates builds in the depreciation estimate, which would be one explanation for what's going on. But then I don't see how that could be a very good predictor of return if there is big heterogeneity in the depreciation rates across all these different firms, which I suspect is the case. So that's point number one. I would like you to comment a little bit on how you think about heterogeneous depreciation rates, which will go into those estimates. The second thing I wanted to ask you is, if in your exercise, you did the following horse race, look at the market-based cost of capital you get, and do a horse race in this big cross-section that you have in this amazing bin scatter that you were showing, where in that horse race, you also just throw like the long-term rate on a bond. Because I'm thinking that you're looking at different countries, different interest rate regimes, so there would be a level effect, which would just be reflected in long-term bonds. So I want to see what you're adding on top of the most naive possible predictor. Thanks.
So I have one observation and one question. The observation is, I think, in a world where investors are learning how to predict returns, where technology for predicting returns changes all the time and so on, it's kind of very natural, this finding that you have, that the model for return prediction is unstable, but cash flows, which is not an equilibrium object that you're trying to predict, is more stable. So this makes a lot of sense. Now, if you now think about this through this lens of investors are learning over time, sources of alpha maybe decaying, disappearing, and so on, it would be very interesting to look at the dispersion of these cost of equity estimates that you're getting. Like, is this changing over time? You know, as you get more passive investing, as technology for return prediction improves and so on, like does this dispersion change? Are we moving to a world where it's much closer for different types of firms?
Yeah, so your approach like takes as given, like takes for granted that that managers are thinking in terms of like present value logic, that they have some sort of discount rate in their head, and the whole challenge is sort of estimating it. Makes perfect sense to us, everyone in this room, right? This is how we think about things, right? If we live in a world where that were the norm for firms, like what would you expect? You would expect, you know, them to talk a bunch about very long-term cash flows, right? You talk them to mention discount rates all the time. In practice, we actually have earnings forecasts for the next couple of years, right? In conference calls, like 99 out of 100 of them don't talk about discount rates. It is noteworthy for this such a central object that we're trying to estimate that people just don't, like how many hoops we have to jump through to actually estimate it. Doesn't mean it's wrong, but it is also like, you know, you would expect if it's as important to, you know, practitioners as it is to us, like it would be a lot easier and much more straightforward to sort of go about finding out this object.
I thought the asset pricing implications were really interesting, but if I were to put my corporate hat on, I am a bit puzzled why you think this thing that predicts future returns mostly through mispricing and alpha should be the cost of capital that firms use in their investment decisions. If we think about a firm right now that's currently undervalued and has high MCC according to your measure, you're saying they need to apply a high discount rate to their investment projects, and that seems to be an under investing mistake, because what matters for the firm should be the opportunity cost of capital that investors get for investing in this firm versus some outside option with the same risk. And if you're offering just alpha, you should actually be using a much lower cost of capital.
I think we'll stay with the tradition of 4 questions so you can remember, and then we'll come back to more questions.
Yeah, thanks a lot. Thanks for a great discussion, and thanks for all these great questions. Yeah, with Stefan, we very much agree that learning could be a natural reason why this rises, and something we should discuss in the paper. I don't think we have results on dispersion right now, but it would be cool to look at and see whether sort of setting, it could both be over time, but it could also just be subsets of the data where you think investors know more, you see less dispersion. That would be an interesting prediction of that paradigm. In terms of what you say, Alex, and you know, we've been back and forth on this a few times about to what extent managers use cost of capital. I think if you look at the surveys that CAM have run in the past, 70 to 80% say that they use, or like 90% of the large firms say that they use some kind of cost of capital in that calculation. So even if they don't talk about it, they say that they use it. But you also asked, but also that they use discount rates. And then if you ask what would you expect to see if they use the cost of capital, you'd expect to see exactly this figure here. So at least we have consistent evidence to support this. For Stavros' point, you know, with whether we have with the role of interest rates, it's an interesting idea. Let me show you a figure somewhere here, which is US only. So now we don't have country level variation. This figure here, it has a time fixed effect. So there is no room for an interest rate to influence. This is all driven by cross-sectional variation and the actual cost of equity. So I think that sort of answers your question, that it is really it's down to this rather than the interest rate. In terms of what we do with the depreciation, you're exactly right. The way we do it is we model the free cash flows, which actually already takes into account potential reinvestment and stuff like that. And that is also the cash flow you want to use when you use when you use the present value formula to back out returns. So
then when you come to the tail, you're assuming that the free cash flows grow at the growth of GDP, right?
Yeah. It
should be GDP minus depreciation.
Yeah. Yeah, you're right. For the growth, you're right. There we just allow them to grow at the same rate. And so maybe we should try to play around with what depreciation would matter for the terminal values of these things. Remember, we put in the same terminal growth rate for all the firms. So in our cross-sectional comparisons, you know, what really bites is how we deal with the first 10 years where we actually predict the cash flows, and then there's less weight on the terminal value. So, Did you, oh, yeah, with Kelly's point, there was excellent point that I think sort of relates a little bit to the Jeremy Stein idea of maybe you don't want to use expected returns as your cost of capital when you if you think that markets are driven by mispricing. And let's just be clear that we don't start out by saying that this is something that you should do. Like we're trying to be precise on, like, if you want to maximize your market value today, you would want to use the expected returns today, even if they mostly show alpha, even if they're almost only driven by alpha. And sort of Jeremy Stein has that in part of his paper. He's showing if you really want to maximize value today, you should use the expected return as of today, even if it's all driven by mispricing. And his point is more that if you want to explain long run value or something like that, then you want to maximize long run value, then you should start thinking about using a different cost of capital. And we are totally open to that idea as well. This is very specific on maximizing market value today. Yeah.
Okay, so maybe I saw there were a couple more questions, so come on up. We have time for another round. Yeah, Xavier and Carolyn.
Very naive question, but okay, so how should we value a firm then? So suppose we can predict the cash flows very well. Okay, so David will say, well, to plug the discount rate, we use the IRR of a comparable firm, but that's kind of a circular thing. It doesn't tell you where it should come from. So is it, it's not the CAPM, so what is it? And maybe it's the next paper for you, or it's a very complicated. People want to do the CAPM, but they have biased beliefs about cash flows, and it's, I don't know, what should we do?
Yeah, so I was just wondering whether you could say a little more about how the first part of your paper connects to the second part, right? So you do all this work coming up with a forecast of long run returns, and then you do the comparison of the internal cost of capital versus this expected long run return, and you say that it's connected to market valuations. But that has, both of these steps seem really valuable. I think the connection only comes about if you think that the market actually uses your very sophisticated forecast. Another thing, another way of interpreting your kind of hump-shaped result would be to say, well, maybe the markets are using the same rate, same cost of capital as the firms are using internally. In that case, you would expect to see a blob, so you're testing that. You could, in principle, use a whole wide range of market rates of return. They wouldn't necessarily have to be good forecasters. Maybe the market is not predicting returns very well. And it could give you, I'm wondering whether you could kind of use a wider range of potential market rates of return and use your hump-shaped curve to test which one's the right one.
So maybe I'm confused here, but I find your inverted V plot of the log market value against the deviation of the stated cost of capital from your calculated cost of capital is a little schizophrenic, in the sense that you're saying the market, I presume where the variation in expected returns comes from, I think you're saying the price is wrong, the market gets it wrong. And so if you calculate the cash flows and use the price, you can figure out the IRR. So the market gets that wrong, but the market's getting this right. So how do you think about that?
So in your model, you forecast the level of cash flows, right? So cash flows are non-stationary. So typically when we forecast, we like to use stationary variables. So I'm a bit surprised that you forecasted the level of cash flows instead of the growth rates of cash flows. And then you can divide by, on the left-hand side, divide by cash flows today. So you essentially get the price to dividend Campbell-Schiller framework back. So I'm wondering whether you would get similar results, and that makes sort of life actually a little bit easier. Certain things would drop out.
So for the comparison to the machine learning algorithm trained to predict returns, essentially it seems like the improvement doing cash flows has to come from one of two things. Either, like David indicated, it's that you're basically giving it some additional information. You're telling it, look, don't worry about cash flows beyond year 10, just plug in the GDP rate. Here's a present value formula. Just take that as kind of given. Don't question it. You don't need to learn it. You're giving it info. The other option is it's just a functional form transformation that, this is not exactly a linear relationship, and so you're putting it through a non-linear one. I'd be interested to know which of those two things is helping. And if it is the kind of economic theory that you're giving it, I'd be curious what other economic theory might do to help. So say a Campbell-Thompson, the expected return should always be at least the local risk-free rate. You know, if it ever goes below, just bump it up. Something you could tell the machine learning algorithm to just say, don't even consider stuff in these regions and see if that improves the out of sample fit.
Okay, go if you want to take some time to answer.
Yeah, let's do them in order. Xavier, you ask how we should value firms, and I guess we don't really have the full answer to that question yet. I think the way we want to use that here is we're asking for a given firm, if you want to take on one more project as a representative of your overall risk, how do you value that? There's a separate question as to how do you value a firm, and of course we've used the price to solve for the discount rate here, so that doesn't give us the answer. I think you're right that this would be a follow-up paper. Another paper, one thing you could do is you could say, perhaps it's actually quite easy once you know the different discount rates of different firms. Maybe there's a strong factor relation between that and the characteristics we already know. So I can quite easily predict the discount rate of another firm just based on its characteristics. And that would then be a way forward to potentially do valuations. And then I just want to, sell the data again, that what you would then need for that valuation exercise is the unbiased cash flow estimates, which, will be online soon. So, for Carolyn and Daniel, I think you asked sort of variants of the same question, which are very interesting and important point to bring up, which is like, how does this work, the inverted view, when you're in a world where we don't necessarily think that all investors, they know this? Like, Ty showed interesting evidence on like this perceived cost of, the market-based cost of equity being related to expectation errors more than risk, right? So how could this still be the prediction of a standard model? And I think there are two ways of thinking about it. One way is a sort of a very asset pricing way of thinking about it, which is that under the law of one price, there must be sort of one person who has rational expectations about cash flows and rational discount rates who will ensure the prices they exist so they are like this. So you could think of that as being like one smart person that is actually able to discipline markets and make sure prices line up in this particular way, even though there are many behavioral investors that don't do it. You can also think of it, and that's the way Jeremy Stein thinks of it in his model, is that, well, the investor, they make mistakes about the cash flows and that leads to mistakes about expected returns, and it's sort of essentially isomorphic. Whether they do one or the other, they'll still behave as if though, they price as the rational investor. It's just they sort of mess up what is cash flows and what's expected returns.
But in terms of maximizing long-term value for the investment.
No, long-term value, exactly. You're exactly right. This is the current value, and it's, if you think it's mispricing that will resolve over the next couple of years and you want to maximize your long-run value, you should be quite careful about using this as your cost of capital. And so that's, I think, something we haven't explored much in this paper, but something we would love to do more going forward. If you have something to say about that.
Oh yeah, about whether the object we're predicting is stationary. I forgot to say this, but we're scaling the cash flows in the future by the current asset, right? In a sort of effort to make it somewhat stationary. And the reason why we didn't look at growth is because a lot of these firms actually have negative cash flows today, right? Especially in the US. And so that's less feasible than it is for the aggregate market. I think. Oh yeah, first Sean's point about why is it that this indirect method is preferable to the direct method? And you're right, and David also brought this up, which is that we are actually giving it some more information, right? We're giving it some insight from the present value relationship that at some point these cash flows are bound to converge. And that is extra data, if you will. But I also think like our theory speaks the fact that we are trying to use historical data to predict something about the future, right? And if those loadings historically have varied around a lot for expected returns, then that's going to be more difficult than if they haven't for cash flows and you're trying to predict that first and sort of absorb that time variation by using the price in a disciplined way. So it is a combination of more data, but also of these time loading.
Okay, great. Everyone looks ready for coffee. Let's do it.
Firms that go out. It's like that's a very big issue. Okay. Right. So what we do
Yeah, the office is in Denmark, actually, Massachusetts. Because you didn't come from academia. Oh, sorry, I thought you meant Wells Fargo had offices out there and that's. No. Yes, I didn't think they were in. That makes sense. Yeah. I invested. The video on this, yeah.
Value and stuff. I think early, but you know, I think
You make me look at me, always good. Yeah, exactly.
All right, what a great coffee break. We would love to get started. Here we can go like, is this work? All right, thank you for joining us for this exciting session. Michaela Pagel is going to present some capital gains are consumed more equally than others.
All right. Thank you so much for putting our paper on the program. This is joint work with Yi King, who is also here, as well as Guodong Chen from NYU Shanghai, and then Xiao Meng from Fudan. Now, the motivation of this paper is a relatively long literature in behavioral finance that's showing that there's limited attention and that limited attention affects investor behavior, specifically trading. So there are a few papers that show that a stock's return rank within a portfolio affects selling behavior. in using online brokerage account data as well as experimental data. There's a paper showing that mutual fund flows are affected by certain salient lists of mutual funds, such as the WSFUJ category Kings list. Then there's a paper sort of showing more broadly that investor attention and news drive stock prices. And there's also some theory work on limited attention and how that affects investor decisions. Now, we are going to go and take that literature on limited attention and ask, does it not only affect trading in people's portfolio, but also how much people consume out of their capital gains and what stocks do they sell and then consume? And here we are related to the literature on the marginal propensity to consume out of income and wealth shocks. That's a big literature where there's been showing that people consume a lot when they get, for example, cash windfalls. And the one paper that is most closely related to ours, probably the DiMaggio paper that is using Swedish administrative imputed consumption data to estimate the marginal propensity to consume out of dividends versus capital gains. And then there are two other papers that sort of also show that the behavioral biases are not restricted to the domain of trading, but also affect consumption. So that's the Loos and the Sumit Agarwal paper. Now, this literature shows that there's a lot of heterogeneity in the marginal propensity to consume, and that affects fiscal and monetary policy and is an interesting quantity for macroeconomists. So standard economic theory says that, there should be, for example, no systematic variation in the marginal propensity to consume due to irrelevant sort of like design, brokerage design or display features. For example, like what fund has a capital gain and what other fund doesn't. And now we're gonna, based on the behavioral finance literature, ask, given that there's limited attention, do people consume more out of capital gains that are more saliently displayed? And here really we've sort of like asked a very straightforward question, which is that if a mutual fund is having capital gains that listed on the top of your brokerage page or your landing page, do people then consume more out of those than other funds further down? And here we're gonna use data from Alipay. And this is actually my first venture into using brokerage and bank account data from a Chinese platform. And one of the great things about this that I can say that this is literally the world's largest payment provider. So we are using a random sample from the world's largest payment provider and China's largest fund distribution platform. Now here, the top of the list is the funds that people most recently invested into. And we use that as well as some more quasi-experimental variation, which is from a co-grouping rule of the platform. So what we find is that people consume more out of funds that have capital gains that are listed on the top of their brokerage page, and we use sort of the simple design as well as the quasi-experimental co-grouping rule to establish that. And there's very large variation. So in our preferred quasi-experimental specification, we find that the MPC out of capital gains is like elevated by 9x relative to the fund holdings further down. Then we go on to redemptions. So redemptions are not consumption, but because redemptions are available not at the investor month level, but at the investor fund month level, the redemption specification allows for a much more stringent fixed defects regime and therefore for a much more compelling test of the additional consumption out of funds that are listed on top versus not. And then we have a bunch of further evidence. And here, I think the most important one is the last one, which is that we show that these differences in the marginal propensity to consume do not seem to wash out when we average across investors or when we sort of like aggregate across time. So when we sort investors into groups of sort of like a large fraction of their capital gains are from salient holdings versus groups where like a large fraction is from non-salient holdings, we find like differences in the marginal propensity to consume across these groups at the monthly as well as quarterly level. Already mentioned, this is using a Chinese brokerage account and payment platform data. We have spending as well as investments. We have the data at the monthly level. things like purchases, redemptions, holdings, and capital gains. People invest into funds and all sorts of funds, money market, bond, mixed equity. In terms of consumption, we mostly distinguish between Taobao, which is basically Amazon, versus everything else. We have 2 years of sample. This is a research platform that a number of researchers use. So we are not the only one using this. It's 2 years of data and a randomly selected sample of 200,000 investors. Here we exclude the top 10%. These are day traders, so we exclude them because it's sort of not quite the people we have in mind, but the results are unaffected by that. So we have then 180,000 investors for account months, 4 million account month observation. These are just some summary statistics. So here we have a, not perfectly representative sample of the Chinese population as a whole, but a pretty representative sample of the more wealthy fraction of the Chinese population. Already mentioned, the default ordering on the platform is by recency. So the first test we're going to run is simply, is consumption larger when a larger fraction of the capital gains of the portfolio are generated by the funds that are listed on top of the page. And here we control for account as well as year-month fixed effects, as well as total holdings and the number of funds as controlled. We look at capital gains or capital gains plus dividends. So here what we find is that, yes, when the most recently invested into funds has larger or like a greater share of the capital gains of the portfolio are generated by that fund, we do find an increase in consumption in both specifications with the controls. And we also find that this effect is concentrated at the top. So when we look at recently invested funds versus sort of like funds that are invested a little bit later, then we find a gradual decline where the effect seems to be concentrated at the top. So now what's of course on everybody's mind is like, well, there are certain endogeneity concerns when I look at the funds that I recently invested into might be different for a number of reasons, and therefore their capital gains would be treated differently. So what we do then is we use a quasi-experimental sort of variation that's due to the platform, which not only lists the recently invested into funds on the top of the page, but in that same block, they list other funds that are from the same fund family also on top of the page. So there's sort of like some mechanical variation in the older holdings, whether they are listed on top versus not. And the co-grouping here, right, like what fund family a fund belongs to is sort of like predetermined independently of the fund's later returns. Also, the Chinese mutual fund industry is favorable for this design because there are a few large, well-capitalized fund families similar to the US that all sort of offer the same products, which then is sort of like reassuring that people are not, taking fund family as a sort of a signal of future returns. So now here we have the similar test to the initial one. So here we are basically looking at funds that were not the recently invested into funds, but that were the same fund family or fund company as the recently invested into funds. Same sort of like fixed effects regime. So in here you see on the top that people are consuming more out of the mechanically elevated older funds relative to the non-mechanically elevated older funds. And this is true when we look at capital gains as well as capital gains plus dividends. So now here we have a bunch of robustness specifications that basically address the fact that there's like some residual endogeneity, like some signal that investors perceive about the quality of the fund family when a recently invested into funds like performs better. So, and here what you can see is we have a specification where we restrict to the fund families that have the most products. So in case people learn something about the product space, and here we can do that for the top 50% as well as the top 25% of fund families, right? So then we only take those as the same company sort of specification. And then we also look at the top decile, the top 10% of fund families by assets under management. So, and that would be, we basically restrict to sort of a few very well-known, well-capitalized fund families, like in the US, think like Vanguard, Fidelity, BlackRock. And then we also show that this elevation is sort of present for the somewhat older holdings, but not the much older holdings, which would not be displayed on the top of the page. All right, so now we have another check where we look at redemptions or withdrawals or sales of mutual funds as opposed to consumption. And here we do two things. So first, we basically run the same consumption specification, but looking at redemptions at the portfolio level as the outcome variable. So that's the total redemptions of an individual I in months T. But then what we can also do, because redemptions, unlike consumption, are at the fund level, right? So I redeem a specific fund, whereas I'm just consuming out of my portfolio wealth. So we can look at redemptions at the fund level, so individual I, fund J in month T. And what that allows us is for a much more stringent fixed effects regime. So in this second specification, we can not only include account and year months fixed effects as in our main specification, but instead we can include account times year months fixed effects and then also fund times year months fixed effects, which would also work in like ruling out of sort of like some confounding explanations for our findings. So here what we find is the same as what we found before. So people are a lot more likely to redeem when a fund, an older fund, is mechanically elevated, and that is true in the account level specification as well as in the fund level specification. We use here a random subsample just because otherwise we have like a lot of observations. So just to sort of like speed up a little bit the timing to run the specification. As more corroborating evidence, because another sort of like candidate for saliency would be performance, right? And there are like papers in behavioral finance that show that people pay more attention to like well-performing funds. So, and here what we have, like we can look at performance, of course, but then we also have a nice interface change during our sample period. And before the interface change, like everybody's holdings were ordered according to recency, but after the interface change, people could order according to performance. So, and here what we find is that, yes, like if we look at the top performing fund, if a greater share of capital gains is generated by the top performing fund, we find like additional consumption, but only after the change. So at the baseline before the change, people were not consuming more out of the top performing funds. The other additional evidence that we have is we first do a split by gains versus losses. So here we just have like either only use gains or only use losses. And we do find that the effects are concentrated in the gain domain, which is not so surprising given that there are a bunch of other papers that show that people like to pay more attention to good news than bad news, or pay more attention to their brokerage accounts when they're performing well. And the other check that we do in terms of attention constraints is that we sort of sort people according to more constraint when they hold more than 5 funds and less constraints when they hold less than 5 funds. And here we also find that the effects are concentrated in the group of more constrained people, more attention constrained people. We have a number of additional robustness checks. I think none of them are that important. Like the one thing that we look at is Taobao, so Amazon versus non-Amazon spending. So, and here we do find that the effect is concentrated in the non-Taobao spending. So that's like, say people going to restaurants, for example. Then we also do a bunch of checks in terms of using other input or output variables. So you can look at cumulative gains instead of like monthly gains, for example. We can already mention this, include the full investor sample, so also the day traders, and that does not affect our results. And then we can also, in terms of the top performer, we can change that by cumulative instead of over like monthly returns. Also, all our results are robust to two-way clustering by account and month. So now, the one other important check that we did is sort of this idea that, well, maybe at the individual fund level, there's a large variation in marginal propensity to consume out of, depending on whether the fund is listed on top versus not, but that might just sort of wash out in the aggregate. And in this table, we are showing that this is not the case. So when we sort people into sort of a group of people where their capital gains are very salient and a group of people where the capital gains are not salient, then what we find is that the bottom salience group has or the top salience group has around 3x increase in the marginal propensity to consume versus the bottom salience group. And we can also aggregate from the monthly to the quarterly level. And here again, we find an increase from around a 1% marginal propensity to consume out of capital gains to like a 3% marginal propensity to consume out of capital gains. So now in order to put this like 1% versus 3% into perspective, we solve a very basic CRA infinite horizon Merton model. Here, when you have log utility, the marginal propensity to consume in this model is 1 minus beta, and beta is the discount factor. So, and then we use like the Gourinchas and Parker discount factor, right, and scale it to the monthly level. So what we end up with is a consumption wealth ratio of like 0.36% per month. So that's if you will, theoretical benchmark. It's very low because this agent has an infinite horizon and it's at the monthly frequency. And then we can actually also extend this model using the Manzini and Mariotto econometrica salience framework that is most applicable for our story, as it literally seems to say like what's listed on top matters. And now you can see here all our sort of coefficients in comparison to the theoretical benchmark, which is 0.36. So you can see here, this is the older versus recent funds, and this is the rank gradient, like literally on top sort of coefficient. This is the experimental variation, non-elevated versus mechanically elevated. This is the non-top performing versus top performing post-July. And then this is the, in the aggregate specification, the variation. All right, so the aim of this paper was to show that the marginal propensity to consume out of capital gains seems to be affected by seemingly irrelevant features of the platform interface, or like what fund is listed on top. So we show that the fund that is listed on top seems to have a greater MPC, or capital gains from that fund seem to have a greater MPC than capital gains of funds further down. And we sort of have a bunch of corroborating evidence where I think the redemption specification is the most compelling one, because we can include a much more stringent fixed effects regime. In terms of broader takeaways, so fund level effects aggregate persistent portfolio level marginal propensity to consume differences. So, and that is important because for fiscal and monetary policy, it's important to know like how much people consume out of capital gains, or like how stock market wealth translates into consumption, right? And how much variation there is in this magnitude, and the fact that sort of relatively small things can bring about like pretty large variation in that marginal propensity to consume is, I think, important for monetary and fiscal policy. So I'm going to stop right here. So thanks again for including our paper.
Great. The discussant is Jonathan Parker.
Well, thank you very much for the organizers to inviting me to do this. I'm a little intimidated going after my colleague David, who I think had 6 slides. I've managed to, I'm going to try to get through 20. So this is a fun paper to read. Some of the authors, like earlier work I've read, there's always a spark here of something creative and interesting. And so I kind of am going to do, let me start by just summarizing very quickly what they did, and then I'm going to tell you what I'm going to do with the presentation. So the main point of the paper is that capital gains on mutual funds lead to higher increases in consumption spending when they're more noticeable in this Ant Fortune app. And so they have data from Alipay linked to Ant Fortune. They have monthly holdings of mutual funds, and they see all of the spending on Alipay, which is roughly 50% of the spending of this population, as best I can determine. They're going to drop the top 10% of trading frequency people out of here. They're going to require at least $10,000 on the platform, which is 10,000 renminbi, $750. They're going to Windsorize a little bit and take a random sample of about 180,000 people over 2 years. And the 2-year horizon is a little bit important given the way they're going to run the regressions. The design for the inference is that the platform here listed shown on the right, as Michaela showed, shows funds by fund family. So if you think of a bunch of mutual funds as having been purchased, the app is going to look at what was the most recent one you purchased. If that was a Fidelity fund, then they're going to list all the Fidelity funds first, and then Vanguard later, BlackRock later. Of course, it's the Chinese versions of those companies, not those companies. And so if you have a fund that you purchased a while ago, if it happens to be a Fidelity fund, and that's the one you saw purchased recently, you'll see it at the top of the app. If it's a different one, you have to scroll down to get there. And so there's a difference in the extent to which you can just open the app, glance at your balance, and see what's done well lately. And so the idea is that's roughly quasi-exogenous. Whether the most recent fund I brought was Vanguard or BlackRock is going to lead to very different display items for the old Vanguard and old BlackRock funds that I used to buy. And so we're going to treat that as random. Sort of ideally, we'll switch the old Vanguard and the old BlackRock fund and see differences in behavior associated with that flip. And the main result is that if you're in a non-co-grouped older fund, so it's way down the display, when you have 100 renminbi capital gain displayed, you have a 0.26 renminbi spending response, or very small. And for the co-grouped older fund, so it's displayed along with the top group, it's a 2.41 renminbi spending response. And so that's a 2% spending response over 1 month in response to a noticed capital gain, which is large, right? So that's kind of the first thing is these are pretty big spending effects. They operate only for gains. They do not operate for losses. And the interpretation of the paper is this represents sort of limited attention, selective attention, and oh, wow, I notice it. Therefore, I'm actually much more likely to sell it. And then I also have an almost immediate and pretty large consumption boom. So what I'm going to do is I want to talk a little bit just about framing about what we want to think about MPCs out of wealth returns. So stock returns just are different. Then I'm going to talk a little bit about the identification and the measurement of the paper, just a little bit of showing what Michaela showed, and then comment on that. I have 2 or 3 comments, and then I'll come back and bring those 2 things together at the end of the discussion. So when we think about returns out of an idiosyncratic return, or consumption, excuse me, out of an idiosyncratic investment return, we have to first ask the question, why do households hold different portfolios? What generates that? And then what is co-moving along with that return? And so, and then what's the consumption response out of associated with that return? I don't want to say out of that return at first. And so the standard, they reference this standard Merton model. You have some MPC out of wealth with IID returns. That MPC out of wealth, you see any innovation in wealth, what do you get? Well, it's something like an annual consumption rate of the discount rate, but it depends on the relative risk aversion, but it's something like 0.23% for gamma equals 4 or 0.36 for gamma equals 1. They're very small numbers relative to what they find. So roughly an order of magnitude less than what we'd find here. If you think about individual heterogeneity, it might come from differences in gamma. So now we have an aggregate shock. We bear slightly different shares of aggregate risk. We have slightly different MPCs, but the MPCs would inferred in the way she does would look like this. Or alternatively, you could think of someone who looks and sees the return, and therefore and compare them to someone who doesn't look. And you'd see that capital gain having an MPC difference of roughly these coefficients. Still an order of magnitude less than what she displays. Of course, in this representative version, if you don't have IID returns, then capital gains are not only associated with changes in wealth, but changes in future investment opportunities. So relative prices of the state today versus various states in the future, and so with intertemporal substitution effects also. And so what is an MPC now partly becomes also a response to investment opportunities. Fine. But we're really talking here about much more heterogeneity than that. So in a world with endowment risk, people are going to take very different portfolios, much more like we see in the real world. But the first pass model of that has complete markets. And in that world, actually, there's a zero MPC for idiosyncratic returns. If an you see me get a good idiosyncratic portfolio return, it's precisely because I've used that to ensure an endowment loss. So the MPC is zero. We're using assets to pool idiosyncratic risks and get rid of them. If we take an incomplete markets model, well, the intuition is sort of the same. There's just now basis risk, right? So I'm not able to completely insure my idiosyncratic risks. Now, if we condition on a large idiosyncratic loss or an idiosyncratic gain, it's a big realization. There's some chance that's insuring a loss, but there's some chance that that now is just kind of basis risk that's gone in my favor. And so we might see a slightly positive MPC. Another version is sort of there's financial frictions that stop me from quite getting to complete consumption insurance. That's Sam Schulhofer-Roll has a nice paper on this. You can then think of that as people using asset markets as if insurance is unfair. Now, when I have a positive realization in my portfolio, it signals that I've had a loss in my endowment, but I have not completely insured that loss. That actually predicts in expectation a negative MPC. That is, it's bad news when my house insurance pays off because I've now got to pay a deductible and a copayment. Okay, so there's a bunch of sort of our canonical theories that have us maybe even getting to very low, zero, or even negative MPCs. And so kind of what you need to go to is either households here are having superior information. Well, that's probably not the right model, right? There's one model is there's noise traders, people having superior information. I take a position when I'm right, I have a positive MPC. That doesn't seem quite right for this set of these people. So I'm going to come back and think of these people more as noise traders. So you want to think of these people as not sophisticates. They're trading due to all sorts of idiosyncratic reasons. And I'm going to ultimately think of this paper a little bit as trying to get inside that black box of noise traders. Okay, there's a lot of noise as to why people buy and sell and leading to variations in consumption. And this maybe gives us clues for how to get inside the black box of noise traders, which is, of course, something that I think professional investors are now doing too, now that they have access to more data on the noise traders. But that makes us think about theories of behavioral biases, mistakes, heuristics that lead to idiosyncratic trading. And the positions are taken due to, for example, overconfidence in one's own signal, failure of equilibrium reasoning, like Francesca's arguments. People are just taking idiosyncratic risk here for non-rational reasons, if you will. And then if you do that, you're essentially gambling with assets rather than using them as insurance or risk pooling. And so these people are gambling with assets. They're not using with risk pooling. And that is sort of the way I'm going to interpret the paper also, which is this is a population that is doing a lot of trading. They're on an app and they're not super wealthy. And this is not retirement accounts, that they're to some extent gambling, and that might be driving a slightly higher MPC. It is kind of fun money to play a little bit with, and a win means I get to go out to eat. There's also the possibility that households actually want idiosyncratic risk, which I guess is what I just described. There's a preference for gambling that somehow comes out of the world. And I guess my line here in parentheses, the complete markets world where all states and dates, you can just order your goods and then you sit back at home and Amazon delivers you what you want to eat and everything will stay to the world is kind of boring. And that actually some risk and, I'll get up in front of a large room and give a talk and we'll see how it goes. That's a little more of an interesting life. So, okay, so households here choose to trade a lot. They choose to hold idiosyncratic risk. And then so this paper has evidence that I'm going to do a little bit of critiquing of that they overconsume when those gains are first noticed. There's also an aggregation exercise in the paper that talks about how big these effects might be. That I'm a little more skeptical of, and it's because we have this thing called the equity premium puzzle, which is the market can move a whole bunch and consumption doesn't move a lot. And under previous organizers, half the papers run the equity premium puzzle. Now we're talking about lots of other things because we had this nice shift to different topics. And so I think that is much more, the problem we have in asset pricing is not that that people consume too much in response to gains. It's that they in some sense consume too little, and that's a pricing puzzle. Okay. So let me talk about identification and measurement, and I'll return to theory now at the end. So The same company grouping design is the idea that we're going to compare the co-grouped to non-group co-grouped older holdings of funds, so that you bought this fund a while ago, it's sitting in the app. Some of them you have at the top and some of them you have at the bottom. The specification here is, as Michaela showed, the key variable is we're going to control for all capital gains. We're going to control for all the recent capital gains. And then amongst the non-recent capital gains, we're going to look at those with the same company versus not. And so that's this key beta 1 is that sort of the capital gain with the double interaction there. I have one sort of complaint that I'll come back to, which is that this is a consumption levels regression with a fixed effect. And really, I'm not exactly sure what the dynamics of how capital gains ought to ultimately end up in consumption. If I'm wealthier, sooner or later, I'm going to consume it. And I would have thought when I first looked at this that this should have been more like a consumption growth regression, where we're thinking about movements in consumption over time being driven by capital gains. And all of the MPC type literature that I've referenced and will reference is about changes in consumption. Now, this is just whether it's high or low over a 2-year interval, given that there's a fixed effect. So there's, to some extent, this is about a cross-sectional regression and changes in consumption relative to the average over the 2 years, but I would have liked to see something a little bit more dynamic. And then there's the identifying assumption that the same company, the recent, sort of the grouping recent is roughly randomly applied. Okay, so the main result, the second column controls for the number of funds and the amount, I think. So some instability for not a whole lot of controls being added, but the key coefficient here is about 2% higher spending response for a fund that's old, that is noticed, versus a fund that's old, that's not noticed. And that's a pretty big spending response. It seems pretty robust. So, okay, so let's run through these just in order. A few other things. So it is also associated with a much higher propensity to sell that capital gain. So the typical 100 renminbi gain on a recent fund, 56 renminbi are sold relative to a fund that is old and isn't sold. So there's a much bigger propensity to sell winners that you notice. If this really were an attention effect, as Michaela argues, then the more funds you have, the more this effect should matter, because the further down the older funds are relative to the new funds, and indeed they find that. So funds listed at the top versus the bottom when there's a lot of dispersion, the ones at the top have even higher relative spend propensities of 3%. There's some evidence on asymmetry. This doesn't happen for capital losses. That I'm a little more suspicious about, but that suggests that there's something. I'm not sure why the attention model has to come with that, but and then there's a bunch of robustness, including the platform changed the structure by which it did the ordering. And when it does that, Michaela's effect changes as they expect it to change. So 2% is a standard annual MPC out of wealth. It's not a standard monthly one. And so this is a very large effect. On the other hand, I wear another hat when I stand in front of macro groups that's about large MPCs out of cash transfers to households that tend also to be much higher over a month or two than we would expect in real life. So, sorry, than we would expect in model life. Sorry, I got that backwards. So let me start comment number 1. What is consumption in the paper here? Well, it's transfers and consumption-like spending out of the Alipay app, which covers about half of spending. And that's food delivery, ride-hailing, healthcare, travel, in-person merchants. It's missing consumption done by cash. Either we pay chat. Other platforms, I don't know if there are bank transfers. I'm not as familiar with spending money in China. The fixed effects sort of handle some of this. But there is a threat here, which is that associated with this capital gain is either a shift to a shift to spending on the app. So if I can choose the channel by which I spend, and I happen to sell a fund recently and I've got a big balance of cash on the app, maybe I just shift some of the spending that I would have done before through other channels into channel on Alipay. And that's a threat to identification that would lead to a higher estimated MPC. Another version of that is I see the capital gain go up, and actually I increase my spending on all channels equally, right? That would mean that the MPC is actually underestimated by a factor of 2 if we're capturing only half of consumption spending. That would be an even much bigger effect of 4. So I would say for both of these reasons, there's a pretty large uncertainty over the actual magnitude of that MPC, but I find it quite interesting that it is there and significant and robust, but I'm not taking to the bank, if you will, that exact number for now. On the one hand, they show that this effect is concentrated on non-Taobao consumption, which is the stuff that you don't buy on Alipay. As I have this sort of the platform, the Amazon version that is integrated with Alipay. But instead on restaurants and local merchants, they think of that as a robustness. I think of it a little bit more as the threat that actually you're substituting one channel of spending for another. Comment 2, I guess you're not waving at me, you've got a pretty tight looking digital counter there. I am reasonably convinced by this quasi-random identification. That seems pretty close to random as things go. And so I really do take to the bank that when you notice you're more likely to sell, which looks to me like a nice sort of disposition or selling winners effect that's been documented before. This is a nice quasi-random view of when you notice them. And it raises my prior for how likely that is to be a real behavior by somewhat more exogenous variation. So very nice. I had trouble coming up with other stories for this correlation. I would push the authors to do something a little more on dynamics, which might actually do some help for some of the, give me a little more confidence in the actual maybe value of the number. So they do a distributed lag of the effect in their model, but still all in levels that shows that the effect comes mostly in the first month and then decays. I think of this as not that different than this. But even though it does have a much bigger standard error. But I would have thought you'd want some specification about consumption on fairly far back lagged either wealth or consumption. That is, at some point, all of that information is incorporated and my consumption is set relative to that wealth, or you're going to measure consumption from that date. And then you have a distributed lag of the capital gains that are happening where you're kind of putting in measures of how noticeable they are over time. Because some things start very noticeable and then become unnoticeable and then become noticeable again. And it might be nice to kind of give me more of a sense as to how that capital gain ultimately feeds into my spending. Once I do notice it, presumably within a few months, everything is noticed. Whereas you're just telling me in the very first month, whether it's noticed or not matters. The ones that you didn't notice right away at some point become noticed and feed into consumption. How long does that go? Gain loss asymmetry I'll also skip. It is consistent with this idea. Well, there's two pieces of interpretation. Is this sort of a ostrich effect, if you will? The salience draws the attention. When I see the win, I sell it and I spend some, and I just want to pretend I didn't see any losses. So that gives you the asymmetry. Or more of a disposition effect, where you just like to sell winners, the cash is then in the account, and therefore you spend. Summary, why do households hold idiosyncratic risk here? I interpret this paper as about a population that trades and monitors often, and we might usually think of as noise traders. And so then we could ask the question, are these results useful for thinking about asset prices? On the one hand, you could say yes, because this is evidence there's noise traders. Well, not very interesting. Slightly more interesting, this is evidence on how noise traders actually behave. It's kind of frustrating to say noise traders and just they're a random variable, rather than noise traders and here's how they behave and here's how they're a function of fundamentals. In some sense, they're black matter and a measure of our ignorance, and so this is starting to pull back the curtain and become a little less ignorant. Or you could say, no, they're not that interesting because sophisticates set asset prices. But then again, retail investors do sometimes seem to set asset prices in the meme stock rally. So this is, again, useful. Why do households consume so much so quickly? Well, no evidence of this overspending comes from liquidity constraints, consistent with some of Michaela's earlier work. My view is that the spending number is a little bit uncertain. But if it turns out on deeper analysis, and if we could measure the bundle to be high, it might still be that these are people who this is their play money. This is money they're playing around with in this app. They're trading a fair bit, and a win is sort of fun money from which they might have a slightly higher MPC than they would over retirement account or bigger account numbers. And so this is a paper about a population that trades and monitors often. Has some preference for gambling a little bit, and this is an MPC out of Sun money. So to conclude, this is solid evidence of significant effects of what we often ignore as a field, which is how information is presented. It has quasi-random variation in whether you observe a capital gain or not. There's reasonably solid evidence that households are much more likely to sell gains that they observe than that they don't, and that this feeds into higher spending on this app, and whether that is a total MPC number that is consistent with that number on this app is still, I think, a little bit up in the air. So I'm very cautious about the magnitudes about the large MPC. And in terms of generalizing, this is probably reasonable to thinking about people's behavior on Robinhood or Kalshi, but not on Vanguard, maybe not on net benefits. And I'm a little skeptical about the aggregate calculation. It's very back at the envelope, and there's something in my mind about consumption massively underreacting to stock market movements called the equity premium puzzle, which also makes me maybe doubt that aggregation exercise. And I leave with a couple of questions, but I'm a minute over, so thank you.
Great, we can take some questions.
Great, so a very interesting paper. I'd like to make a remark, but this paper in general, all of household finance papers, which is, no, it would be nice, it's great to have all this data, but it would be nice to connect it to a systematic model, because otherwise it's more like there's, stamp collecting dimension to it. For instance, one big object in macro is the impulse response function of capital gains. So here you say, this is what happened in the first month. But what about the whole impulse response function? It would be really nice to show it. Then you say, look, there's this asymmetric, they consume the gains, but not the losses. But when you think about it, it cannot really be true, because you suppose every day you have 50-50 chance almost of a gain versus a loss. If you just consume the gains and never the losses, you're going to consume enormously, always in the positive. So that cannot be the right model either. So maybe as a rough approximation, there's something to that. But I think it would be nice if you said, look, for normal macroeconomists who's behaviorally inclined or open, here's roughly what you should do, what the model of consumption look like. I think that would be very useful. Also, something about dividend versus capital gains. So if you think dividends are kind of a random walk and they're kind of permanent, maybe the MPC of dividends in a rational model should be 1 out of, but the capital gains, it should be more, maybe just 5%. And there was discussion yesterday about temporary capital gains of a fleeting part of a price, or more permanent coming from dividend. Thinking about those distinctions, linking them to simple models would be very useful, so that the product of a paper like that, which is great, again, tons of data, tons of work, is not 12 tables and 9 figures, but more like a few equations also, with portable parameters across for the rest of the people interested in macro and the like. Thanks.
Interesting paper and great discussion. I want to echo a point both Severe and Jonathan mentioned, which is to potentially benchmark your results to some model, or maybe to think about what you can add to some benchmark or classic model we have. Because what you have done remind me of a very nice paper by Andy Abel, Jen Eberly, and Stavros Panagis and Stavros and Jen Jablowski, so feel free to step up if I misunderstand that. But they have actually 2 papers talking about optimizing attention to stock market, in which you have 2 accounts, and there is a stock account, there is a cash account, or maybe a bond account, which you can use for consumption. And there is, I think, actually 2 costs. And one is a cost which is proportional to how much cash you're going to draw. And there is another fixed cost. I think that fixed cost probably capture what we have here, right, in terms of the attention you need to look at the accounts. But I think one thing interesting in their model is they're going to generate some of those responses in terms of you do more when those funds are and when those games are more salient, because they're going to reduce the attention cost. But I don't think the model are going to generate this
disposition effect or the asymmetry. So maybe one thing you can think about is what you can add to their model to generate this asymmetry, and you can use their very nice model as a benchmark. That's just one example, and there could be other benchmark models we can think about, but I think those are all very interesting directions explored, going back to Jonathan and Davia's point.
I wanted to pick up on one thing that Jonathan, a couple of things actually that he mentioned. One is, you know, how much is this more, how much should we think about this more like gambling than investing? And then a comment on, you know, the tight connection between consumption and your gambling volatility or gambling payoffs, and the loose one between consumption and your regular investing payoffs. And then if you want to speculate, I think this is a really interesting paper for where we seem to be going with gambling markets and retail investing, and like the long run wealth dynamics of someone who looks only at their gains and then eats them all sound really dire. Maybe take those.
Yeah, so let me first take the gambling versus investing question, because Jonathan mentioned that as well. So and actually your understanding about taking idiosyncratic risk for irrational reasons really fits my understanding about Chinese investors. If you think about like the stock investors, the turnover, like daily turnover is huge. Yeah, so I do think like the tendency for gambling by Chinese stock market investors or mutual fund investors is a very reasonable guess. Yeah. And then Xavier's comment, you actually made that comment before as well. You want to see a more unifying model to understand how limited attention affects the consumption, and probably whether we should also whether we can back out some of the parameters, behavioral parameters behind, like for example, inattention cost, or yeah. So what we have right now is a more like kind of a descriptive model to understand, try to understand the cross-sectional variations within the portfolio, but not the one that can reconcile also like the disposition, like the redemption, the gain loss asymmetry, and everything. And for Yao's comment, I'm aware of that paper, the intention paper. I think the cost can also be proportional, because if you have like a number of assets, like 10 assets versus 5 assets, or even like 100 assets, your attention may be like disproportionately allocate to the top ones, and maybe less to the latter ones. So it's not like I don't think it's a simple like fixed versus like proportional kind of allocation of attention across different assets. But your point is well taken. I think we'll take a deeper look at the inattention literature.
Given that everybody's very quiet, I just want to add one more thing about the gambling and consumption, because I've been sort of spending some time thinking about this. So in some way, I think so. Like notwithstanding the recent evidence on Robinhood on like options trading, and they sort of like get people into like very high transaction cost trades. But I think one of the great benefits of Robinhood, for example, was that it catered to retail investors and sort of got them invested and interested in trading at the stock market. And given the stock market has been such an amazing deal in the last 30 years, I think like one of the big concerns that household finance economists have is that so few people invest into the stock market. And sort of this, like, if you will, gambling has actually like, some promise, and that this is like a perfectly untested sort of like speculation now. But the promise here is that it's getting actually more people invested into the stock market and contributes to sort of like lifetime wealth building of like a population that was previously not invested into stock markets. That's a little bit besides sort of like the main point of this paper.
Yeah, it's sort of like the high schoolers or grade schoolers that started trading like baseball cards and stuff like that. Everybody always thought that was like a good thing to become, wealthy later on in life. If there are no more questions, we can continue the discussion over coffee, and then we will come back for the last paper.
Thanks so much.
Yeah. guess no, you're gonna.
So if we reflect on, different venues in which we could actually apply this, we went and looked at a bunch of different spaces and ultimately arrived at studying earnings announcements. So basically we have 5 decades of studying earning announcement returns. So basically what happens here typically is, analysts are forecasting what a firm's earnings are going to be. The earnings announcement happens, a firm says this is what our actual number is, and you compute a surprise. So actual minus the estimate, generally scaled by something to make it comparable across firms, and you run a regression of abnormal returns on that surprise quantity. If you do that, you typically get an R squared around 2 to 5%. In the 5-ish decades since we first started doing this in accounting, there's been some great work by other folks to develop more robust statistics. That's this first one, which gets you up to about 5%. Some of my colleagues, they said, well, it's not just earnings that are being forecasted by analysts or being reported by managers. It's also revenue, it's specific costs, dimensions, things like that. So if you go out and collect all those different things that there are computable surprises over, there's 33 other ones, you throw those into this regression, you get to an R squared of around 8%. And so clearly progress over 50 years, but we looked at an earnings announcement and said, well, it's not just this quantitative stuff, there's also a lot of qualitative stuff. So people are speaking, people are showing slides, maybe LLMs, vision language models can help us process that into a format and really lift that R squared above what we have seen historically. So we thought the earnings announcement was a good setting for testing this. And then further, if you think about the release cycle of these models, a new model tends to come out, kind of iterative one every 2 months. Every year, a full new generation. So think about going from a non-reasoning model to a reasoning model. That's kind of the release cycle. And so this stuff is advancing so fast and so frequently that we felt like we needed a benchmark where we could very quickly draw statistical inferences. And so with 2,000 plus earnings announcements each quarter, within a couple month time span, you can actually draw some meaningful inferences. So the benchmark, how are we going to set this up? What's our goal? Basically, it's to evaluate the extent to which these models can actually explain the effect of an information release on asset prices. How we're going to implement this, given an information event, so the earnings announcement, we're just going to ask the model to explain the returns in a very short window around that event. So, in our case, we're doing 1 day. We give the model either the full transcript of the earnings call or a summary. And in practice, people could use whatever they want, so long as it was released prior to the earnings call to assemble in an information set. And so if we think about this setup within kind of a stylized factor model, you would imagine having the firm return that's generally explained by some sort of factor structure and then an idiosyncratic component. In this case, we're interested in the effect of an information release on that idiosyncratic component. So we're going to decompose it into, or the information release itself is like a little omega. So we're going to decompose the idiosyncratic term into some sort of pricing function G of that information, which takes in the release as well as kind of the state of the world prior to the release, and then some noise. And so what we're really interested in is evaluating approximations to G. So assuming that there's some sort of pricing function for the information release, how well can we develop a G? We can't observe G, so we have to kind of infer how well people are doing on this. And the way we're going to do that is basically a very classic setup. We're going to measure the abnormal return, and then we're going to regress that on the predictions. So what we get from our G hat, our approximator, and a bunch of control variables. So you could think about the classic earnings surprise, and I guess I realize now that my mouse is not on this. But the earnings surprise, could be a control variable here in our X. So we were going to run this regression. We get an R squared, and the typical R squareds in the prior literature, 2 to 8%. We'd hope that markets in this very narrow window are able to be a little more efficient than that. And if they can't be, then it's interesting to understand why. And so our hope is that we can lift it from that realm. So a preview of our results, if you just take during our quarter, which is 2025 Q4, and run the regression on just the surprise alone. So abnormal return regressed on surprise, you get an R squared of about 5%. So in line with prior literature, as you start introducing the predictions from LLMs, you lift this substantially, and you can lift it to as close as 20% or close to 20% with some optimization of the context you're providing the model. So that was enough for Ralph and I to be, if I can invoke my California proclivities, stoked, and say let's get something online. And so kind of the first case that we do here is to just apply the models to the full transcript in near real time. So basically, as soon as the transcript draft comes out, we apply the model. So hopefully the labs are not injecting some sort of real time information to bias our results. Assuming that they're not, we're able to get with just the model itself, so without using the surprise or anything, in R squared of around 10 to 12%. If you include in that regression surprise as well, it's not like the prediction from the LLM subsumes the surprise or vice versa. We find that they're relatively complementary to one another. So you get an R squared of up to around 15%. You might ask, is one model dominant versus another? If you look within the quarter and you look across industry heterogeneity, what you find is that actually, it's not clear that one model is dominant. Opus, for instance, is better at consumer durables, but is really bad at chemical companies. Everybody seems to be good at business equipment. I can only imagine that's because stonks go up. But it suggests that maybe there's some sort of multimodal or multi-model or ensemble approach that you could use to combine these things together. A challenge with what we want to do, eventually we want to optimize these things. We want to apply some sort of optimization technique. A typical earnings conference transcript is maybe 16,000 tokens. So, that's not huge, but it's enough that doing optimization is kind of burdensome. And the kind of OG application of language models with summarization. So, there is some fluff in these calls. If you sat on one, you probably know that. And so we apply an LLM to just summarize the transcript. We find that on average, this leads to a summarization that's about 28 times shorter than the full transcript, which basically enables us to do optimization quite quickly without a whole lot of loss and explainability. Particularly if we use Opus, which is very good at summarization, we get artifacts that basically don't degrade the performance of the little models that we're applying to the summaries at all. So that basically sets us up to say, okay, let's start applying some optimization techniques. So for anybody that has done optimization before, you might be familiar with kind of gradient-free methods, or one class of those is genetic optimizers. And so there's this technique for prompt optimization called genetic Pareto optimization. It basically just refines the prompt by sampling a whole bunch of candidates, looking at which ones work well, which ones don't, synthesizing that into a new pool of prompts, and then iteratively doing this over and over again. So we apply that. We find that we do, in fact, like the optimizer works in the sense that it reduces the mean squared error. It drops by maybe about 30%. However, when we look at this, what we see is that, well, it doesn't really move R squared a whole lot. So, the baseline right here to just minimizing the loss, that's MSE, not a whole lot of movement. And if you were to inspect this model, let's say it's a traditional machine learning model, you could look at it and there, through diagnostics, you could say, oh, well, actually what happened is the model was debiased. And that's great. It's nice to be able to see that, sort of statistically, but to illustrate the power of one of the things we're doing here, you can also just go and look at the prompt. And what we see is that the prompt realized that, good, the manager saying good needs to be priced in, that is actually neutral. And so the model, the MSE reduction that we're getting is basically coming from just debiasing the model. And we can infer that from the prompt that pops out because it talks a lot about sort of debiasing the predictions and being more neutral even when the managers are saying good. In addition, we can also see that there's some sector-specific heuristics that it's learning. So, we've shown these things to some different people in industry, and they go, yeah, that's, very reasonable for what an analyst would say. So we think that's kind of cool that through a data-driven technique, the model can learn these heuristics that, an analyst might themselves be using as well, without us ever explicitly, telling the model to do that. The second optimization technique that we apply is something called agentic context engineering. And so it's a similar idea, but basically what happens is the model attempts the task, it reflects on the outcome and how it did. And if it did well, it tries to understand why and then write a rule that will help it in the future to put into the context. If it did poorly, it can reflect on why it did poorly and then again write a rule. So it assembles this rule book over time that basically tells the model how to actually do this task well. And so when we run this, we find that actually it does have a meaningful lift in R squared. So that number where we got close to 20%, that comes from this agentic context engineering. And similarly to the JEPA genetic Pareto optimization, the cool thing here is that again we can look at what are these rules that the model is coming up with, and what exactly are those encapsulating. And so one thing that we've been thinking about a lot is, if you solve a benchmark like the one that we've set up and you have a rule book that enables you to do it, you could maybe take this rule book and try to understand the important factors that should be in an asset pricing model to explain what's going on. And so on that notion of kind of solving a benchmark, one of the comments we've gotten frequently is, why do you need this benchmark? Why do you need this competition? And to give you a little bit of insight into where Ralph and I are thinking, there's this thing called ImageNet that was invented like 16 years ago at this point, or were introduced then. And it was this very large data set of just images from the web that were assigned to classes. So Pomeranian, Labradoodle, hot dog, things like that. It was huge at the time, and along with it was a challenge to apply computer vision techniques to classify the images. And initially when this came out, humans were actually still designing the features from scratch themselves, and the error rate on this was about 30%. So, close to 1 in 3 predictions was wrong. AlexNet in 2012 came out, like 2 years after the benchmark was launched. If you're not familiar with that, that is basically the model that kicked off the deep learning revolution. It was the first one that was trained from scratch, from random initialization to do a task like this. And it dropped the error rate by a factor of 2, basically down to 15%. It was absolutely insane at the time. I remember I was a mechanical engineer designing engines, and I was like, I got to get me some deep learning, and went into this field. And so, gosh, sometimes my jokes hit like 50-50. So we got a large drop in the error rate here. Further refinement of AlexNet itself went down to 11%, and then eventually the introduction of ResNets dropped it better than humans. And so one thing to push here is that AlexNet, like that was an academic paper itself that was born from this competition that's like basically kicked off the revolution we're currently in. ResNet, I think most people here have probably heard of ResNets. That was a huge foundational paper that changed the way we train models, transform models, all have residual skip connections in them. That was the paper that introduced those. And so this benchmark by itself, well, you might say, do we really need to have one of these? 2 of the most foundational papers that basically kicked off everything that we have today resulted from this competition. And so we believe pretty strongly that this is an opportunity where if people solve this benchmark we've set up, maybe we'll learn a lot about asset pricing. So on that note, I'll conclude. We launched this benchmark with Optiver on Monday. We have about 200 signups so far, so we're pretty excited about that. 40 plus people are kind of actively making predictions right now. If you want to join yourselves, which we hope that you will, and put your agent out there or your technique, it doesn't have to be AI based, it could be machine learning based. Go check us out, explainingmarkets.ai. There's a leaderboard there that should be populated next week. Once we have 100 plus observations, we have enough data to run the analyses. There's some cool visualizations we'll give you of your agent running in real time, things like that. And of course, this is a live project that we plan to continue updating. We have a lot of ideas for future things that we can do, but we wanted to get the thing up and running so people can start participating. With that, thank you very much for inviting me, and I look forward to everyone's feedback.
The discussant is Itai Goldstein.
It's 9. This is yours? Yeah, this is yours. Okay.
Okay, thank you very much for inviting me to discuss this paper. I have to say it's not an easy paper to discuss. It's hard to argue with the idea that AI agents are doing a good job explaining market returns. So it's more about what do we make of it, where do we take it further, and that's what I will try to focus on. But let me start by just explaining in my own words what the authors are doing, what is the background for this paper, and then give my comments. So we start from earning announcement returns. We know that earnings announcements is a major information event for firms. And there's a lot of literature trying to understand what earning announcement imply and what can we tell about the stock market return that follows earning announcements. It's kind of striking, and the paper brings it up pretty clearly that it's been extremely hard to explain stock returns following earning announcements. There was typically a pretty low R square in older literature that did that. The way that it's typically done is that you take the earnings surprise, which is basically what is the earning relative to what was anticipated before. You put it as an explanatory variable on the right-hand side, and then you try to use that to explain the earning announcement return. People have done that for decades. R square is pretty low, and newer literature is adding a lot of bells and whistles, like features from the text that is coming with the earning announcement, and still the R square is pretty low. So when you're thinking about it from the point of view of asset pricing, this should be one of the most fundamental questions in asset pricing because it really leads us to doubt what exactly is reflected in the market. And that's why I think it is of interest to asset pricers. So what they do is basically bring the agentic AI systems into the picture. And we know that there is a growing use of AI agents across fields. I think Bradford did a pretty good job giving us the flavor of what it looks like in some other areas. And needless to say, there are many potential applications for financial markets. Okay. So what the paper is doing is to ask, can we use these agentic AI systems to help us explain earning announcement returns? And from the outset, they say there are two complications. One of them is the look-ahead bias. And Bradford explained this pretty clearly. But the idea is that you want to avoid using a system that already has the information before the event happened. And as a result, basically the way that they deal with it is that they're performing the predictions in real time. Okay, so they will train the system on past data. Then there is an earning announcement coming out, and then they will say, this is the earning announcement, give me the projection for what will happen. So I think, generally they do manage to avoid the look-ahead bias as far as I can tell. The other complication is what they call reflexivity. And this is the idea that, over time, AI agents will not only predict returns, but this information will start affecting market trading. So it will already show up in the price. And basically what that means is that over time, the ability to predict will change, right? Because if people are using this information and trading on this information, it's going to show up in the price, and then the earning announcement return is also going to change. I don't know if there is a solution to this problem. I'm going to come back to this later, but I think this is still a speculation and still remains to be seen whether AI agents can deal with that. So the main result, as you could see, they do quite a lot in terms of different AI models, and then they are optimizing, and there's a lot of work going on in the background with these AI systems. But just to zoom in on really kind of the main thing that they show in the paper, it's just this R-square feature, right? That if you look on the left, the blue bars, this is kind of a summary of what was the R-square that was obtained in older literature, somewhere between 2% and 8%, roughly. The green ones is what they get with their AI agents. And this goes up to 18 or maybe even 20% in some cases. So they managed to increase the R-square, the predictability, quite significantly. And again, just to be clear, what they're doing is before an earning announcement comes, they will ask the AI system to predict the return using the information from the earning announcement, but before we see the return. And then they will put that as an explanatory variable on the right-hand side, trying to explain the actual return. And then they combine this with the earning surprise. And with all this together, they get to up to 20% R-square. So there is a significant increase in predictability. Okay, so that's kind of the paper in a nutshell, without going into all the bells and whistles of optimizing AI agents and so on. So let me tell you what I'm gonna talk about. As I said in the beginning, I think it's a natural and interesting exercise. It's hard to debate with that. It kind of adds to the growing chatter we have all around us about how AI agents can do things better than us. But I would say that they're being pretty careful not to take it too far, but rather they just say, look, we can improve the predictability. I was expecting to see more in terms of like, we don't need asset pricing research anymore, but there was none of that there. It was, I think, all pretty balanced and measured. So I don't have as much to complain on that. What I will focus on, so I will wear the hat of an AI skeptic and kind of try to push a little more on the key message and what do we take from that? Okay, so what do we really learn about asset pricing? And then I would try to broaden the scope based on some of my own research interests, in particular involving information in financial markets and more recently AI trading in financial markets, and try to argue why things are maybe a little more complicated and more nuanced, and maybe some things that we may want to think about interpreting these results or taking them further. Okay, so let's start with what do we learn from the paper. As I said, really the main result is about R-square. And I think it's a matter of interpretation. How surprising is it that AI agents can generate such a high R-square or relatively high R-square when explaining the earning announcements returns? Of course, the AI agents are trained on a lot of past data. They can include a lot of variables. They have a completely flexible structure. So, is that really that surprising at the end of the day? I think different people will have different opinions. What digging in, of course, comparing this to machine learning also enables us to take something that is very flexible and try to get better predictions. So the question is, what is the main advantage here relative to machine learning? And what the authors emphasize a lot in the paper, and we also saw some of it in the presentation, which I generally agree with, is that the advantage of these AI agents is that they give us human readable justifications and rule books, so you can actually get some output. I think the return is going to be X because of this, and that potentially can provide us quite a lot of information. Okay. So my questions here are the following. First, can we really trust the justifications that are provided by AI? I mean, AI can come up with something just to justify what they predicted, but it's not necessarily the most sensible thing. And I think we want to evaluate that a little more closely. We can't just blindly trust whatever is the readable justification that the AI is giving us. What I would like to see, and this was kind of disappointing in reading the paper, I did not see much in terms of plausible new economic insights that are coming out from the AI that are explaining those returns. And I thought this was the main thing that we were trying to get. So I think they do have some of the output from the AI, and we saw a few paragraphs there on the slide, but that's about it, what you can see in the paper. I think it would be much more interesting to get a lot more information how AI justifies those returns and whether these stories are really plausible or not. Okay. A related question is, why do we focus so much on this one dimension of the performance of the model, R squared? One would say, well, this tells us how well we understand market prices, but I don't know that at the moment. I feel like I understand market prices better from the paper because we don't have this underlying economic model or reasoning that we can match to the prediction. So it remains a little vague. Another reason to focus on R squared, maybe you want to have some kind of a trading strategy where you can trade on these pieces of information, the predictions of the AI, but then R squared will not be a sufficient measure to capture that. So I'm wondering more generally about the R squared. So let me take a step back and ask, from the point of view of understanding information in financial markets, what are the questions we could be interested in this context? And, suggested to the authors, maybe they can think about it a little more. Because at the end of the day, one who is outside the literature, did not run regressions of earning announcement returns on earning surprise, might be wondering, why do we care so much about explaining earning announcement returns? So as I said in the beginning, I think we might care about it because fundamentally we want to know how information ends up in prices and how informative prices are. But at the end of the day, the current exercise doesn't tell us as much about that. So here are some questions based on literature that is very close to me that I think would be interesting to try to understand with those tools. So first, how does information get into prices? If you want to understand asset prices, how does information show up in prices? Is it based on trading? Is it public announcements? Who are the informed traders that bring the information into the price? Second, one of the biggest questions we always ask in finance is how informative the price is about future cash flows. And that is kind of, trying to take the price change and seeing how much of it is reflecting really future cash flows, future fundamentals, and how much of it is just noise, okay? And that's not about predicting the earning announcement return. It is about trying to get a sense whether the earning announcement return is informative about what's coming next. And I think that would be, you can dig into that by trying to see what information shows up in the price according to the AI agents. I think that would be a very interesting question. And finally, taking it to the final level, what we call market efficiency versus real efficiency, which is the idea that the efficiency of the market is not just about how it projects future cash flows, but also whether it provides information that helps allocate resources. And again, that is something that potentially could be observed with those tools. Okay, so I don't have a lot of time left, so let me be a little quick here. So the authors acknowledge the complication that is coming from the fact that information from AI agents will start showing up in prices. At this point, I don't think the analysis in the paper helps us with this issue. I think in general, it remains a speculation whether AI agents' prediction will adjust over time to account for the way that prices are reflecting the information. Okay, I think that remains to be seen. We will probably need a lot more data to see that. You know, asking whether the agentic AI system can figure out the whole feedback loop that is generating market prices so that they understand that some of the information that they're projecting will show up in the price, and you know, how this is changing over time, that's certainly a very interesting question. I don't think the paper right now can help us with that. So I think this is still an open issue. And I will also add, it's not just that the market is going to change as a result of the use of AI, but the firm's behavior will also change. I mean, if firms know that this information is reflected in a different way, then they will start changing their strategy on how they announce earning and so on. So there is a lot to think about. Now, so we are doing some AI in financial markets research with Winston there, and he presented our paper a couple years ago. And I wanted to bring that in because I think that there is a lot to think about when you're thinking how markets are going to change with AI agents. What I did so far was just to say, well, the information from AI agents will be reflected in the price, and that might complicate the way that you can look at earning announcement return. But it goes beyond that, because what we are thinking about is how AI agents are starting to interact with each other, and we document in experimental settings behaviors like collusion, where they are withholding information from the market, and behaviors like manipulation, where they are trying to make a profit by anticipating the price path. So again, the AI that you see here in the current paper is very passive, but once you bring the AI to be an active trader in the market, I think those things are gonna look quite different. Okay. Another question is about AI versus humans. That is a question that is on everyone's mind. You know, the pessimistic view will be that with AI agents, there will be no role for humans in financial markets. In another paper that we are doing now, that Winston will present tomorrow in the financial market session, we are basically trying to think about an equilibrium with humans and AI agents at the same time. And we start from the premise that AI agents are better at understanding past market patterns, but humans bring some new information to the table, and it's interesting to see how this plays out. I would say the current paper can help us with that by shedding light not only on how AI is doing better than humans, but more about what are the advantages and disadvantages of AI relative to humans. For example, one could expect that AI is doing a good job predicting returns in normal times, but it's missing when there are big changes. I don't know. That's something that you can look at. Okay, I'm pretty much out of time. I don't know, this competition thing, I was going to say something about it. I'm not sure that's the best idea going forward, to have a competition where people try to get the highest R square. I don't know why we can't continue with the usual way we do research. You write papers and the best papers get presented and published, and this is how we move forward, but I'm not going to get into that. Let me conclude. So it's definitely interesting to see how agentic AI systems are doing in explaining market returns. I would say there's a lot more to think about. So just quickly, 3 things. What are the mechanisms that AI uncovers that we didn't understand before? I would suggest that the authors spend a lot more time on that. What are the bigger questions about information in financial markets that this exercise can help us answer? And then what will happen with the growing presence of AI agents in the market? So I look forward to future iterations of this. Thank you.
Great, we have time for some questions.
So one question I have is, we've learned in recent years about post-earnings announcement drift from, for instance, Patrick Woe's paper with Enriqueta, Marco, and Luis, that you can have these kind of retail flow patterns around them. So one thing I suggest that would be really fun to run, or would be interesting, is if you could kind of look at retail flows, maybe through sub-penny identification like's been done in recent years, and try to see whether the AI is picking up on some patterns in human-driven retail flows that are being processed by the AI that we're not able to pick up on, whether that might be responsible for some of the predictive power that it's able to pick up on stuff that we can't.
Yeah, I want to follow up on some of Itai's comments. I think there are too many papers being written just to sort of get the best out of sample R square or the highest Sharpe ratio. That's the objective, instead of what we learn about the economics of the problem. So I think I'd rather have a model that has maybe a slightly lower R square or lower Sharpe ratio, but that I can interpret and I actually can understand what comes out of it. So I think these horse races, to some degree, I think they're actually counterproductive. I think we should really think about models that may be a little simpler. Maybe they don't give us the highest possible R square, but are still interpretable and give us insights about the economics, what we learn from it, right? I am sure I learn a lot more from the R square of 15% or 19%, right? So I think we should, go back to some economic insights and make sure that we actually can learn something about the underlying economics from these models.
So it's possible that I misunderstood something, but if I understood correctly, the way you are trying to get your reflexivity problem is by saying, hey, when was this technology introduced? Let me just evaluate it after it was introduced, right? But if agents, like investors, have some frictions, let's say they want to take some time to adopt the technology. So in that case, I want to think not only about when the technology was introduced, but when investors started using the technology. That's only then I'll be able to really get to the reflexivity problem. But it's possible that we're already doing that, and I just didn't quite get it.
I'm wondering if we could get some kind of practical advice as to what to do. In particular, for example, your results suggest that the ACE technique dominates the JEPA, though it's not clear to me, given that it's a different platform and Gemini 2.5 Flash is inferior. And I know that you looked at inferior to Opus, Haiku, and Sonnet, but just not obvious. And number 2, it seems like we moved from being prompt engineers to context engineers. And the latest thing, which you didn't mention, is harness engineering. And I'm wondering if you could talk about that a little bit. It is a software governance, and it seems to me that within that environment, you could seed it with Itai's 3 questions, which are fundamental questions. And that would deal, I think, with Martin's point also.
Okay, this is a good time to answer those.
Yeah. So yeah, I'll start kind of from quickest to lengthiest. So in terms of the reflexivity thing, we're not really trying to get at that. We're just basically, evaluating the models at a sample and seeing how well they do. So whether, investors are adopting the technology or not is not really something we're specifically digging into just yet. In terms of the AI and retail flow, is the AI picking up on patterns in retail flow? I mean, we can certainly do that. In terms of the sub-penny stuff, I know Brad Barber has some papers on this, but that sub-penny identification is not great. I think we have John Campbell here. I don't know if maybe Arrow Street can provide some information on how many of their trades get price improved, but I bet an awful lot of them would be classified as a retail trade based on my own experiences. So we could do that, but yeah, I'm not sure the inferences would be super strong. In terms of too many papers, emphasizing R squared and you want interpretability, I think we are completely on board with that. And in fact, I think our hope would be that, maybe if you typically have a factor model or something with 1,000 different factors in it, it's kind of hard to understand what's going on there. Maybe you use Shapley values or something to do some interpretability research. But it's difficult to do that. In this case, it's spitting out something that is human readable. To Itai's point, can we trust that? It can be difficult to do so, but there's a technique called sparse autoencoders, which we've started playing around with. There's actually on that Frontier to Pit website, we do some stuff there where you can actually see that the model is thinking about cheating, for instance, when you ask it a question and it has advanced knowledge of the conclusion. So when there is look ahead bias, you can see that the model is quote unquote thinking about the fact that it already knows the answer to the question and is just going to regurgitate it instead of reasoning through it. So I think we could leverage that stuff to do a whole bunch of more interpretability. We could do some interventions. So that agentic context engineering rulebook that comes up with, that the model comes up with, if the model says I'm going to use rule X to make a prediction and that it's helpful, we can also just intervene and remove that, right? And at random, have it do predictions again and get an estimate of how much, variance there is due to removing particular rules and actually sort of statistically figure out how important is that rule for making the prediction. So I think there's a lot we can do there. Hopefully we don't have to go down the path of, anything AI is less interpretable. I think in some ways, maybe we can improve there. I think it was Cam who said wanted more guidance on these different techniques. Yeah, prompt engineering is dead. Long live context engineering is kind of the mantra in the Valley, but they're like sort of the same thing. I wish we had a whiteboard so we could go through it. Yeah, I mean, I think whatever the hottest new kind of buzzword is for designing some of these things, you'll have an evolution. I think there is, though, some point to originally, a prompt was just engineering one prompt for a task, and then you'd use that for all your tasks. Context engineering is now like, well, it's a prompt, but then it's also, there's these 47 different disclosures that happened over the last year that might be relevant, and there's certain chunks there that I need to provide as context to the model. How do I select the right chunks for analyzing this specific call? And so there was an example from IBM last week where they sort of pre-announced some stuff that led to a very large stock drop. When IBM has their actual announcement this week or next week, pulling that in is probably relevant. And so I think context engineering is kind of the next level of that. Anthropic would tell you to just do harness engineering. So stop engineering prompts and context and stuff like that. Just define the tools. So for instance, here's a search engine over Edgar, and just let Claude sit there and grind in its harness, which has tools like searching through Edgar and things like that to figure out what the right context is, as opposed to you prescribing it. You're not as good as the model would be their view. And so just let it kind of grind in the harness. And we've started playing around with some stuff like that.
Yeah. So let me just sort of reiterate, but also clarify maybe two things. One is sort of like on the economic interpretability. So I think like there's a huge advantage, I think, to realize of like what sort of these models can do. And so we can sort of, I want to push back very strongly on we're just maximizing the R squared. And so really what you're doing here is out of the gate, these models get an R squared of like, let's say 10%. Now you start adding a rule book to it. So you can evaluate sort of the same earnings announcement with and without that rule book. And you can, as Brad said, you can take some rules in or out, and it's sort of like you can see how the predictions change. So now, you know, giving that additional piece of information, does that help? You can then also ask the question, is that rule book portable? Meaning that if I give it sort of like, if it's trained on, let's say, an Anthropic model, and I give it to like a Google model, or I give it to an OpenAI model, and it lifts the performance across the board, there must be something like uniformly sort of that I learn that exports across all of these different models, and we find that it does. Now, then you can ask the question, at this point, like we can say like, oh, it's, I don't know, we go from 8% to 20%. I think many of us in this room may not have realized how low this R squared was to begin with. And we make all kinds of claims of what drives asset prices. If we don't even understand in like a 1 day window around an earnings surprise, which is a quarter to quarterly variation in returns, what drives it, that seems, I know, should give us some pause and say, okay, maybe we should try to understand like what's actually going on those announcements. Now, we currently only use, so the AI doesn't have like retail order flow just yet. So you can manipulate what other information does it get. So maybe it learns from like earlier announcements. Some CEOs may be more optimistic. Elon Musk generically may be more optimistic than others. You can manipulate that information. You can give it information from peers. If other hyperscalers already announced, you can sort of see how that matters for predictions. And so this ability to sort of like manipulate the information that it gets and then see how much it helps you to explain return variation, there's so much interpretability there that we generically do not have with lots of our characteristics, I think. And so I think in that sense, I think there's a huge benefit actually of trying to sort of see, okay, how well can we explain? And then like we can go to the step of interpretability, which is something that we don't have with a lot of the machine learning tools, I think. In terms of like reflexivity, the way to think about that is that sort of like the question now becomes like, okay, as time goes on and let's say you get another event like COVID, et cetera, then like traditional machine learning may need a lot of additional data to sort of like understand how to navigate that environment. Think of the large language models as being like a ginormous sort of economic prior that has learned lots of stuff. And so it may figure out very quickly like, okay, there's a pandemic. What really matters now is like how much face-to-face interaction do you have and all these kind of things. So it may understand how to interpret sort of like certain announcements more effectively. And so in that sense, you get more interpretability, I think, than, I don't know, we had so far. And so the question is, how can we use that? And then if these features start to show up kind of like consistently in these announcements and they transfer across firms, but there's no direct analog in our models, then that should give us some pause. Okay, and so I think in that sense, I'm actually more positive on what we can learn, and that raising the R squared should be a task. And however we do it, structural, not structural, et cetera, I think all of these sort of contemporaneous like events that are so important, I think is kind of relevant. So.
Yeah, I think we have time for like 2 more questions or so.
I'll make the corporate finance comment in the asset pricing. So it's also the case that if you make all of these rules much more explicit and understandable, that a CEO may say, I think I should actually be doing something. So you've made the formula observable for exactly the rating you get, if you will, and then you structure to the rating. So there may be sort of a going forward moving target issue here, which is fine. It's just an interesting thing. But when you know, it may be a victory for asset pricing, but less good for the informativeness of earnings announcements ultimately, because everybody tries to get the signals disappear as everybody signals the same way to try and get the good rating.
Right, but that's I think why encoding it in a rule book is like really interesting, and you can watch the evolution of the rule book over time. And so maybe we can learn from that.
And we'll run a randomized controlled experiment where we only release half the rules and see how managers' behavior changes.
Okay, so first, great paper and great discussions. So I have 2 suggestions. I'm not an expert in this area. One thing is like I was in Citigroup actually just yesterday, and they make a statement. It's like every large language model and every generative AI have located bias. That's their statement. I think you design a method, you can estimate the look at the bias. You can use your model and also with and without look at the bias. That's probably one direction to go. The other thing is like you say lots of models cannot predict like earning like a return well. It be because before the AI, we rely more on structured data. And AI actually allow us to use unstructured data better. And then you can write a paper about the importance of structured versus unstructured data in making predictions. Maybe that's another way to go. By the this is just my 2 cents, maybe free disposal.
Want to respond very briefly, or?
I mean, I think those are both great things that we can dig into and give them a try. So, yeah.
All right, well, that brings us to a conclusion. We would like to thank all the authors, discussants, and participants, and we hope to see you soon.